but we need to keep it high level, because I think this is the thing. I think there's a miseducation. And I think that's the thing. That's why people feel so strongly about it. No one feels more strongly about crypto than the people who dislike it. And a lot of those people are misled. Well, if I send you some, it's taxable. No, it's not. No, it's not. It's not. So there's a lot of things, just like there's no wash sale rule on it right now. Now you have the economic substance doctrine that you need to be aware of, but there's no wash sale rule.
Right, so you can buy and sell it anytime you want.
Buy it right back, so long as you're able to defend the economic substance doctrine, right? You can sell Bitcoin and crypto losses, and you can offset those losses against stock gains, right? Like, there's just really easy things here. You can get it in any form. You can buy it in an ETF now. You could buy it at Cash App. You could buy it on Venmo. You can create your own experience around it now. Is it for everyone? No. Everyone shouldn't own it. But what everyone should do is understand it and understand the technology behind it, because that's what you're starting to see is going to make the experience better. If you, one, send remittances, you have people that you send money to in other countries. If you're tired of putting your check right in the bank and then waiting 2-3 days for it to clear, if you're tired of paying wire fees, all these other things. Why do you think we have a real-time payment system?
For fees.
No.
No fees.
No. When did we get a real-time payment system? Do you know?
After Robinhood? Are you talking about like with stock trading?
A real-time payment system. Like
elaborate.
Fed Now. Do you know Fed Now?
Like +1, +3? No, go ahead and elaborate on what you're talking about.
Fed Now is our real-time payment system, meaning like Japan has had a real-time payment system since the 70s. We just got it in 2024 after it was promised in 2019. You'll have a hard time convincing me that they didn't start to develop that and really lean into it because Bitcoin didn't come into the world in 2009. A real-time payment system allows you to send money, value, similar to Zelle, how you can Zelle people, but depositing your check in the bank and it available now, real-time payments, like real-time. So there's the federal government launched Fed Now. And you want to know why it's not broadly adopted or people don't know? Because of banks. And they don't want to broadly adopt it because of what? If they do that, then what happens? Tyrone is no longer charged $15 every time he receives a wire. There's a reason the existing financial system is architected the way it is. There's some good things to that. There are some bad things to that. So this is what I'm saying. I'm not in a position anymore where I'm arguing with anybody about this. I had put a LinkedIn post about it. Bitcoin is one. There's nothing really to argue anymore. However, what I do think there is just broad misunderstanding, and there needs to be more education for people who want to know. You're not going to convince adults who hate this. I'm beyond that. But I think if you care about people, which I do, if you care about the disenfranchised, like I do, if you think the existing financial system is unfair, like I do, you have to root for Bitcoin. It has to be a part of the conversation because it's this big flashlight that shines a light on everything that I'm saying. That's it. So if Bitcoin goes to zero, it's a massive win because it literally showed every single thing that is wrong with the existing financial system. And you know what? The little b will go to zero. The big B Bitcoin is going to go until 2140. It's when the last Bitcoin will be mined. No one will stop it. Tick-tock, next block. You know what I'm saying? So these are just, you know what I mean? Data, greater sign, feelings.
No, this is good. And I love it, man. I appreciate your passion. Is great. Like, yeah, you really do care about it. And then when you tie it back to why, like you said, you saw it impacted your life. And you saw that you can make a difference in your life and other people's life with Bitcoin. Just for the record, I wouldn't say I'm a Bitcoin bear for anyone listening, but, I'm trying to bring the other side to the conversation. You know what I mean? But more so, you did mention an interesting thing. So Bitcoin is going to, there's a limited number of Bitcoin. While I was doing the bear case with Clem Miller, shout out to Clem. Clem's good people, man. When I was doing the bear case, he mentioned something I had never heard of at the time. It was called forking. You heard of Bitcoin forking? Like where a computer program went in and created like fake Bitcoins, like split them up?
You can fork any blockchain, yes, but what good is that?
I'm asking.
Yeah,
what good is it?
Yeah, I've heard of it, but what was his argument?
Well, he said if specifically with the blockchain and Bitcoin, like you mentioned, you said Bitcoin, there's a limited number of supply. I think that's where he brought it up with the limited number of supply. But if you fork them, that increases the number of supply. So I didn't know how to answer that question, so I can.
That's a very technical explanation to get people to understand, but it's simple. We're going to keep this very simple. We're not going to get in the weeds here. Fine. Could a bunch of developers and miners and node operators fork Bitcoin? Sure. But what do you get? You have to get all of the consensus to go with you. There's other types of Bitcoin. Bitcoin Cash, right? There's all types of Bitcoin, right? No, you don't need a bank account. So you can fork Bitcoin all you want, right? But you got to have consensus. The miners, the developers, the code, everyone has to agree to go there. Here's the example. Go back to what I was saying. Me and you could create our own money today. We could create our own $20 bill. We'll call it the Marcus Ty dollar. Or we got to get consensus from all the people in the United States to agree that our $20 is better than the other. Like, it doesn't work like that. So no one can create more Bitcoin, the Genesis block of Bitcoin. No one can do that, right? That's just, you can't. And if there's a book called The Bitcoin Standard, and you should read the Bitcoin white paper. If you understand this, yes, there could be, fork it. Great. But you got to take all of that consensus, all of them, all those miners, all those node operators and everything with you. Again, very important to keep in mind here. Blockchain, flip it. It's a chain of blocks with information in them. In order for a block to be completed and move on to the next, you have to have consensus of every single piece of information in that block. One has to agree. When everyone agrees, all the node operators and everything, okay, great. Stamp the block, you go on to the next one. If anything in that block is disputed, the block is not complete. But it's all of the information in that block. Stamp it, you go on to the next block. And it's just the history of everything on the chain that can't be rolled back, can't be removed. It's there, which is why when people say, oh, well, criminals use it. Yeah, criminals use the dollar too, but guess what? You're a stupid criminal if you're using a blockchain because it's public, right? Like Cat Williams, I can see you. You know what I'm saying? Like, we can see what you're doing. You know what I'm saying? And this is, and I want Kevin made a comment. I want to make this important here. There are people who don't use a bank now. My partner does not use a bank. Right? You don't need a bank account to deposit anything into a wallet. You need to spin up a wallet and I can send you whatever. He uses an EtherFi card and that's it. He's completely unbanked himself. He only deals with a bank to do business, like our business. Personally, he doesn't use a bank. So you can completely operate on chain if you choose. You only need a bank if you want to go back into the old, antiquated, expensive world of traditional finance. And, all right, I send Marcus $20 of Bitcoin on Cash App. You can sell it right there in the app, and you got money right away. There's a reason why I suggest Cash App to this day as the best venue for people to get access to Bitcoin. Right? So it's not a matter of a bank account or any of that anymore. You need an internet connection, and you can get on chain.
That's some truly decentralized stuff right there. That's good stuff. Okay, so let's say, because we're about halfway through. For anyone listening, watching, Hit the like, subscribe, check out Tyrone. This is good stuff. This is really good stuff. So let's just say that someone's listening. They've got somewhat of an understanding with crypto, Bitcoin. Okay, where should they start? What should they do? Like, you're not telling people they should have 100% crypto, right? Or are you?
You can check every piece of content.
I'm asking.
No, I'm saying I've never done that. I don't even do it with our clients. You can look at and I will challenge anybody that find a financial advisor that has a longer track record of talking about this stuff than me and see where I've said you should own X amount or whatever else. It's not what I'm saying at all. I'm not saying everybody should own it. It's not for everybody. But if you decide that, I don't decide that. It's for people who do the work. You own Bitcoin at the price you deserve. So you should read about it. You should ask questions. You should ask more questions. You should ask more questions. And then when you feel like you want to get exposure, again, I've been saying this. I said it this morning on the podcast. I'm going to say it again here. I've been saying it for years. Look up the restaurant closest to you. That's the most expensive. Figure out what it costs for two people to eat there, all inclusive. Drinks, food, dessert, everything. Buy that much. And your venue of choice, your Schwab account, Venmo, Cash App, whatever, buy it and let it sit. I know one thing. If it goes to zero, you're still going to be able to pay your mortgage or your rent. You're still going to eat. Your kid's still going to play tennis and travel soccer. If it doubles, you ain't going to spend summer in the south of France. But what it'll give you is skin in the game. You'll be able to watch the drops. You'll be able to watch the highs. You'll be able to check the price on a Saturday. You'll be able to check the price on a Sunday. You'll be able to check the price at 2 a.m. You'll be able to check the price at 12 midnight, whatever the case may be, and you'll get exposed to it, and you can learn and grow. Now, I personally feel that, again, I'm in La Jolla, San Diego. Some very rich people here. They've made their wealth off of Bitcoin. Does it make sense to tell some of these people that they need Bitcoin? No, it doesn't. If folks are younger, yeah, maybe it's a part of the conversation. If you are younger and you have a long time horizon, that's the first thing. You have a very long time horizon. You should have a high tolerance for risk. You should know when you're going to get in, when you're going to get out. And you should put an amount in initially that if it goes to zero, if all of the bears are correct, that it is the worst thing since the devil fell out of heaven, you should make sure that it's not going to ruin your life.
Man, I got you. And I also like to, when people ask me about crypto or Bitcoin, like you gave a nice dinner for two, I'll say that, or like going to a very nice sporting event. Maybe not like the Knicks finals because that was so expensive, but like the amount that you could start with.
Whatever analogy you want to use, whatever. But that's just what I've been using because that's probably going to be somewhere around $200-$300, right? Depending on whatever, give or take a couple $100 based on zip code. But $500, it doubles, it triples. You're not buying a Bugatti, and if it goes to zero, life goes on.
Yeah, life goes on. Cool. Good stuff, man. Let's talk about some of the other things. You mentioned that you want to clarity, right? We're seeking clarity from regulations, and you've been screaming it from the mountaintops. You've talked to the SEC, you've talked to different people all around the country, just trying to educate them. Like you said, financial literacy is important. And the Genius Act and the Clarity Act, right? The Genius Act was passed last year, if I remember correctly, and the Clarity Act's yet to be passed. How do you see that? You mentioned yourself as a true crypto hippie.
Yeah.
How do true crypto hippies feel about that?
I think it depends on who you are. If you're Arthur Hayes and you're like myself, I don't think clarity is needed, but there's clarity needed. The Clarity Act isn't needed, to be clear. There are some people who want it because it is going to give clarity around stable coins, what the SEC and CFTC is going to do. It's going to give a lot of clarity around what is a broker, what is not, all these other things, investor protections, all these things. It's tied up now based on the fact that the biggest revenue generator in the space last year was our president. as far as crypto is concerned. So the Democrats aren't happy about that. So it may be tied up here. It may be a while before it gets done. But I personally feel like with some tailoring, it's a good thing, right? I think investor protections are the main thing. Retail has gotten hurt here, and I hate that. But what I hate the most is retail have gotten hurt off the acts of awful people, not necessarily barriers and things that aren't in place. Because a lot of times when you get this legislation, it keeps people out as opposed to giving people access. So I'd prefer to have more people in and have more altruistic individuals be at the head of it, as opposed to this sweeping legislation and then people who deserve and want access can't get it, which has been the norm in this country.
Gotcha. So the Clarity Act is going to give more. It seems like it's going to actually give less clarity, but more structure, I guess.
Yes.
More regulation.
Yep. Exactly. That's a great way to put it. More structure, right? More clarity? Probably not.
And the Genius Act, that was basically to establish that you could have a stable coin?
Yeah. Genius Act was basically all about stable coins, which is why you've seen all these. Everybody got a stable coin now, right? You should have one. I'm going to have everybody got a stable. I don't know what the point of it is, but everybody has a stable coin.
Everybody has a stable coin. And you mentioned that the president was the largest profiteer had the biggest returns in his investment of crypto last year. What are your thoughts on that?
I don't like it. I mean, when you made more money than Coinbase's net profit, that's a problem, especially if you are the president of the United States, and this is independent of party. Right. I just don't think that should be the case, especially when I think his token is down 99% and Melania coin is down like 98, 97%. That's problematic. And again, independent, I just think the fact that our government officials could trade stocks and do some of the things that they do while representing the people is annoying to me. And I will say, I look at these things a little differently because I always feel like we need to put better people in positions of leadership. And if that's the case, you got really high quality peoples with morals, principles, and character that could accumulate wealth, power, and prestige, then they pour back into the people that they lead, right? So that's not happening here, and that's more problematic to me. But and people are like, oh, well, his administration is going to be great for crypto. And yeah, sure. I think he's clearly turned that he hated it at one point, and he had disparaging things to say about Bitcoin. That changed, right? And he wants the U.S. to be the crypto capital of the world, and there's a new administration in the SEC and so on and so forth. So yeah, the next 4 years could be great potentially for me, but that does not mean that there are some things that I'm uncomfortable about and things that I wish were different.
Great explanation. And here on the podcast, the live stream, Main Street meets Wall Street, everyone knows there's nothing political here. It's not red or blue, it's about green, which red or blue makes purple. Anyone's ever seen Purple Rain, they know why the rain's purple. But, the blood in the sky. What are your thoughts? So you have 401 Financial. That's your RIA, correct?
Mm-hmm.
So you have clients and you do portfolios. Like you said, you don't particularly suggest anyone goes 100% in the crypto. So you obviously pay attention to the macro environment, the micro environment. What are you seeing right now in the economy, and how are you positioning your clients with that? Or is every client so uniquely different?
Our clients, every case is uniquely different. Every client doesn't get the same advice. We're an advice-only firm. So every client doesn't get the same advice. It's personalized. We meet with our clients monthly. And to be clear, you talk about 100%. I've never suggested folks make a 1% allocation, including my clients. I've never done it, right? Folks know how I feel about it.
people are, what I see as being a disruptor is people are going to have to start to say, this is delayed. We have delays because of this shortage, or that shortage. And that's going to mean that our facility is not going to be in place. And therefore, the release to the marketplace is going to be delayed. And as those delays happen, I think people are going to start to get impatient and say, hey, I've seen a good run. Is now when I should take my profits and get them off the table. And I think that as people take off profits off the table, I think there's going to be a concern that they're not going to come back, that they're going to wait for what I'll call the correction. And then when people are waiting for that correction, the market might just move sideways.
They say I'll talk fast, but if you listen fast, I'll have to slow down so you can catch up. Curtis Jackson. Look at what's happening in these markets right now. Everyone on financial TV is giving you the exact same corporate canned answer about artificial intelligence, Fed rate cuts, and record stock indexes. But last week, I sat in a room packed full of institutional asset allocators down in ATL, managing billions of dollars. So I sat on the panel, I asked them two simple questions. One, how many of you use AI tools every single day? Nearly every hand went up. Then I said, no need to raise your hands for this one, but how many of you want a multi-gigawatt institutional data center built in your backyard or in your neighborhood? We just let them sit on that one. This instant contrast exposes the exact fault in the global markets today. Wall Street's pricing in infinite software promises, while Main Street's running directly into hard physical limits. Power grids, land constraints, regional geopolitical shocks, and sticky inflation rates that refuse to die down. I'm Marcus Sturman Sr., founder of the ABC Squared and host of the Main Street Meets Wall Street podcast. We're on live right here, right now in Charlotte, North Carolina. The Wall Street is south. We got a little storm coming in. Let me know if you can hear us. Let us know where you're tuning in from. We're live. For those who don't know the numbers, Charlotte isn't just observing, global finance from the sideline. We control over $4 trillion in headquartered banking assets, standing firmly as the second largest money center in the United States behind New York. It's the primary headquarters for Bank of America and Truist and the nationwide operational engine for Wells Fargo, Vanguard, and Barron's. This city sits at the exact intersection where institutional capital flows data into real-world commerce. That's the mission of the Wall Street South Journal, right? We don't deliver speculative hype, and we don't repeat PR or press releases. We bring Main Street real talk straight to Wall Street capital, giving business owners, executives, self-directed investors the unfiltered institutional mechanics required to build, preserve, and scale True's intergenerational wealth, something you can pass down. Now, why does this perspective matter to you? Because you've officially transitioned out of the era of easy money and predictable central bank forward guidance. When we look across the macroeconomic landscape right now, analyzing these markets is like stepping outside and asking whether it's partially cloudy or partially sunny. It depends entirely on where you stand. On one hand, you have massive capital expenditures driving mega cap tech. On the other hand, you have a bond market, which is the absolute big brother of financial assets, signaling that inflation isn't touching 2% anytime soon. And then we still have geopolitical conflicts threatening to push oil right back above $100 and right onto our doorstep as the consumer. If you're trying to navigate this environment using 2020 rules, you're going to get caught in that leverage trap. We saw the leverage trap as it was happening over in South Korea. Those markets and the concentration with the Kospi, and then we saw the leverage that actually was unwound and the way that stopped whole entire market right down. So we're going to sit here and we're pulling back the curtain on everything from Federal Reserve communication or lack thereof, the chaos. We're going to talk about some high-profile family estate lawsuits, semiconductors, free cash flow, the circular tech movement, and how to build an unbreakable anchor into your personal portfolio. Once again, this isn't investment advice. This is just things you can take. Every situation is different, so you have to know your own personal investing situation. But it's just something we're doing right now, letting people know. We have the Wall Street South newsletter. We're going to share our most current edition, which also published as an article on X. If you're enjoying this, like I said, give us a shout. Give me a 1 if you can hear me, if the audio is good. And we'll jump right into it. So for those who don't know, this is Wall Street South Journal. This is an X version, but it's published on LinkedIn. A little over 1,400 subscribers right now. And so this is just this is a summation of a lot of things that's been happening, right? First of all, I was invited. Thank you to the Titan asset allocators for inviting me down to a special dinner and sit on a panel. And on the panel, like I said, one of the first questions they asked were about the data center. The next thing they asked about was AI in the data center. Then we got into the conversation of just where we're at in the world in general, right? So like I said, this is the Wall Street South Journal's July edition breakdown going into August. So it was like a weekly cadence with the newsletter, but now we've moved into a monthly cadence and gone to a much more denser deep dive look for those. So subscribe to the newsletter, subscribe to this YouTube channel, follow on X or anywhere that you can check out Main Street Meets Wall Street or myself, Marcus Durbin Sr. One thing that jumped out to me, we're talking about, we'll start right where it was. As I was driving down on Wednesday, I got to hear Kevin Warsh's speech in its entirety. So I felt I might be dating myself, but going back to like Green Day and that classic track, Basket Case, and it said, "Do you have time? Listen to me whine about everything and nothing and all at once." And I feel that's kind of like what Kevin Warsh did. He didn't really whine, right? But he just kind of went out there and he spoke, but he didn't really answer. He was kind of vapid in his responses, but maybe that's exactly what he was trying to do. I'm not quite sure. And the markets responded. The market went way down. Well, the markets were already down that day, but once he delivered his speech, the markets went down even further. For those listening, I did air quotes. So another thing we have to realize is that Kevin Warsh has said that he wants to communicate different than Jerome Powell did. So perhaps this is how he's choosing to communicate with the markets by not communicating. He wants less Fed speak. He wants less noise, quote unquote, versus signal. He wants the market to tell the Fed versus how he felt before the market was reacting to the Fed. I kind of thought about like this, like Jerome Powell, just, even the way they approached the press conferences, because Jerome Powell was he would give information in the press conference. But so, yeah, Jerome Powell's like a grandpa or someone sitting on that rocking chair right on the front porch of some like big old estate. He's watching it, right? Watching the whole global market. Everyone's running around, staying in their boundaries. Everyone kind of knows the boundaries of the yard. And then we have Kevin Warsh comes in, right? And Warsh comes in, he grabs the chair, and it's like Christmas or Thanksgiving. I got a really big family, extended family, like at the extended family's house where you got 1,000 people running around, and Warsh kind of just got into the recliner, lazy boy, laid back, and just made everybody run around him to see what happens. And that's not to say that Warsh isn't on top of it. I just think Warsh's style is different. We'll have to see. We'll have to give him the benefit of the doubt. But the bond market, like I said, those interest rates, they started to go up. During the speech, we saw interest rates, yields, I should say, not interest rate, but yields on the treasury bonds start to go up, indicating that the market thinks that rates will be higher and that there's only so long that Warsh will be able to, quote unquote, jawbone or just speak about what's happening in the market. At some point, he's going to have to do something. He's going to have to make a move in these actual markets. It's only going to be so long that he's allowed to just talk. So it's kind of like I said, the lazy boy recliner. And then after that, like the next couple of days, we had people coming in, other Fed chairs, and there's only one Fed chair, other Fed governors, vote members. We had 3 dissents on Wednesday. So it was a 9-3 vote, but the 3 dissenters came out yesterday on Friday, and they were all speaking, saying the reasons for why they dissented and stating what they see as the path forward. for inflation, and they definitely seemed like it was higher for longer. Another thing with the Kevin Warsh speech, it seemed to me kind of like when Ryan Cohn was speaking on CNBC, when he was just kind of like half stock, half cash. Like maybe he knows something we don't know. So we'll see. Like I said, but remember though, the bond market's huge. So whether the equity markets are going up and down, we can't really ignore the bond market, right? That's the big part. So a lot of people that bank on bonds, a lot of money investing in bonds globally. It's the big brother. Holds more weight and leverage than the equity market. Well, maybe not more leverage anyway, the way people continue to leverage things, but it's ridiculous. So those are some of the things we're talking about with globally with the Fed and economics. Been in the newsletter, like I said, I want to encompass the total things we talk about money and family, prenups, estate battles, and money dates, right? Because these are some of the things that are in the news right now. We just saw, I just sat down with Ashley Kwame. She's a certified financial behavioral therapist. And we did an interview. It's available on YouTube. It's available on YouTube. The podcast is out on the Main Street Meets Wall Street podcast. Wherever you get podcasts, it's out there. By the way, if you're finding value in this video, hit subscribe, hit like, share this with people that you know. But we're talking about families, prenups, estate battles, money dates. And like I said, prenups is a dirty word, apparently, 4-letter word. But it's not. We can see right there it has more than 4 letters. But with the prenup, we were speaking about how it's not necessarily a terrible thing for someone to have a prenup. And then literally as we were speaking about, we saw the Malcolm Jamal Warner prenup thing start to blow up where his widow is suing his estate. So let's sit there for a second and talk about that for a second. His widow is suing his estate. And part of the reason his widow is suing his estate is because it was set up where Malcolm Jamal Warner was supposed to have $1 million in life insurance. And I think it was supposed to be reciprocal. So she would have a policy back in the same way in case she passed away. Anniversary payouts, like $15,000 to $20,000, somewhere in that range on their anniversary, they're going to pay it out, which, okay. And then there was an annual salary for the role she had in the company and managing, and then guaranteed accounts. So she wanted a retirement account that was fully tax-free, I guess some type of Roth account or something that she could have funded to a certain level, and then college for their children to be funded, which those things aren't outrageous, And I believe at the time, Malcolm Jamal Warner was reported earning about $600K a year between residuals and all those things. Still at it. I mean, he was on the Cosby Show. He was on Malcolm and Eddie, and then he was even on other shows after that. So Malcolm Jamal Warner definitely could have some residuals coming in. Could have. Rest in peace to Malcolm Jamal Warner as well, too. But this situation, like I said, provides a critical lesson. Even when you have a prenup on paper, legal frictions, family obligations, disruptions, disputes, they can still explode. Just got to make sure it's legally tight, and we'll see where it plays out in courts. But none of this matters if they don't do it anyway. We haven't seen it happen. So we'll see how it goes. Like Ashley said, nothing brings out underlying hidden tensions like a good old-fashioned family fight over money. So Ashley, like I said, she was great. When we sat down, we talked about on the podcast, emotional and psychological impact of money. How do couples view money? What are two people in the same household? How can they perceive money so differently? So if you want to check that out, like I said, we got a deep dive into that. But one of the concepts that she spoke on was a money date, which was very interesting to me. So it's where a couple, you and your significant other, she would suggest you do it in the daytime, probably in the lunchtime or somewhere where you just schedule into your work day. I guess it can be virtual. I don't guess she said it can be virtual. It can be virtual. It can be in person. Maybe you're going to get lunch together. You sit down and you talk about your finances. But this is after you've already had conversations to establish where you're at. You'll be surprised how many times you'll see a person who is two people who are married, been married for a long time, sit down and talk with them. Let's talk about your goals, what you want to do when you're retired, where you want to live, how you want to live. And when one spouse says, I want to live in the mountains, one spouse says, I want to live at the beach, right? So there you go. And that starts the conversation. So before you get into the money date, you got to figure those type of things out too. I want to have your budget figured out, those type of things. Then you want to figure out where you're spending, right? But the money date is a good way to make sure that you're actually having some targeted conversations with your spouse or significant other about money, about the ways that you view money, how you're spending money for the month. You don't want to tell someone they're spending money wrong. Ashley, to go back to the conversation, she gave a great example of her husband now has taken up hunting, or maybe he's more of a hunter than he was before. We spend a little more time hunting right now. So, and that's the thing they discuss, hunting. It's not people are like, just stop getting a cup of coffee out every day. I mean, that makes incremental savings, but that's not going to save you, quote unquote, as far as saving goes, money goes. There are other ways to go about it, but you need to figure out, like, if that cup of coffee is important to you, man, if it helps you every day, if it's got to be certain brands you get in there, it's like the middle part of it, maybe you should get your cup of coffee. Maybe you should have that experience every day and figure out another way to save money. But you got to figure out what's important to you when you're spending money, because everyone spends money on something. We usually spend money on what's important to us. So if you can figure out a way to have a money date with your spouse, you and your spouse are just conversating, sitting down, maybe make it a more technical money date, like once a quarter, where you pull out like really hard number spreadsheets, things like that. But one of the points she definitely pointed out that was strong is that you don't want to wait until 9 o'clock at night after working all day to try to have a money date. That's not going to work out well. That's going to lead to nothing but arguments, and nothing's good coming for that. Then you also want to look at the fact as to where the market is right now, where the world is right now. We have inflation going up. We have wages going up. They're not keeping up with each other. The job market seems stable. Where are we going? We have the geopolitical conflict, which I guess we can go into right now. And once again, remember, these are all things that are in the Main Street Meets Wall Street newsletter over on LinkedIn. This is the X version that we're looking at right here, that we're reviewing, the article. But yeah, geopolitics, man, they just keep going into it. You can't seem to get enough of these geopolitical events happening all across the globe. Question that was asked to me: what do you think if this conflict turns into a regional conflict? And, is this not already a regional conflict? You got to look at geography. Look at the multiple points of engagement already, if not just by Iran, but by Iran struck a lot of people out there. They, immediately retaliated when this actually already began back in February. And maybe it really began when we bombed the nuclear site at the end of 2025. But I don't know. It seems like there's more people involved every day. I think Hamas agreed to an agreement with President Trump as recently as yesterday. But see, these agreements and these memorandums, they're struggling to stick right now, to say the least. So what we're seeing from them, the memorandums of peace, that's clearly been violated. Shots are being fired. We're back to kinetic warfare. There are reports that Ukraine hit an Iranian ship. I don't think Ukraine denied it. So it's just, this conflict seems to be here for a while. Some reports, and once again, I'm not a geopolitical reporter, some reports are that Iranian folks feel like they can last longer than we can due to our political situation where we have elections. They don't have elections. It seems like the goals may be changing, but here's just some things for us to think about right here on Main Street, right? Gas pump and voting booth. Like, how long can the average American consumer absorb these elevated gas prices? For it, it just completely dominates the election season. And gas and oil is a big part of inflation, right? What we saw when the war began, we saw really high inflation prints. And then we saw the price of oil come down during this conflict, and we saw inflation prints that were lower than that. So inflation we're seeing it with the pump, and people are feeling it, right? As prices climb, discretionary spending has to slow down because you only have a finite amount of dollars in your budget. It seems like $100 a barrel. We keep seeing it go up and down around that place as a benchmark, right? So we've seen $100, whether it be WTI, so West Texas intermediary, or we see the Brent crude oil, either way, hovering around $100. And then you got to remember, those are priced like future prices. So those are priced a little bit different, but there's swings up and down. We had Exxon report yesterday, and Exxon missed some of their numbers. Then we have a company like Chevron report yesterday, and Chevron reported blowout numbers. But investing in oil, people want to invest in oil when they saw the war start. Like, that's another thing. So I won't go on a tangent. I won't get too far off on the subject. Like, when you invest in, it's just another reason why a person should have somewhat of a diversified portfolio where you have all your areas covered. So you're not chasing oil. You just already have these oil producers inside of your portfolio. So if they do move, maybe it becomes oversized just due to the growth inside the stock position, the stock price. Like, the stock price just continues to go up. And then at that point, once it reaches a certain level, it would be prudent to trim some of those gains. Because in the long run, energy is a very fickle thing to gain money in. But in situations like this, where we see elevated oil, so you can't go in there chasing everything either. And then it seems like there was a while where we had the Monday through Friday, there was peace, and then over the weekend, they were fighting. And markets were resetting every Monday. But that seems to be passing a little bit now. They just seem to be fighting. I know we took a break or a pause a couple of days ago. People were concerned about whether or not there are enough munitions for these battles, where our stockpiles are at good levels. Once again, I'm not a military expert, but the thing about from a main street perspective, or even if from an investment perspective, if you think we need more missiles, you have to look at companies who make the missiles, who are making these missiles. What do you use in war, right? We have the drones that we're trying to find a lower cost of war. But like I said, the oil, we use oil for everything. Oil is used to transport things. Oil is used to make energy. There's just so many different ways that oil is used, and it's actually like synthetically inside things as well. So oil is inside a lot of products, petroleum, whatever you want to call it. Our supply right now, we're going into the strategic reserves, probably at a faster rate than we anticipated. I think this war is being drawn out longer than some people anticipated. When I was asked about it in February, I said this thing could last years. I don't know. Hopefully I'm wrong. But that was when they were saying it was only going to be 6 to 8 weeks, maybe, or 8 to 12 weeks. So it's definitely longer than it started out, and probably closer to a year no, it's not close to a year yet. Starting in February, so we're entering what would be the 6th month as it's beginning of August. So, but like I said, that's why you want to be in a constructed portfolio that's well balanced. You want to have exposure to defense and energy already, like in proportion to size. The equal weighted market has made such a strong return this year. And I don't mean particularly market return. I mean like a return to prevalence. People are using it again. People are investing into again. As we saw with I in the Mag 7 and tech, we saw that the concentration was so high in those companies. We saw the concentration was so high, it was almost 40% of the S&P 500, which is cap weighted versus equal weighted. And we talked about that in a video I posted earlier this week. If you want to go back and check it out, we're talking about IPOs, Apple, why Apple always wins. What 401ks, we actually went on a little history dive of 401ks and why people invest in them, why they should invest in them, why they do invest in them, how they came about with the death of the pension. But I was saying before, so we're seeing rotations inside the market back to an equal weight. That cap weight was when it was nearly 40% of your portfolio. Think, like I said, with Asia and the Kospi over there, where you have pretty much two stocks, Samsung, SanDisk, they're making up the whole entire over half of the index. And when you see those go down, you saw the drastic losses that we saw over there this week. And we saw sell-offs inside of America as well. The week finished strong, but it was choppy. It's very interesting sessions, interesting data. But like I said, we're going back to the markets and market dynamics. So at the end of the day with the markets, it was a big week for earnings. In the last week, we've had like 4 hyperscalers report last week. Well, I guess this week, but the week before we had Alphabet or Gemini report. This week we had Meta, Microsoft, Apple. So yeah, and here we're talking more about it. The thing that investors seem to be concerned about: return on investment and free cash flow. And how are we funding the AI build out, right? Are they funding this AI build out through free cash flow or through debt? How is it being funded? Those are some of the big questions that are being asked right now. That's what people want to know. And with regards to it, like I said, both, we'll just look at it. And this is all in the newsletter. So please check out the article on X, check out the newsletter over there on LinkedIn, subscribe to it. If we're not connected on LinkedIn, let's connect on LinkedIn. Check out the ABC Square. That's the company page, is where it's at on X. I don't have a personal X page, but the company has an X page and then the YouTube page. So, and this will be on the YouTube page and the Main Street Meets Wall Street podcast. This information is out there if you want to receive it. We're out there. We're putting it out there for the world to see. Like I said on the podcast, we have a lot of great people in there, and we still have more people coming up. Just finished recording one with Sarah Grillo. She brings a lot of great information. Tara Ross, we have his episode coming up, where the Bitcoin bull case is coming up. That comes out this week. Part one of that. We had the Bitcoin bear case for folks who want to hear the bear case to Bitcoin. We have war reports going since the war started, where we were doing some live sessions, and we also had some record sessions, and we just put them into hour-long sessions that you can sit back and watch and see the war kind of document in real time. So the war reports are a very cool thing. Then we also have very cool guests who come onto the podcast and break down things for us. Help Main Street Meets Wall Street. So it's usually with the guests. When we do it Tuesdays, you can catch the episode with the guests, and then Saturday, something like this. Saturday, Sunday, over the weekend, we like to release something a little bit different. It's usually just me solo breaking down information, or some things I've been quoting in the media. I don't want to go too far or digress. Another big thing, which actually I think could actually tie all into this AI play out, AI build out. And if a bubble was to happen, is the buy now, pay later craze is going on. And I say craze because it's starting to get really extended. That leverage that people are using, and people are getting into the wrong mindset with it. Stories of people who are ordering $40 worth of Chick-fil-A while living at home with their parents, splitting the payments, not because they have to, but just kind of because that's their condition. Is easier in their mind to pay it off. And if you can't pay it off at 0% interest, I get it. Cash is tough, affordability is high. But if you don't, these buy now, pay later loans end up becoming pretty much like credit cards, where you have high interest rates that you have to pay it back, and they could impact your credit in a negative way. Because some of these do report when you make payments on time, but I guarantee you, when you aren't making the payments, you're going to report them. So you have to look out for the on-time payments, and then the payments that you don't make on time. So buy now, pay later. Just be careful with it. Watch out. Be careful if you're out there doing it. I always think about like layaway, but the thing with layaway is you didn't get the product in layaway until you had actually paid for the product. So that's a huge difference from what we're seeing right now with buy now, pay later. Buy now, pay later, you're literally buying it, getting it, and paying later. So if we see that, we see a consumer continue to struggle there, that could be another sign, something that's coming with busting a bubble or a bust economically. And people blaming on AI, whatever sector may bring to them, because AI has been the big buzzword. But like we said, Meta, Microsoft, they both reported different results, right? Meta reported they were going to spend more cash, but they didn't necessarily have a clear path. I think Zuckerberg he's been penalized before for some of his spending, excessive spending. It seems like he chases dreams sometimes, but I guess that's how he got to be where he was, chasing dreams and creating things that other people couldn't see. Microsoft had been underperforming all year, but they gave a great quarter. They gave great guidance. They have a great plan for their free cash flow, and they said they're going to reinvest too, but we saw their stock have, I think, its best day in like 20 some odd years. One of the best days in the index in a long time as well for the overall stock index, just by a market gain and market share. So, but then we go back with Google the week before, and Google increased their capital expenditures for the AI build out and managed the liquidity and equity issues. I think Alphabet was initially down, but it's come back since then. So it's not like Meta is still being punished. Apple reported Apple stock was down initially, but Apple had been one of the best performing stocks in the of the hyperscalers for sure. It was the winner. It had overtaken NVIDIA again as the world's most valuable company by market cap, as we saw semiconductors continue to get punished as the rotation happens in this market. Once again, that concentration risk that I was talking about. But we see semiconductors, they got destroyed. And like if you just look at the Philadelphia SOX or the SMH, two semiconductor indexes versus like the IGV, that's a software index that covers software companies, you saw that flipping all of them. And then Oracle. Oracle, oh my goodness. Oracle is the poster child for AI spending and wave spend and whether or not this is going to be one of the AI winners or losers, or how to go about AI. First in, first out with Oracle, maybe because they were one of the first ones to come out and not say how much debt they were going to issue, but issue out a lot of debt after their blowout report, because they did pretty much right after they had a blowout report last year. Like we said, we saw the stock skyrocket up over $300. And now the stock's got hammered back down like the 120s, and the stock stock has some momentum. That's a low level. But it just illustrates how sensitive Wall Street really is when it comes to capital expenditure spending. But Larry Ellison has a track record as well of leverage and people thinking he's down and out and somehow pulling it off. You don't get to be one of the richest people in the world by not taking risks, almost losing it, and making it back. Look at pretty much all the richest people in the world. They've had some move or some sort like that. And not to say that wealth is a measure of anything other than dollars, right? Dollars are not wealth. Wealth is different for every person, but you need a certain dollar amount to function in the world, to live in the world, to meet Maslow's hierarchy, where you're not worried about sleeping or shelter or feeding yourself or your family, right? Then you start thinking about wealth and things above and beyond that. But like we were saying, the Cosby, the concentration and the leverage, you want to see the real world warning shot regarding concentration risk and systematic leverage. Like I said, look at South Korea. That Cosby index was so heavily concentrated, right, that they had to call in the foreign minister. That dude was about to lose his job, and decrease some of the leverage. They took some of the leverage that you can have over there anymore. You can't be 3, 4, 5 times leverage like they were before. I think maybe you can have one leverage now. But leverage, like I said, can magnify your gains, but it can be terrible on the way down. It will destroy your capital faster than not at a casino. Position size is just as critical as risk management, like for real. You have to, because if you're over, position size is a part of risk management. So if you're over extending the position size, like we were talking about, like say we're diversified in our portfolio, we have the oil companies like Chevron and Exxon, and then they grow. Now this position size has grown. Or even right here with the Cosby, maybe you got in the Micron, which isn't a Cosby, but just like the memory trade is also tied in this. We saw the memory trade go away, the DRAM trade. You have one of those companies and they're getting just killed or punished, and you're leveraged, you're going to see it even worse. So be careful with leverage, margins, shorting stocks. Just, if you don't understand all these things, trees don't grow to the sky. Just figure out your risk tolerance and invest based on it. Don't chase the next best thing. Know your investment thesis. There are a few reasons why you should change it. Few things happening in the world that'll make you change it. You have to know your investment thesis and know why. Speaking of investment thesis and knowing why, I was speaking with David Snyder, the man who predicted the .com bubble, CNBC mystery broker to Michael Santoli. We were speaking about he sees the AI. He sees the AI as a bubble. This was a few months ago. He was telling me with the AI bubble, I was like, what are signs people can look for a bubble in the AI? And he said, well, one of the things people can look for will be SpaceX, OpenAI, Anthropic all coming out and going public. Because once they all come out and go public, that'll be a lot of capital. He said pretty much most of the capital is exhausted. One of the things, one of the signals that you look for. So we're not going to get too deep into whether it's a bubble or not, but we are going to talk about these IPOs. Couple things to note with IPOs, like lately, vast majority of IPOs are down like 50%, 12 months after their listing date, right? So think about SpaceX, some of the gains we saw in it, 220 post IPO, but 135. So I guess technically you could see it hit 65. I don't know. The 60 levels, or it could surge back to 200. SpaceX is a little bit different when it comes to that. SpaceX has the cult following. That SpaceX, the cult following, so like from Tesla, some of the original retail investors, like GameStop, meme stop type things, were like Tesla investors before GameStop and meme stops. So, and if you live on this planet, you know that there are a few people as diverse, and not even from, well, maybe from his actions, but we're not getting into his actions, but that people have such diametric views of than Elon Musk. Some people will continue to buy this stock because it's Elon Musk. Some people will never buy this stock because it's Elon Musk. That's for each his own on that one, Main Street, but you'd be, you would have a lot smaller pool of stocks to choose from if you invested based off the person that runs the company. I'll just leave it at that. But another thing that came out with SpaceX, people were expecting SpaceX to buy Tesla, which could still happen. But SpaceX has the government contracts, and the SpaceX was to buy Tesla. And this was reported, or a leak. Elon Musk actually denied it, that Tesla would be divesting from his China interests in some sort of separation, or some sort of pulling apart of the company. Oh, that word's leaving my brain right now. But like, well, Honeywell did it, GE Verona did it. Where you break it down for the sum of the parts. But they could do something like that and then leave the interest in China, and that way you wouldn't have to worry about the security interest. But Elon Musk said that had not ever been reported or ever even talked about, and that was faulty reporting. But we'll see. I think China has a different type of set of rules if you want to leave China, or maybe you want to stay in China. Either way, I think China has a little more control on their companies than America does for now, anyway. But like we said, we got OpenAI and Anthropic preparing for their public listings over the next 12 months, and people really talking about the circular investments again. It's part of the reason why we saw companies like NVIDIA take a big hit here recently. We saw tech giants that are investing in NVIDIA actually made another investment to, I think it was Anthropic, earlier this week. I discussed that deeper in one of my videos from earlier this week. But yes, we see that right there. And people are wondering, where exactly is this money going to come from? Where's this money? How's it getting back to them for this cloud computing? How much is it going to cost? And then you have reports coming from China, where the Chinese companies are building these products out and building out these same type of things for for fewer costs, less tokens, cheaper type tokens. Because now it's become about tokens and tokenization. Cost of tokens, cost per token, what kind of quality are you going to get from your work for a token? When they first came out, I realized it was about tokens. People were buying tokens and token maxing, and then I think corporations just say, oh, that's really expensive. We need to pull back here and figure out a more efficient way. And then, like I said, you see the China companies coming out over there with models that are just cheaper models. I think we saw, maybe it was Alibaba giving some NVIDIA chips to some companies in China, smoking some over there to some companies in China, and they just build off of those NVIDIA chips to grow their AI companies. So like go in there, clone them, and increase their AI capacity. Obviously at a cheaper price. I mean, if you're getting it free, it's pretty much a lot cheaper than what they're paying. So you have that, the circle investment. We just saw people a lot of concern with AI and the AI build out. And then also with the way AI is financed, and we saw the leverage go into effect from the private investor who Ken Griffin and the Citadel came in to quote unquote save. His fund was up to like 45 billion, but it was so highly levered. I think they probably sold it for parts for like 10 billion, and I say that like that's a little bit of money. And who knows what Citadel's going to do with it. But I'm sure Ken Griffin has a plan for it to make multiples on that investment versus what they paid for it. But it was highly levered into like memory stocks and into the Kospi over there. And when it worked, it worked. But when it stopped working, Like, these are rotations and these are realities of the market. Like, when it stopped working and when it has that much momentum, it's just whoosh, you can be hit really hard. People's life savings or trillions of dollars just wiped out. Speaking of trillions of dollars been wiped out, like an example. So when SpaceX first came out, it initially made Elon Musk a trillionaire. Within like the first week, maybe like within the first weekend, they bought a company for like several hundred billion. The company they bought actually was pretty much the same amount of market cap that they had gained in stock price over that time, which is interesting in itself, before the stock went back down. But they're taking some of that money and were buying other things, growing that company. Like I said, this goes back to circle investments maybe. But here we are, and we're at the equal weight, like how the markets are moving. Capital is moving away from that hyper concentration back to equal weight indexes, one equal weight index. And this is a stock recommendation. None of these things we've said, just to repeat, are stock recommendations, but they're just stocks that you can look at. So capital is moving away from the hyper concentration. Small caps have been leading for like over a year. I don't think people realize that. Small caps have been running. If we do get rate hikes, that could definitely do something to the small cap rotation that we've seen, because higher rates will impact smaller businesses more than they will impact larger business. We recently saw 50% tariffs implemented on Canada. So how will these be passed through down to corporations, to consumers? And then, we got the debt wall going on. So we got the metric flash. When it signs $40 trillion. And then that serviceable debt's like 160 trillion. So a lot of debt that we have to service right now, which ties back into the interest rate conversation that people are having. Will we have lower interest rates, which will make it easier to service the debt? That's why people ask, will we have lower interest rates as well? Make it easier for people to buy homes. And these are all in theory, with the rate cuts, right? Because the truth is the Fed cut rates several times under Jerome Powell, and the stock market went up. So you had several rate cuts, and then you had the stock market go up. So where is the stock market going? I think you're going to see more bumps in the stock market and volatility until we reach the election. Then hopefully we have some clean, clear elections that can carry us in and through the stock market. Once the stock market has clarity, I expect it to go up. But we'll see what happens in between now and then. A lot of volatility, a lot of things are happening. Like I said, we still have a war happening right now. Tariffs are coming back. How are these tariffs implemented and impacting the world? How is inflation hitting consumers? Which one of these big companies that everyone's banking to win is not going to win? We'll see. Or who's going to zero? Someone's going to zero. We haven't even talked about crypto. Crypto's a thing that seems to be coming back as well. But just a lot going on. And then cybersecurity, right? So we're talking about a little bit about cybersecurity. Over the last few weeks, we've seen Anthropic's model, I think it was Anthropic's model, hack into other places, hack into other companies, hack into other models. Hugging Face is one that hacked in, and it's doing this outside of the parameters that it's being trained to do, right? There you go. Claude Anthropic, right? Yeah, so Hugging Face goes in there, and then I think as recently as yesterday, they announced like 3 more interfaces that were breached. These AI models are supposed to be in sandboxes, but they're getting outside the sandboxes. The first one it was supposed to be a test, but the AI model decided that the test was too hard, or maybe it just decided there was an easier way by going into, instead of solving the answers for the test, just go to the source for the test. So one thing to think about with that is, back in the 80s, 90s, Microsoft really dominated the world because it had enterprise like software that people could put on the computer, and it was in everyone's operating system. Pretty much you had to have Windows for a while, a monopoly. I believe they got sued for it. If I remember correctly, Microsoft got sued for that. Could cybersecurity be the next layer like that? And there's a company that's leading like CrowdStrike. Well, is that going to be like the next Microsoft? Once again, not investment advice, not a single stock recommendation, but is CrowdStrike or Zscaler or Palo Alto, or is that a company that's going to be like Microsoft? Now we're seeing the increased need for cybersecurity. especially with large amounts of capital. Not to mention a company like Palantir. Palantir is really deep with government contracts, and they're so layered inside of defense and cybersecurity. Maybe they could be a winner inside of this movement to cybersecurity. But cybersecurity stocks also, they go strong with software. I don't know if people remember back in February where we had that SaaS apocalypse, and it just kind of became a rotating SaaS apocalypse. Cybersecurity, financials, every industry. I think the trash industry got disrupted 1 week because of something with um, AI. We saw all birds go from a shoe company to an AI company. So just rotating AI bubble popping around, right? And that's another thing. That was another question. Like I said, people asked if there was a bubble with AI. And I would say, I actually did say, so this is how I describe it. I don't think it's a bubble per se. If it is, we're all in and we all know it. But it's like a building. I got even deeper into my thought about it from where I answered the council. So it's like a building. It's like when you're building a building as well. So you gotta put up like the framing, and I don't build buildings, right? You gotta put the framing on the inside or whatever you're going to do, but you gotta put up the four big walls outside, however big the building is, right? You gotta have four walls. So like the AI, in my opinion, is like so far as the four big walls. This is a huge building. Then they're going to break off into different sections, like rooms inside the building, and that's what's happening inside AI. So like different rooms are popping and different rooms are bubbling. That pressure's going, but it's all the same. It's all in the same house. Hopefully, the whole house doesn't catch on fire at one time. So maybe that's the difference of what we're seeing right now. So, is it a bubble? If it is, like we're in it and we know it. It's irrational exuberance all over again, perhaps. Is this time different? They rhyme, but they're never really different, right? But they're always different. They're different calluses, I guess you should say, right? Whether it be the 87 crash from that stock market just running hot, whether it be, the 99.com bubble where that stock market went hot from everyone thinking that the internet was going to change the world, which it did. I mean, if it was for internet, we wouldn't be sitting here doing this right now and having the AI conversation, to the housing bubble, which the world knew about. Well, not the world, but people definitely knew they were putting together trash products and junk and selling them, and they were essentially betting against the products that they were putting out. I digress. That really ruined a lot of stuff for people of this generation right now. There are a lot of people who were children in '08 and saw their parents lose their houses and have to move or lose their jobs or get divorced. It's just a lot of things that came from a situation that could have been avoided. You just can't give subprime mortgages to everyone. People who can't afford it. And then, anyway, we have to know where we're at inside this bubble and be positioned properly. Okay. We talked about concentration risk. I spoke about concentration risk inside this conversation as well. Like inside your portfolio, anything you're investing in, you can't have, a simple way of saying is you don't have all your eggs in one basket. When you think about building our portfolio, right? And this isn't once again, not a stock recommendation or a plug for Apple or any individual stock, but Apple seems to win, right? We talk about why Apple wins in the long run. There's an article right there in the video right here. And once again, this is all in the newsletter that I wrote for LinkedIn. It's a long newsletter, but this is the article on X right here that we're reviewing. It's just reviewing the markets in the month. But Apple wins in the long run. Not a recommendation for Apple, for or against Apple, but why does Apple win in the long run? Like, just think about it. Apple sent me a message the other day, said they were increasing my Apple Music price, and I didn't cancel my Apple Music or my Apple monthly subscription. It only increased about $1, right? So we're in here and we're sitting in a water bowl, or we're going to jump out. I don't know. We'll see. Everyone else was spending so much money on CapEx, capital expenditures, right? Last year. And Apple stock was being destroyed for it. Being destroyed for the capital expenditure because they weren't spending money, right? I said to other people, I said it's a good bit, like the early bird gets the worm, but the second mouse gets the cheese, right? And Apple may be the second, third, fourth mouse, right? And I got a video on this from earlier this week where I go deeper into Apple and all of these things as well as why they win in the long run. And they just reported and their stock actually went down. So maybe that's an opportunity to look at a stock like Apple And it doesn't just have to be Apple, but we are going to talk about Apple right now, like Apple specific. But people were being rewarded for spending money last year. And now we see with stock, people are being punished for spending too much money if they don't have a clear plan of where that money is going. So they were burning through their cash on data centers and free cash flow. And Apple has a fortress of a balance sheet. Apple has more cash than a lot of countries in the world. Like Apple would be one of the larger economies in the world just based on how much cash that corporation has. Apple has so many levers and so many things that they can pull, so many things that they have invested in, Apple phones, Apple devices, Apple subscription, Apple TV, just so many things with Apple. And then just to bring in with Apple, like half the world's already built in as Apple users. And people usually don't switch. So then they have the partnership with Google. And this is another thing. People hear these things. This is all on the media right now, like the mainstream media. There's Apple stuff. Go get Apple, go get Apple, go get Apple. But other people have been talking about it. I was talking about this Apple for over a year. I've been talking about this for Apple for like well over a year. Pretty much anytime anyone asks me about Apple, I'm like, yeah, it's probably not a bad time to invest in Apple. Once again, not a stock recommendation, but reasons why, and people say Apple's price high, it's priced over the market multiple, like 35, 37, 38. Well, Apple's a premium. It's the most valuable company in the world by market cap. So you're probably about to pay a premium for that. You pay a premium for premium products, but you also should expect a premium return, which Apple had not been delivering for a while. A premium return, like we said, we saw the stock trading sideways and trading down, but now it's been one of the better performers this year until recently when they report. And I was asked a question on South Korean TV, K-Pro TV, earlier this year, asked about, and Apple or Alphabet. And like I said at the time, it's hard to go wrong with either one of them, but I do like Apple. And this was a time when Alphabet and Apple had just went into their strategic partnership. Apple is paying Alphabet a subscription fee for them to use it. But at the end of the day, you got to realize that it all comes back to Apple, right? People always come back to Apple. All these tools, all these platforms, whatever OpenAI is building, it's going to be on Apple. All these AI interfaces, the Uber app, whatever you're thinking about, it's going to be on your iPhone. At the end of the day, people just want to tap that app and get to it. So the App Store is so powerful. And Apple's now a rosy, right? Like I said, you have the multiple that's above the market level. So there are definitely opportunities with companies with lower multiples, although the multiple probably came down some with the price depreciating this week from the stock selling off a little bit. But it had been on the run, a great run. One thing to look at is the leadership transition Apple has coming in. Tim Cook is taking his final earnings call. That was Sunday, or I'm sorry, that was Wednesday. So the next one will be from John Turnus, who comes in September. Watch out for his expansion plan. We'll see. Like I said, Apple has already built in a lot of user base. Apple went and spent a lot of money on AI. Apple has kind of said a couple of things that they want to kind of do now with AI, maybe playing some stuff with Siri. And Apple's hardware failures have been of note here lately, right? I think the 17 got a better response than most people expected, and now they're launching 18. So perhaps with those product launches of the hardware, we can see some appreciation as well, like see some growth towards earnings in Apple. But you also have to remember Apple, and people were calling for Apple to acquire something last year. Why is Apple not buying this? Why is Apple not buying that? Apple hasn't really been making a lot of acquisitions. They have had a lot of brain drain, so a lot of people leaving from the top. But Apple is built to last. People thought that Apple was going to be, dead in the water when Steve Jobs passed away and Tim Cook took over because you have Steve Jobs, who was a visionary, then you had Tim Cook, who was a supply chain guy. Turns out you need a supply chain guy for COVID, right? When the whole world shut down, you needed someone who could navigate supply chains. That's one of the reasons we saw Apple continue to not just survive, but thrive during that time. They had stock split. I remember stock was down like $100 when they did that split. So Apple's a strong play. Once again, not stock recommendation, but find a stock if you are looking for like a stock, some type of stock. Find a stock like that, right? So that's what I mean by like find an anchor stock. Find some stocks that you can grow on. And if you never invested, you probably should base it on some type of index or ETF that mirrors the market, right? As a big part of your core position, right? Think about like you have a jar You got rock, big rock that is most important. And you have little pebbles. Then you have sand. Pebbles are kind of important. The sand is just like frivolous stuff, right? You want to fill your, but all of it makes 100% of your portfolio. I don't want to say frivolous. It's smaller, right? You got to figure out how to fill that jar up, which the lid's going to be smaller a little bit than the rest. It's going to be kind of shaped like that. So you got to figure out how to fill that whole jar up, right? If you just put the big part in, you just put the rock in there first, and then you build around it, are you going to be able to get everything in there? So maybe you want to build your base with a little bit of that sand, right? We can say that the sand's like small caps, right? So you have a little bit of that sand in there, then you put the rock in there. That's taking up a lot, maybe some large cap allocation. Then you put the pebbles around it, the mid cap section. Then you got the whole portfolio in there. You got everything inside of the rock. And it's not over proportionate. But like I said, if you're doing it with like market indexes, something that's just mirroring the market, that should take care of that for you as far as like diversification. Make sure that you have everything inside your portfolio. Because once again, with Main Street meets Wall Street and the conversation we have, trying to give you actionable steps that you can take and things that you can do, ways that you can grow, like things you can do today, tomorrow, like things that you don't have to wait and do, things that don't seem so downtrodden for people, right? And then, like I said, so back to equities, capture the headlines, but bond market's big brother, right? When Walsh was speaking, Treasury yields pushed higher. The bond market looked at the Fed and simply said, man, you can say whatever you want. You keep talking about that 2% target, which you hadn't hit in 5 years or longer. And, inflation's the closest it's been has been in the threes, right? Low threes, maybe it touched some high twos. But Kevin Walsh also said his inflation numbers, he's looking to the left of the decimal, so he wants that too. Then he said, so this is more of the Walsh talk that we're getting, that he is concerned that when he says 2, I think he means 2.0 for an inflation target. Different from the first speech versus the second speech he gave. But we had the huge stimulus injections, pretty much across multiple presidential administrations for decades, right? Like, let's be clear on all that. It's not just Biden and Trump who did that. And now people are going to turn to Jackson Hole in August just to see, which isn't, a quote unquote Fed meeting, but he's definitely going to come out and say something. As Walsh said that he would speak for the Fed, committed to give speeches for the rest of this year. He will reevaluate after that. So he'll speak in Jackson Hole. He'll speak at the September meeting. I think they have maybe 2 more meetings after the September meeting. So he'll speak for those. But the market should adjust to like Kevin Walsh's style right now. That what Kevin Walsh is saying is not, he wants the market to take care of it. The market's going to make the Fed do something. They're not just going to sit here and keep letting Kevin Walsh make the market take care of it. So it'll be interesting to see. But you got to maintain proper position. You got to schedule your money dates, folks. And you got to be in this for the long term. Don't let the short-term noise and short-term signals distract you from what you're doing, from where you're trying to get to in life. From the goals that you have, from the economic principles that you've based on your plan, unless any of that's changed, stay in there. If anything, maybe you need to double down when turmoil comes in the markets. Because guess what? Every 5 years or so, the market's going to get hit. And you're going to lose a decent amount that you hold. Considering if you've been inside this market the whole time, you've just been watching it go up, it's going to feel like a real big amount. But what you have to do, and this is where financial professionals or someone else can help you generally, because it's hard for us to have that mindset alone, is you have to remember why you're invested. And if you stay invested, history's shown us, and I can't speak for the future, but history has shown us that if you stay invested through these market downturns, and when market downturns happen, you'll be rewarded markedly on the other side, like multiple. We've seen some generational wealth. Like I said, I walked into the room and I told, I said, Marcus Sturman Sr., go down here from the Wall Street South, Charlotte, North Carolina. And I was in Atlanta, and the Atlanta folks looked at me like I was crazy. But y'all gotta watch out for Charlotte. Like I said, we got $4 trillion in assets. We got BA here. Truist is here. Wells Fargo has a big thing here. Financial heavyweights like Truist came here when they were in Winston-Salem. Wells Fargo's got their most employees here. And then pretty much every major center is here. Even JP Morgan just came down here. JP Morgan Chase came down here. I think it was the end of last year. Saw Jamie Dimon doing an interview from an office. This is in Charlotte. A lot of financial workforce. I know a lot of people who work in the financial workforce here in Charlotte. Charlotte's one of the biggest and largest growing cities. And our mega banks control a lot of our local deposits. So, like I said, Charlotte is just, with the Wall Street South. Sorry. I mean, it's not a bad thing. And a lot of people are like, oh, it's what it is. Like, Wall Street is South represent. That's pretty much the newsletter that we went over. Like I said, if you want to read this, it's a 10 to 15 minute read. But it's definitely worth it. If you want to go more in depth on some of the things that we were talking about. Some other things that, just so you're not reading the letter the whole time, just take a few minutes and wrap this up real quick, We did get a GDP report. It came back a little bit lower than expected. So we're seeing GDP maybe contract. We'll see how that works out. But that was, we had the war in Q2. So Q2, AI valuation reality versus the actual premium that we're seeing in this market. Don't let AI and AI build out have you over concentrated inside your portfolio right now. Because we've seen that whipsaw goes both ways. Then we talked about estates, family money dates. Make sure we are planning these money dates, that you're sitting down with your loved one, you're preserving your wealth, you're doing the things you need to do. Y'all are having these conversations. Make sure they're structured, make sure they're really happening. Some things you can do, like I said, actionable steps. Make sure you have beneficiaries designated on your accounts. If you remarried or something to that effect, make sure you have proper updated beneficiaries, because I don't think very many people are going to be happy if they pass away and their ex-spouse, while they have a current spouse, gets the stuff. So make sure you have those updated. Make sure you have rebalancing set up the way it is. Make sure your generational transfer strategies, they align with tax laws. Like, if you want to set up a trust, you probably should spend some money and get a trust attorney to help you set that thing up the proper way. And then just remember, the Malcolm Jamal Warner situation, just because you have a prenup or a trust, or whatever you may have, things can change and people can contest them, and we'll see how the law plays out for it. We say will oil hit $100? That's going to be a big level. If oil hits $100, and then maybe we'll see interest rates. And this isn't necessarily saying that they'll be tied together, but they could be. Oil, $100, interest rates at 5% for the 10-year. The 10-year is like 4.7 right now, but we see the 10-year is like 5%. People are conditioned in their mind to go more risk off because they feel like 5% risk-free is a great return. I would say, is it really 5% risk-free though? First of all, everyone could default. The U.S. government probably won't. They never have not paid a bill. But if it's 5% return, and then you are, let's say inflation is 3.5%, you're really only getting 1.5% on that cash back in real return, which is another reason why equities generally outperform in the long run, because you're generally going to get 7 to 10% historically on equities. Like, if you look back over the last 100 years, let's say when inflation, there's a reason why they say 2% is a target. Let's say it's potentially 2%. That's a larger real return than if your cash was getting 4%. So we'll see how it goes. We'll see how portfolios are hedging against it. We'll see if gold comes back into play, if metals come back into play for more than just the AI build out. So we'll see if the actual precious metals become a thing. So that'll also be a sign that people are worried about money and the stock market. We've seen the dollar firm up here, just continue to go up. So that would also be another thing that could be impacted by interest rates. And we're seeing maybe as the dollar firms up, people are saying, yeah, we think the rates are going to go higher for the cost of capital. CapEx, cybersecurity, right? So tech earnings, you got to look out for CapEx. We need to see where this money's going, where they're spending these dollars, where they're actually going right now. This IPO window is going to be key. We've seen several of the big ones push their announced date back to properly the beginning of 2027 or some point within the next year, whereas people would have thought that they probably all three were going to come this year. Watch the earnings. with the cybersecurity, right? Because if they continue to spend, it's eventually going to compress your margins. I mean, you can only spend so much with the earnings before you take it away and you're in bad shape, like really bad shape. And that could just happen overnight. So watch how these firms are financing their debt, how this debt's being financed and where the money's coming from. And what's the ROI is, return on investment. And like I said, Charlotte, man, where the Wall Street is South. Like people can hate, people can say whatever they want, but Charlotte's the Wall Street of the South. I want to take a minute and just thank people. You know, I want to thank y'all for the people who tune in, the people who read the newsletter, people who listen to the podcast, the people who support the channel, people who pop in and say like, share, subscribe. Like, appreciate that stuff. I want to show you the newsletter. Like I said, that was the LinkedIn version that I just showed you. I mean, that was the X version. Here's the LinkedIn version. Like I said, we're sitting 1,400 subscribers, over 1,400 subscribers. I love that picture of Warsh and Powell. And then it's the latest edition right here. So it just came out. And it's a 15-minute or so read. But it also has videos in there to, you know, help you dive deeper into some of the concepts that we're talking about. So video there with Mr. George Hoppenfuller. Sorry to go so fast. The debt, we're talking about the debt in one of the videos. It's a tranche of wealth right here, a wealth of knowledge. Ashley and I talking about couples and money, reason money and couples. It was that was a great conversation. 2 parts to it, actually. Then actually one with Mr. Derek Kinney. Derek has a great conversation, ways to think about the economy and volatility. If you're an advisor, how to talk to your clients during these times, or how to grow your business, or whether you're just dealing with your own personal financial economy, which all of us are, right? We all have our own personal CEOs or personal financial economies that we're dealing with and that we're trying to grow. So his is great for that. And then, oh yeah, great conversation with Ryan from over at Benzinga. Great conversation. He hosts the Pre-Market Playbook show. We just talked a lot about noise versus signal. Ryan's a Bears fan. For those who don't know, AI made that shirt logo. I don't know why he made it like that. Ryan's a Bears fan. He had on Bears shirt. But you should check it out. It's a great conversation and just some of the things they're doing over there at Benzinga. It's really, really cool stuff. I actually have a Benzinga link that I can put into the leave in the show notes for folks so you can check it out. Use my link and I may be compensated, but it won't cost you anything extra. Speaking of Benzinga, there's another conversation I had with Benzinga with Brad Olson, the chief content officer over there at Benzinga. So that was a great conversation as well. And maybe part 2 with Brad. And then we talk about the cybersecurity. And then that's the video. So I was talking about a video I did earlier where we were talking about Apple and breaking out some of those companies. That's it right there. So, and also in the backside of that video, I take like the last 30 minutes to talk about just 401ks, history of 401ks, like how they were written out until like 1978. They were pretty much a loophole that someone discovered in the early 80s. Like they were only for high-ranking executives. It was kind of for executive compensation is why they came about with the 401ks. And then people realized that there was an evolution and how 401ks actually meant, you know, a good reason to push some of the honest back onto the individual. So we talk about defined benefit plan versus defined contribution plan in that video as well. So for that, just real quick, high level, let's say defined benefit plan. You're going to get X amount as long as you're going to get this benefit. Think of pension, you'll get an annuitized amount of money for the rest of your life as long as you put in this amount and follow these rules. So that's defined benefit. Whereas with defined contribution, where it's just said, if you put this amount of money into this plan, you may get this return. It's not a guaranteed benefit. It's up to you that you do it. For one, that you put the money in there, and two, you pick the investments in. So that's defined contribution, like you're defining that you contribute. It, once again, just pushes the onus back to the individual. And then right here, we have a deep dive on SpaceX IPO. That video actually has several interviews from SpaceX's, like straight from their mouth, the CEO. So yeah, Musk is talking to the CFO, and they're talking about their vision. It goes through their history. So it's a good conversation right there. And then for anyone, like I said, this is the LinkedIn version. So anyone who wants to roll on LinkedIn, like how to make a good post, what people are looking for on LinkedIn, why LinkedIn is great, what LinkedIn is good for. That conversation with John Tomasi is right there on the newsletter as well. So like I said, the LinkedIn newsletter is a lot, this one. And then it also has the podcast that you can check out, link to the podcast and link to the YouTube channel. So yeah, Main Street, that's a lot. Showing you a lot here, talked about a lot. We're about to sign off here. We're going for about an hour now. I just want a little over an hour. I just want the people hit the like button, subscribe, share this with someone. For anyone who has yet to experience Main Street Meets Wall Street, or anyone who has not heard the podcast, not seen the channel, check it out. Come through. This football season, so we got the Raiders, Panthers. It's that time of year. Fantasy football is kicking off. But Main Street Heart, Wall Street Smarts. Like I said, check out the podcast. We have some really good people coming on. This one was live. We're refurbished. You'll be able to catch it later on. Main Street Heart meets Wall Street Smarts. Hit that like button, subscribe, share this. Thanks, Main Street.
We had 3 years of greater returns, Marcus. It doesn't, I think it's healthy. I think disagreement about markets is healthy. I think that being skeptical about the future and trying to figure it out so that everybody understands it is healthy. I know it's difficult to have this uncertainty, but ultimately I think it leads us to a better place. I would much rather do this than say, I think the market's going up, and you say, I think the market's going up. We all just talk about an unrealistic expectation that leads us to inform people in ways that they're going to be biased. I don't want to be biased, positive, negative. I want to be biased in the present as things are. And I hope that what we've done today is have a good balanced discussion.
You can choose to burn brain cells and complain about things you can't control, or you can say, based on these economic trends and how they affect my personal economy, how can I benefit from them? There's always a way to make money when other people are worried about possibly losing.
Welcome back to the Main Street Meets Wall Street podcast. I'm your host, Marcus Sturtevant Sr. Every week, we perform the audit. We look at the data coming out of the Federal Reserve, the macro trends moving the S&P 500, small business owners' challenges, and we ask the only question that matters. How does this impact your ledger? We see the headlines every day: inflation, interest rate shifts, and consumer uncertainty. But the truth is, the natural economy picture is often just noise for the entrepreneur who doesn't have a strategy to capture the value. Today, we're moving beyond that noise. I'm joined by Derek Kinney, the voice behind the Good Money Revolution and a regular authority on Fox Business. We aren't just talking about money. We're talking about institutionalizing your purpose. We're going to break down how to distinguish between economic volatility and opportunity, and why the Main Street agenda is the only operating system that will allow you to survive and thrive in the 2026 more economy. Derek, welcome to the show. To get us started, when you look at the disconnect between the headline data we see on the news and the reality of small business owners managing their own cash flow, what's the biggest noise they need to filter out today?
Marcus, first of all, thanks for having me. I've been excited to be on your show, and I'm excited about this conversation. What people need to filter out is what actually matters to me in my life. I like to say there's the economy, and then there's people's personal economy. And ultimately, people's personal economy is all that matters. We hear about inflation and job loss numbers and the war in Iraq and gas prices and all these things. But ultimately, can I still retire? Can I still go out with friends on Friday night? Can I pay for my kids' soccer lessons? All the things that matter are in people's personal economy. And so what I tell people is, as an advisor, as an entrepreneur, you want to not just think about what the news is, but you want to be a news interpreter in terms of what does this news mean to your exact clients. So when I was an advisor, I sold my business about 5 years ago. People would come in the office, Derek, I see employment's high, inflation's high. What does this mean? They'd get into a panic, and then we'd boil it down. Well, what does this actually mean to your 401k? Or to your goals for retirement, or to your ability to buy that business? And actually, it was very little, because those were things out of their control. But when we realized, okay, here's the things you can control of making more money, saving more money, setting clear goals on what you want, then they became empowered that even in the midst of all this uncertainty, focusing on their personal economy gave them certainty and, more importantly, simplicity.
Great explanation. Just to even dig a little bit deeper into that. So what were some of the specific questions they were asking you when they were coming?
Well, first of all, Derek, what does inflation mean? What do the unemployment numbers mean? What does it mean when our country is at war with somebody else and gas prices go up? How does all this work? Because people want to know, how does it affect my money? But there's one radio station that everybody listens to, and it's UIIFM, which stands for What's in It for Me. Ultimately, it's our favorite station. We listen to it 24/7. And so what I would tell people is, listen, if you're complaining about gas prices, what about if you were pumping gas and you owned some of the companies that invested in gas? Well, now you might be cussing the gas price, but you're cheering the stock price. So there's a way to counteract that. And so I would tell people, and they're like, oh my gosh, I hadn't even thought about that. And so what we look at is, you can choose to burn brain cells and complain about things you can't control, or you can say, based on these economic trends and how they affect my personal economy, how can I benefit from them? But there's always a way to make money when other people are worried about possibly losing money. And so that's what I would tell people is, look, if we know the market's going to be volatile, then let's shift our strategy over here. That way, even in the midst of all the worry and all the uncertainty, people feel like they have a plan. And that's what I would say the key word is. There's a lot of 4-letter words out there, Marcus, but the best one is PLAN. When people feel like they have a plan, even in the midst of all the uncertainty, it reduces their worry. It dramatically reduces their anxiety and makes them feel like they're making progress, even in areas that they can't control.
Yeah, that's a great explanation. I think what folks don't realize is that radio station you're talking about, WIFM, that's larger than what people consume the most now, YouTube and Disney.
That's right.
That's the largest channel in the world. It's not just on radio. It's serious. It's everything, right? That's really where people do have to think, like, your personal balance sheet. And I love how you mentioned the fact that if you're at the gas pump and you're like, I'm at this, and all right, so everyone already knows we're not making any stock recommendations. We're just talking because you have to get into a personal relationship with someone to make a stock recommendation. But the gas station down the street from me has Exxon. So if I'm pumping Exxon gas, man, do I own Exxon stock? I get Amazon Prime delivered to my house so often. Even if you don't understand stocks or valuations, if you're getting a bunch of Amazon, maybe you should look at buying some Amazon stock, like owning what you're investing in. We're going to get back to that deep stuff a little bit more. I love do you want to expand a little bit more on that?
Well, it's funny. As you said that, I was just thinking about a stock. I always, when I work with my clients, I always like to tell a story about their investments. For most people like you and I, we love managing money. We love investing money, making money. But a lot of people, shockingly, don't care. And so what I would do is I would tell people a story about their investments to make them more interested in the process. And so I'm not recommending this, but this was a great example. It paid a really good dividend. There was a preferred stock back in the day called Grand Metropolitan. back then it paid like a 9% dividend. I'm not recommending it, but I'm just saying back in the day it worked really well. And what was cool was what it invested in. So it invested in Haagen-Dazs ice cream and Smirnoff vodka among two of its holdings. And I would tell people this is the classic investment where on days where the stock market's going down, you're going to like that Smirnoff vodka. On days when it's going up, you're going to love that Haagen-Dazs ice cream to celebrate. And it made it personal. People like, oh, Derek, how's that Haagen-Dazs Smirnoff vodka investment doing? And so when people can name the investment with something fun about it, now you brought them into something that they care about. But the key is so many advisors bury their head in the sand when there's bad news going on. And what I find is when you can predict the bad news, doesn't mean you're going to say exactly the date, but you just want to have a conversation around, let's be proactive. And if the time comes where the U.S. is at war with somebody or we see higher inflation, a lot of volatility, here's the game plan of what we will do. So when people know that and hear you say that, you become viewed as this proactive, empathetic, highly caring financial advisor that has the four-letter word PLAN, plan, that people want. You don't have to know when they're going to happen or if it's going to happen, but just the fact that you're talking about, here's what worries me right now. Here's what I'm concerned about. When you're happy about everything, people don't always have the urgency to keep working with you. I tell advisors every visit that you have with a client, whether it's on Zoom or in person, you want to say the words, now, there's something else I'm worried about on your behalf right now. You see, you become the paid worrier that they want to keep paying because you care for them and are walking alongside them, helping them avoid the costly mistakes and save money that they don't want to have happen to them.
Man, I'm glad you did expand upon that. Like you said, a lot of people, especially like financial advisors, don't even want to bring up worry. They're just trying to get out of that meeting with that client.
Right.
You know what I mean? But you are supposed to bring up that kind of stuff, right? Like what can I do better for you? However you want to frame it, right? How can I improve my service for you? What are you looking for? But that comes with the expectations at the beginning too, as well, when you set up these relationships. Speaking to clients, I know you don't have clients anymore per se because you sold your business for like an 8-figure exit, I think. But that's this is. Let's go back to the beginning. Let's take folks back and just walk back through to, I imagine you had the 110-3-1, dials back in the day. Or did you dial and smile? Is that how you got into the business? Let's take it back. Just take it back through Kenny's memory lane.
Take it back. Wow. Yeah. So I had a problem when I became a financial advisor. I was 26. I looked like I was 13. I had no natural market. I had no gray hair. I had no wrinkles. But what I had, Marcus, was a passion for supporting local education. And so I had this crazy idea. I went back to my alma mater high school, Sam Houston High School here in Arlington, where I still live today. And I brought a $50 Amazon gift card for the teacher and a $25 Amazon gift card for the student. And I began to do a Teacher and Student of the Month award at my local high school. And I would give to the teacher a certificate and the gift card and let them know how much we appreciated them, and give the gift card and a certificate to the student, letting them know that they've got a big, bright future ahead. And we get a picture taken with the student, the teacher, the principal, and myself. And back in the day, we put this in the newspaper, kind of cutting edge technology back then. And I began to get phone calls about 6 months later. And what one woman said to me shocked me. And it completely changed how I thought about my business. She said, Derek, we know you're new, we know you're young, but we want you to be our financial advisor. And what she said next just changed the entire business philosophy I have. She said, Derek, we want to work with you because you care about what we care about. You care about what we care about. And it was in that moment I realized I didn't have to be the smartest or the best looking or the most well-connected. I just had to care about what my ideal clients cared about. And it was like this weight lifted off my shoulders. And what I realized was I then began to do this at all the local high schools, even some of the junior highs and elementary schools. And it was on the cheap. But what I found was people that have money want to work with people who are giving back to the local community. And what happens is it gives them elevated status. In other words, if I'm busy, but I care about the community, but I can't be involved because of my schedule, I feel like I'm part of something bigger by working with Marcus, who is involved in his local community. And so as an advisor, so many times you're told you got to give the $10,000 gift to the symphony, you've got to make the $50,000 donation to the Museum of Art. Nope, I was bringing in $1 million clients with $75 a month. And what I realized was two things. If there's two takeaways you have from our time together today, number one is when you have a cause that you care about, it's like a magnet that attracts people to you. So I like to say when you connect a cause to your cash and meaning to your money and purpose to your profits, it drives you to go make more money so you can do more good. And then people want to work with you because they're part of something bigger. Then the second part is own a painful problem. So many advisors sound and look like everybody else, and they sell based on their features and benefits of their products and services. And what I tell people is when you own a problem, you own your success. You want to identify who's your ideal client, what is the painful problem they struggle with or worry about, and that you help fix that. When you do that, you have a cause you care about and a problem that you own, you become virtually irresistible to high net worth people because they feel understood by you. They're like, finally, somebody gets me. Somebody understands what I've been thinking about and worrying about, and they're involved in the community. And by the way, everybody loves supporting education and helping kids. It's a no-lose proposition.
Yeah, that's great stuff, man. Especially like you said, those last few points, like what people, can you say that the three statements you said, and then the 2 points? Can you reiterate them one more time?
Sure. When you connect meaning to your money and purpose to your profits and a cause to your cash, now would motivate you to do more good and go make more money so you can do more good with it. You see, one of the biggest issues that advisors have is oftentimes, and I was guilty of this, so I'm speaking with all vulnerability here. I wanted a bulging bank account. I wanted to build a multi-million-dollar business, and I began to do that, and I looked around and realized nobody's here with me. I'm saying no to everybody else, even myself, to pursue this goal, and that led to me feeling burned out. And so the antidote to burnout is find a cause you care about and let that motivate you to go grow your business so you can give more money to the cause you care about. And then let the people in your community know when you work with us, you're part of something bigger and you're helping make a difference in this cause. It attracts people to you. And then the second is own a problem. When you own a problem, you own your success. So for example, it might be, you know how so many people worry about running out of money in retirement? We help them fix that. You know how doctors are great with their patients, but their finances need a prescription for help? We help them fix that. You know how so many hardworking women have a sudden life event, a divorce, a death, a job loss, and suddenly they feel stuck? We help them fix that. You see, when you own a problem that your ideal client instantly understands and says, yes, that's exactly what I'm worried about, and you say it in words that a third grader could understand, now people say to themselves, that's the person I've been looking for. That's the person that gets my pain.
Pain points. Yeah, people with pain points and your money, like people aren't even thinking about these things. And then you're just brushing the surface. So you suggest like finding one thing maybe for your whole niche, like that's your pain point. This is your ideal client. People don't. So there's a lot of conversations in niche, like how deep down a person should go into their niche, or just how people can tell people what they do, right? So if I was to walk up to you, and I think you kind of were, I think you were beginning to say that. If I was to walk up to you and say, hey, Derek, let's go back, not what you do right now, but what you did when you were a financial advisor. Because I know if you don't know how to deliver this to people, they just pretty much don't even want to talk to you anymore if you say I'm a financial advisor, right? Even if you're not trying to be like, even if you're not seeking them to work with them. If you just
Right.
tell them what you do, I'm a financial planner, I'm a financial advisor. But if you can frame it like you said, I help people with. So when did you realize that framing worked? Because that was before you started your own business, right? And how would you frame it if someone asked you?
Well, where this happened was I had a big problem as a young financial advisor. Is when I would say to someone, I'm a financial advisor, when they ask me, what do I do? Their eyes would glaze over. They'd start to walk backwards. They'd murmur something under their breath like, I already have enough insurance. You sell mutual funds. I was like, what's happening here? And I used to cringe thinking when people would ask, Derek, what do you do? So I would ask them a lot of questions. But what I realized was until you connect with pain, then you're not going to be memorable. Memorable people make the most money. And most importantly, if you want to make it rain, connect with pain. If you want to make it rain, connect with pain. And so I just got fed up. And so let me give you an example. Marcus, let's say that you are at a social event in your local community. You've got your favorite beverage in your hand and you're mingling around the room at this event. And a man walks up and asks, hey, what do you do? And you reply, well, I'm a financial advisor. He says, oh, okay. And you ask, well, what do you do? And he says, well, you know how busy professionals, they want to get into shape? Well, we help them do that. Okay. And then you ask a few other questions, have a conversation. And later on in the evening, a woman walks up and says, hey, what do you do for a living? And you reply, well, I'm a financial advisor. She says, oh, okay. And you ask, well, what do you do? She says, you know how busy business owners, they always put others' needs above their own, so their health takes a back seat? We custom tailor workout and eating plans so they can feel good, but most importantly, they can look great. So one day they can be the cool grandparent that has the energy to chase their grandkids across the floor. We specialize in personal training for busy professionals. Now pause. Now let's say that 1 week goes by and you look in the mirror and you say to yourself, I think I need a personal trainer. Which one would you call, Marcus? Would you call the man or would you call the woman?
Yeah, I would call the one who told me exactly what they're going to do so I can help my grandchildren, right? Like, I want to run with my grandchildren, stay healthier for life. That woman definitely broke it down. Yeah.
It's
That's
so funny that what you just said there, I didn't mean to interrupt you there.
you're good.
What you said is what people connect with. It's like, I want to be the cool grandparent that has the energy to chase my grandkids across the floor. Now, if we pull back, both trainers are probably equally qualified, equal experience, will probably do an equally good job. But one used better words to connect with the instantly relatable pain points that you have. And so, again, if you want to make it rain, connect with pain. And so the formula that I've created, I call this my how framework. So psychologically, when you say to someone, you know how, well, just those words infer to the person that they will know what you're about to tell them. So it opens this mental door of, okay, I'm about to get what you're about to share. Does that make sense, Marcus?
Oh, yeah.
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 So
You're
what you want,
triggering, you're anchoring them.
that's right. So what you want to think about then is, and this is that there's 3 sentences, but the first sentence is really your express lane to success. And that is, put the words down here. You know how, then insert who your ideal client is, and then the words worries about or struggles with, and then insert the instantly relatable problem, period. We help fix that. So for example, I was working with a coaching client recently, and he said, Derek, my primary audience are corporate professionals who make good money, but they're worried about when they can retire. What should I say? And he came up with like 10 things to say. And when you talk about too many things, you bore people and you lose people's interest. What we know is if you're asking me to burn any brain cells to figure out what you're saying, you lose. You're causing me to have to figure it out and I move on to the next thing. Instead, you want to say it as though a 3rd grader can understand it. So in his case, we talked about, you know how hardworking corporate professionals, they make good money, but they're worried about having enough money to be able to retire? As I slightly nod my head, we help them fix that. He said his client engagement went up dramatically and new clients that he brought on were up about 45% in the first 3 months that we worked together. because number one, it gave him confidence of what to say, but it also clearly spelled out the pain point that hardworking corporate professionals who make good money but worry about having enough money to retirement worry about, because it's easily stated and nobody has to figure out, now, what is he talking about? So if you want to make it rain, connect with pain.
There you go. Find the local pain point in your area, find the people who are connected with it, and then get that structured intro. Just practice it, practice it, practice it. So did you come up in a time where like scripts were heavy when you first started?
Yeah. When I first became an advisor, we had an entire script that we practiced, and it was really well done. What I found though was that you needed to know it so well that it sounded conversational. One of the things, even when I teach my how framework, well, Derek, this feels like it's going to sound scripted. But actually, the more that you say it and it's in your words, in real time, you can actually see people's responses. Now, Marcus, I want to share something very important here. And it's really critical for, I think, an advisor who may be listening or watching right now who feels stuck. Like they know they're better than where their current revenue numbers are, but they're not there. And that is, so often we would reply financial advisor just to get it out and get it done. And what I realized is when I answered, I'm a financial advisor, I'm a wealth manager, I'm a dream funder, whatever you want to say, I knew what was going to happen. I would get a closed door. But when I connected with a pain point, people began to lean in and say, tell me more. And I had to do something to change my own behavior, because my tendency was just to say financial advisor. Now, this is going to sound crazy. I like to eat. And so what I said is, if any time somebody asks you, what do you do? And I reply financial advisor, I have to skip my next meal. I didn't want to skip my next meal. But what that gave me was I had to get okay with owning 7 to 10 seconds of verbal real estate. And what that means is when I say, oh, I'm a financial advisor, that's like 2 seconds, answers out. But instead, I've got to be willing to lean in and say, and this was my how phrasing that I came up with for me as an advisor is very effective. Marcus, you know how so many people, they worry about running out of money in retirement? We help them fix that. You see, that took about 8 seconds to say, but I gave myself ownership of these 8 seconds, if said with empathy and a little bit lower and just a little bit slower, it automatically causes people to say, this person really knows what they're talking about. I need to lean in and hear what they're saying. And what often happens then is if those words land well, they say, well, now, so what do you do? And then the second line is describing your process. So the first line is the problem. The second line is your process. And so I would say, we have a 5-step framework where we custom tailor a strategy for each client so they don't run out of money, so that they feel confident. And then, oh, wow. Then I always add the third line, which is the specialty line. We specialize in retirement income planning. You see, you say it as though you're the doctor who literally has the medicine for their financial pain. And there's a point I don't want people to miss, and that is when you're in a critical conversation. Have you ever been asked a question, Marcus, and you're caught by surprise, or something was asked you weren't expecting? But what happens is often people's voices go higher and they talk faster, and they instantly sound nervous and anxious and less confident. So instead I say, when someone asks you a question you're not expecting, or you're in a high stakes conversation, you want to communicate like you cook a brisket, low and slow. So you want to talk a little bit lower and just a little bit slower. And instantly you sound more authoritative and empathetic and like you know what you're talking about. So for example, if I were to say to you, I'll do it 2 ways. You can close your eyes and see if you pick up on the difference here. You know how so many people worry about running out of money in retirement? We help them fix that. A. B, you know how so many people, they worry about running out of money in retirement? We help them fix that. Now, could you sense a difference between the 2 ways I said the exact same words?
I mean, it's almost like when you said the second time, like, I believe that you can help me fix that. And you believe you can help me fix that. As with the first time you said, it's like, hey, I mean, maybe someone there can help fix that, but I don't know if he's the one who can do it.
Right. I like how you said that. And so part of this is simply practicing, but ultimately you have to ask yourself one question. And you've got to be honest with yourself. Of all the advisors in your local community, should clients work with anybody besides you? And how you answer that question will then give you the confidence to own 7 to 10 seconds of verbal real estate when you answer the question, so what do you do? Because those 7 to 10 seconds will leave somebody and say, I'm going to close the door, or lean in and say, tell me more. And memorable people make the most money.
Yeah, that's very memorable as well. And when people speak and then you slow down the tone and you're forcing people to lean in and listen to you. You were talking earlier about the Sullivan nod you were doing when you're saying stuff to people, you're nodding yourself. Yes. I like to liken it to a coach like some little kids in basketball. And you've seen how little kids miss layups. Big kids do it too. I'll tell them it's like you go fast, you're running fast. If you're dribbling or whatever, till you get that ball. When you get that ball, you're still going fast. But when you get ready to shoot that ball, you got to slow down. That's when you slow down and take the shot. And it'll work out. Another thing I like to tell them with basketball is like, when you get the ball, slow down because everybody else is watching you pretty much. Like you're in control when you have the ball, right? So take your time. And that's pretty much what you were saying with the second one. Like you're taking your time. Everyone's watching what you're going to do. Game 7, we've had several Game 7s in playoffs this NBA season. It's interesting to hear it. And the way you said it, like I said, when you close your eyes and listen, the second one's even better. Derek, I want to talk a little bit. So you were an advisor. We got your website up over here. You were an advisor and you stopped being an advisor to clients and you became an advisor to advisors. Can we go? How did you get there?
That's right. Good way to put that. Yeah. So to go back a little bit, every year I go on a yearly sabbatical. I take about 5 days completely by myself to think and pray and journal. And I ask myself 3 questions. Number 1, how do I be a better husband? Number 2, how do I be a better father? And number 3, how do I be a better business owner? Okay. Now, the reason I began to do this was about 15 years earlier. I've always had a type A personality. I move really, really fast and I get easily distracted. And what I realized was I can run really, really fast, but if I'm not clear on exactly what I'm running fast toward, I'm running fast in a circle. And that was not getting me the results that I wanted. And what I realized was if I could take 5 days, basically a week, to get clear on what I'm going to run fast toward, now I can run really fast the other 51 weeks out of the year and hit the target and achieve what I want. And so I like to go by the water typically. So I was in Boston at the W Hotel there on the wharf. And I asked myself those questions in July of 2019. And I'd been feeling this for a while, like what's next? I call this Derek 2.0. And I began to write a list out of all the things that I would like to do. Just dreamy, blank canvas, canceling the voices that have said you'd be a failure at this, you can't do this, this is something new. And I wrote down some crazy things like write a book, launch a podcast, coach, speak, consult. Could I build another business that had the same level of recurring revenue as my financial planning business? And I realized in that moment, that was my moment to leave being a financial advisor and move on to Derek 2.0 because I could monetize the business I built. But what was most important to me was not just handing off my clients, I wanted to hand them up. That was very important. And so one of the hardest things, just being completely transparent here, Marcus, that I ever did was I called each of our clients personally to let them know that I was selling the business. And this took about 2 months for me to do. Okay. And most of the people were excited for me. They said, Derek, you get to do what you've helped us do. They were celebrating with me. But some people were angry. There was just a handful of people, a couple people actually cussed me out a little bit.
What?
I can't believe you're abandoning us. You made a promise that you would help us retire. Here you're leaving before we retire. And I was able to calm them down. But one lady, Marcus, summarized it the best. She said, Derek, if you're going to have a midlife crisis, just buy a Corvette. It's a whole lot cheaper. But so I started this. It was the first week of January 2020, right before COVID started. And I made my last call in the middle of February. And I remember thinking about it now, it brings it all back. The moment I made that last call and I hung up, I began to weep like a baby. It was like all this emotion that I had just experienced, doing the hard thing, calling the people I loved, that I'd walked alongside, my team had walked alongside through marriages and sometimes family members that had passed away, and new jobs and achieving goals and seeing their kids grow and weddings and all the things. And I was choosing to say goodbye to that to go to what else I wanted was so hard. But what I realized was to be the best advisor legitimately, because I prided myself on being like the best advisor in my local area. But I had to tell myself, I now need to find a better advisor than me to hand my clients up to. Because the win was no longer them saying, Derek, you're the best advisor ever. Who did you give us to? But a year later, them saying, wow, Derek, we liked you, but we really like so-and-so. And it was like eating a big slice of humble pie, because that was the goal. And that actually happened. And that it's been 5 years now, and I'm still in the local community. I still see a lot of these people, but the transition went very, very well. And so for me to sleep at night, it wasn't just a transaction, which financially I did very, very well on, but it was knowing and having the peace of mind that when my head hit the pillow, that I helped these people improve their lives, help them make money, save money, and that was part of my legacy, was giving them a better advisor than I was.
Oh man, that's powerful. That's great motivation. Like, just think that you realize that you need to take time to set the agenda before you just go fast. People say if you want to go fast, you go alone. If you want to go far, you go together.
That is
Type
right.
of situation, right? So are you still in 2.0 or are we in 3.0? Which iteration are we in?
Yeah, I'm still 2.0. And, there's a lesson I learned, and I've been learning this, is at first I began to create some things that I thought were going to be what worked. And I learned this lesson about a year and a half ago, and that is a lot of the ideas in my mind I thought were perfect because Derek thought of them. Of course, they're going to be great, right? I built a successful business. Everything else will be equally successful. What I learned is what I call the focus group principle. And that is what I now do is I'll take ideas in my mind and I'll say them to other people and see if it resonates, if it connects, and then how they say it back to me is my reality. Because it doesn't matter what I think is true. If 3 or more people tell me something about me or an idea that's whatever, then that is true. So for example, when our kids were younger, my youngest son would come in our bathroom as he got ready for school and ask, hey, do I look good in this? And my wife and I would say, yeah, you look fine. He said, you always say that. You're my parents. And I said, you know what? Go ask your sisters. Ask your sisters if you look good in that. And so he'd go back and he'd ask his sisters. Yeah, they said I look good, but I don't like this color. I said, Dylan, let me give you a simple life and business lesson. When it doesn't matter what color you think you look good in. If other people say you look good in it, then that's the color you want to wear. And especially if the girls say you look good in the color, that's the color you want to wear. Okay. But the point was the focus group principle. In your mind, you may think it should go or sound or look a certain way, but it's how people say it back to you that is reality. And so, for example, when I began to do the work I'm doing, I built this communication framework. How can you simply say the words that cause high net worth people to want to work with you? And a trusted voice, I ran this by, said, oh, Derek, you're like the client conversation guy. You should be at every main event to complement all the technical stuff. You give people the exact soft skills of how to connect with people on the human level. And when he said, you're the client conversation guy, I just began to adopt that. I hadn't heard that before, but in his words, it made sense. So that's the lesson, is take your idea, but let other people tell you how to implement your idea. It saves you a lot of time and a lot of money.
That brings us to the end of part one with Derek Kenny. We've covered a massive amount of ground today on the mechanics of building and exiting a high eight-figure firm. But we're really just getting started. If you found value in what Derek shared today, especially the tactical shifts he made in his client acquisition strategy, make sure you're subscribed to the show. Hit that button now. You don't want to miss part two. In our next session, we're going to go deeper into Derek's story, his post-advisor career as he moved into advising advisors, and other great tidbits. Head over to the show, Main Street Meets Wall Street podcast. Check out some of the resources on Market Servant Senior's YouTube channel, or check out Derek's website as well. While you're there, hit that subscribe button if you haven't already. Leave us a quick review. It's the single best way to help spread this message to help Main Street Meets Wall Street. And I'm still hanging out in the chat. So if you ever have questions that you just want to ask Derek or me for part two, drop it below. Reading every single comment, and we'll respond. Thanks for spending some time with me. I'm Marcus Durbin Sr., and I'll see you back here for part two of this series. Main Street Heart meets Wall Street Smarts. Calibrations could force a rotation into your portfolio, regardless of whether the AI bubble bursts tomorrow, the next 6 months, 12 months, 18 months. So sit back over the next 60 minutes, stop looking at the sentiment, and we're going to start auditing some of this solvency. We're covering the defensive areas as well, so high yield credit and gold, the dollar, that serve as the hedge against some of these structural failures David describes. And if you've been waiting for a signal to review your portfolio and your estate planning and tax efficiency strategies, this is that signal. Ledger's open. Let's move to this execution phase.
Well, I mean, I think it's going to happen within the next 12 to 18 months. So one of the biggest signals is these major companies going public. Anthropic, ChatGPT, SpaceX, although it's not directly AI. That's a big warning sign. You have what could happen is, as I said, there's a lot of things that could go wrong. You're definitely going to get a deceleration. I mean, they've been growing CapEx by 50, 100% the last couple of years. It's definitely, even in the projections for 27 and 28, they're definitely going to slow down, although they'll probably raise those numbers. So there will be a slowdown. But there may be a point, you're going to look for, some kind of news where they're not getting. I don't think this is it, but the reports yesterday in the media about ChatGPT not meeting their goals on revenue. So if you get more of that kind of, commentary, that could be the tip of the iceberg to start. And it's all a vicious cycle. Once it's going to hit all the way back to suppliers, to the data centers, to the industrial companies that provide the electrification for the data centers. So everybody's tied into this cycle on AI. So they're all going to, if one gets hit at the top, everybody else is going to get hit, or all the way through the supply chain. So it can just be a vicious cycle on the way down. There could be all kinds of things. There could be, the chips aren't, become so efficient, you don't need as much data center power, or just, all kinds of things like that could happen. But the biggest thing will be, in my opinion, they won't get the return on investment, and then they'll have to slow down their CapEx. I think that's going to be the biggest issue. Institutions are slow to change. As good as this new AI technology is, it's hard. You're talking about having, these systems ingrained in these corporations. To tear them out, it's not that, it doesn't happen as quickly as people would hope for when something like this happens. People are slow to adopt these new technologies. So I think that's going to be an issue nobody's really thought about, that it will take more time. Even if the technology is that good, it'll take time to adopt. So it's just going to be a slower, pace. I mean, I heard yesterday somebody on CNBC say that they hope that it does slow down, because that way it won't be, get out of hand. And I'm thinking, no. If there's any evidence of a slowdown, all of the stocks are going to get hit really hard. It may be good for the long run, but it would be a massive sell-off if they all started to slow down their spending in the short term. We're at a point of no return. I mean, if they start slowing down now, it's going to be a disaster. If they keep spending even more, you're causing even more of a bubble. So they're in a catch-22 at this point, the hyperscalers. So I think it's a very dangerous. So there are so many. You usually need a catalyst to get the market to go down, especially these hyperscalers and all the AI. So you need some kind of we have these oil prices staying really high. These are real companies, Marcus. So people think, oh, they're just going to adopt AI no matter what. Well, let me tell you, if oil prices stay high and we enter recession or just whatever slowdown, these companies have to cut spending. And people think they're not going to cut AI spending. No, they will cut AI spending, or they won't grow as AI spending as much as they were hoping to. So the overall economy can affect the AI spending. So but oil prices today, just what did I see, rose $5 to like 104? I mean, it's 7 weeks into this. So that could be the catalyst down the road if that continues. So we have every measure we're extremely overvalued in the stock market. So when you get to this level, it doesn't take much. You're very vulnerable to any kind of bad news because you're at such high valuations. And by the way, Mark, it's not just valuations. Everybody's saying the tech valuations are lower today than they were in the late 90s, which is true. It's really earnings. So earnings caused the collapse of the internet bubble more than the valuation. So you could easily get a 50% drop in tech earnings in a bubble burst. So right away, if you have a 50% burst 50% drop in tech earnings, and you remember the big bulk of tech earnings now with semiconductors doing so well. So you could see, if you have a 50% drop in earnings, you could easily see a 50% drop in the stock market, right? Because if you just stay at the same valuation level. So I'm not convinced just because the techs, and then you have the other industries like industrials, which support the AI. The industrials are trading at all-time high valuations. So it's not just tech that's causing the PE to be at 21. So you have a lot of other industries that are somehow attached to the AI revolution that would also come down dramatically. Marcus, this is so similar to the late 90s. It's almost too easy. Too easy that the bubble will burst in the next 12 to 18 months. I mean, we've had 17 years of real returns in the S&P 500 of about 15%. That's exactly almost to the day. It's very within months of the 1949 to 66 bull market and the 1982 to 2000. Both of those are about 17 years and about 15 to 16% real returns. Real returns are 6.5% a year over the last 100 years. You don't have to be a math genius to know if you get 17 years of 15% real returns and you average 6.5, the next 10 to 15 have to be like negative real returns, which is what happened between 2000 and 2009 when we had negative 3 or 4% a year returns or 3% a year returns. We are, we're following almost to a script what happened that ended the 62, the 49 to 66 and the 82 to 2000 bull markets, almost to and the other eerie thing is the biggest, at the end, it was the semiconductors. And if you notice, the semiconductors have been on fire for the last 3 weeks. Well, I went back and in the internet from June of 96 until March of 2000, the semiconductor stocks, the index went up 8-fold. From October, using that's 3.5 years, right? From using October of 2022 until today, which is about 3.5 years, we're up about 6.5-fold in the semiconductor industry, which is these are like the two biggest increases in semiconductors ever. But the parallel, 3.5 years, almost the exact same parabolic increases. as back in the late 90s. And by the way, we had the same thing in the late 60s with semiconductors, had this enormous run, and then the bubble burst. So we have that parallel, which is just scary. And both of those bull markets, Marcus, in the last 5 years is when a new revolutionary technology came out. And back then it was the integrated circuits and the Moore's law and also the aerospace. So you had, now this is the same way. We had the last 5 years has been the AI, just like the last 5 years in the 90s was the internet, and the last 5 years in the 60s was integrated circuits. It's crazy how closely they parallel. Also we have right now, price to cash flow is 28 times the S&P 500. That's the highest since the late 90s. We are the biggest discrepancy between price to cash flow and price to earnings since 99, 2000. Another incredible parallel. So we have just incredible, and then of course we have the parallels of the disruptions of every other industry going down, like software. And back then it was, real estate and what we discussed before. So we have that parallel. I mean, there are so many parallels. It's crazy. It's just incredible to me.
Whew, yeah. All right. Hold on, David. Let's pull up and take a breath for a second.
Okay.
You just gave Main Street a lot. People might be calling and trying to get out of all of their AI investments right now listening to this.
Right now. I'm not saying right now. I'm saying within the next 18 months.
No, you're good. I understand what you're saying.
And by the way, Marcus, don't forget, the biggest gains occur at the very end and the biggest losses occur at the very beginning of a bear market. So it's very difficult to time. If
possible to time almost,
Yeah.
I was going to say, just speaking back to the market, this market may be different though. I don't know. You've seen a lot of markets, maybe all markets are the same. You talk about resilience and you mentioned China and how much cheaper they are using AI technology. We saw DeepSeek at the end of 24, if I remember correctly. And that was really like a Lehman Brothers moment for NVIDIA, if everyone remembers. It went really far down, but then it came back. And then we've seen, let's say, I'm just trying to think since DeepSeek, we had tariffs, which were, we saw what we did to the market. The market just moves different. And now we're in this Iran conflict. The market moves different. I don't know if it's the speed of information. I don't know if it's the retail investor. A lot of people invest in the market have never seen a recession, they've never seen the market go down. So people are sitting here listening to you speak right now, David. Go back and tell them a little bit about yourself and your history and what you've seen so they know, pay a little bit of attention to this ghost whisperer we have on here right here.
Well, you're right. It seems different, but actually what's happened so far, Marcus, is exactly what you would have thought would happen. In other words, if I go back to March of 2009, when this secular bull market started, and if you had told me back then, Marcus, if you had told me, Dave, it's a new secular bull market, what's going to happen? And here's what I would have told you. I would have said, we're going to have 17 years of about 15 to 16% real returns of the secular bull market. It's going to last 17 years. And at the last 5 or 6 years, I don't know what the technology is. We're going to get a revolutionary technology that's going to capture the imagination of investors. And it's going to cause a bubble. And the bubble is going to burst. And the secular bull market's going to end. So that's exactly what's happened so far. So nothing that has happened so far wasn't predictable based on the past two secular bull markets before this. I mean, we're perfect. It's almost a perfect now. But what I will tell you is, if this lasts past next spring, then it will be different. Okay, then it will be different. But in those two, but Mark,
say that again for the listeners, David. What you just said.
If this secular bull market AI lasts past next spring, it will be different than any other secular bull market, because that would last more than 17 years, and the returns would still be, very high. But you're talking you're talking about how the market bounced back from tariffs, from the oil spike, from the Iranian war. But in the late 90s, Marcus, we had the Asian crisis in 1998, and that was very severe. We had a depression in a lot of countries in Asia, and we had the long-term capital where they almost went under. So people were shocked how we bounced off of that and came right back. 98, like that was a 20% drawdown in a couple of months, just like the tariff did. But we bounced back immediately. And we had in 96, we had a high yield crisis, and we had, different things happen, and the market would keep coming back. And people would say to me, Dave, this market's incredible. It just comes back. It doesn't matter. People just buy the dips all the time. Yeah, well, that happened for 17 years. And then after 17 years, guess what happened? The internet bubble burst and everything went on. So when people tell me, Dave, this market's different, it's resilient, we have everything that happens to it, whether it was the inflation spike in 22 or the, tariff, tantrum in 25, or the oil spike to this in 26, the market just comes back. That's what happened. That's no different than what happened in the late 90s or the late 60s. So only if it continues past next spring will I be convinced that this is something different. And I don't believe it will. This one thing we haven't talked about much is productivity. Everybody thinks it's going to be the panacea, right? And it really hasn't happened yet. People keep quoting these huge productivity gains, right? However, we had negative productivity for like 4 or 5 quarters in 22 to early 23. So we have had increased productivity since then, but that's only because we have had a big, rebound from negative productivity growth in 22, early 23. So if you average that out, it's really not that great. And if you go back, I think I saw that after 20, productivity is only averaged a little over 1% a year growth after 21 and 22 until now. But everybody will quote you from mid 23 until now, and they'll say productivity growth is 2% or greater now. But that's just a function of a rebound from a decline. But here's the problem with productivity. In 2000, we had the highest productivity we ever had, 4.2%, I think it was. And the stock market went down, 15% that year. The economy went into recession the following year. My point is, it's not a panacea when it depends on the context. Productivity grew 3.2% between 2000 and 2004. That was higher than the 3% from 1995 to 99. Yet the stock market went down in real terms 4% a year from 2000 to 2004. So productivity growth was the highest ever. I mean, not the highest ever, but the highest in multi-decades from 2000 to 2004. And we had not so great economy, and we had stock market declines on average, annualized at about minus 5% on a real basis. So it's not a panacea. Even if we have a pickup and by the way, inflation went up in 2000 from 2.8 to 3.4%, even with productivity of 4.3%. So it depends where you are in the business cycle. If you're already close to full employment and inflation is starting to rise like it is now, the productivity is not going to save you. It didn't save us in 2000. I don't think it's, we have no labor force growth because of the demographics, as you know, because no immigration and because of the baby boomers retiring. We have a decline in the labor force, out there. So that means you are dependent on productivity for growth. I don't know if you know, from 1950 to 2000, the GDP grew about 3.5%. And of that 3.5%, about 40% was from aggregate hours worked. About 1.6% a year aggregate hours grew. So you had almost 40% of GDP growth was aggregate hours. We can't grow aggregate hours now much, okay, because of the demographics. Aggregate hours are based on, how many hours the labor force increases every year. If you don't have increase in the number of people working, you're not going to grow aggregate hours. And with the demographics, it's going to be very difficult. So my point is, almost half of GDP growth came from aggregate hours work. Now, in the next 10 years, we're going to almost have no aggregate hours. So we're totally dependent on productivity. So if productivity does it needs to grow, over 2% in order to get GDP at 2%, because you're not getting you're losing that whole other growth factor. So that's something that people don't understand. So yeah, you will, even if productivity goes up a lot, it's not going to offset the loss of aggregate hours growth that was 40% of GDP growth from 1950 to 2000. So
Okay.
that's a big, big deal that people aren't thinking about, overall. And also within that, Marcus, even though aggregate hours grew 1.6% from 1950 to 2000, the number of hours people worked declined. But because labor force growth was so high, it was greater than 2%, aggregate hours can go 1.6%. So if we continue this trend of people working fewer hours in the workforce per week, per year, right? That's another, if you have no labor force growth, that's really going to take a hit on aggregate hours, right? It's really going to affect it negatively. So this is a major force, and it's a big reason. I'm doing a big thing right now on how the amazing thing is that earnings, GDP grew like 2% a year last decade, but earnings grew like close to 10%. And nominal GDP, we already grew like 5%, but earnings grew like 10% a year. Well, if you go back to, last 100 years, nominal growth equals GDP usually equals earnings growth, very close. In the last 20 years, earnings growth in the S&P has been way higher than nominal GDP growth. And the only way they did that was through the labor getting less percentage of sales, right? They're taking away from labor. And now we have this K-shaped economy. You can't keep taking away the revenue, giving more revenue to the owners versus labor and capital, giving more money to capital and owners. You can't keep doing that because K-shaped economies eventually die. They can't grow anymore because if you have very wealthy people that have most of the wealth, they're not going to spend, a high percentage of that wealth. Whereas the 50% or lower income groups spend most of their income. So we know there's all kinds of academic studies showing K-shaped economies will suffer lower growth. So I guess what I'm saying is if we're going to get GDP growth by keep taking money from labor, sacrificing labor for profits, eventually that's going to turn on its head because the economy won't continue to grow. And we, as you know, I'm sure you're well aware, this is the most K-shaped economy ever in the history of the U.S. And it's dramatic between the haves and the have-nots. And that will, if it continues, will actually depress economic growth. So that's another big factor, which is also, Marcus, why you mentioned that everybody buys the dips, right? Well, here's the problem with a K-shaped economy. The wealthy keep spending and keep, as long as the stock market, there's more, I guess, economic growth has been more tied to the wealth effect today because of the K-shaped economy than any time in our history. So if you really do get a down cycle that stays down, so if the stock market somehow went down 20, 25% and stayed there for a long time, or whatever, you get the virtuous cycle. You get the cycle where it would actually affect the economy way more than in past bear markets. In other words, a bear market is going to affect the economy more than it ever has. That's another major risk. If we go in a bear market and recession induced, it's going to be really hard to come out of it because it's going to affect spending more than it would in other recessions. So we have that to deal with. My whole point of bringing up this earnings growth growing faster than GDP is that if you're going to have these high valuations in the stock market, you're expecting higher earnings growth or more stable earnings growth. Well, how are you going to have higher earnings growth if GDP is going to be less than it was, for the last century without sacrificing labor? So we have that, big issue of how we're going to get growth in the future, right? With all those factors I just commented on.
So yeah, and that was a lot, and there was some salient points in there for sure. And obviously on the other side, we're looking at a new, today while we're recording, this will come out a little bit later, but this is presumably Fed Chair Powell's last meeting, right? So we have Warsh coming in. I think Tom tells us I'm down here in North Carolina, Wall Street is South Charlotte. Senator Tillis said he will allow the confirmation to go through, the nomination up through the board. And so I know Warsh is more concerned with, he thinks AI is going to help the Fed in different ways. He's concerned about AI obviously destroying the economy, but he thinks it's a way that something that we have to embrace and it will possibly help us outgrow this economy. That's just such a diatribe or a divergence in the way that the world's looked at right now, because half of the people and the people in charge of our fiscal policy, by the way, and monetary policy think that we're going to outgrow this that we're at right now with the deficit. That's why they're looking to lower interest rates and reduce the amount of debt that we have so it's easier to service this debt that we're paying. And then they're praising AI for the productivity booms that it's going to bring. But as you just mentioned, AI and this productivity gains, especially when you see in the side of the earnings, the gap in earnings and real GDP, Like seems like a formula for chaos. How do you see Warsh coming in and affecting this? Because the Fed could actually, this is something they could actually play a big part in, like whether we go into a recession or not. We'll take a quick break here and just set back.
Well, his number one goal is to reduce the Fed's balance sheet. So if he does that, that would probably cause long-term rates to go up. But he is going to definitely try, in my opinion, try to lower rates. I mean, he knows what Trump expects of him. So every new Fed chairman has been tested in the first 6 months. And what I mean by tested, the markets have taken the stock market or the bond market down within 6 months or a year of when a new Fed. So he's going to get tested likely. So I think the test could be he's going to want to lower rates when he comes in. With inflation still actually rising, especially with oil prices high, the market's not going to like that. And if he is able to convince the rest of the Fed to somehow lower rates, the vigilantes in the bond market could rebel. In other words, the longer-term Treasury bond market could sell off significantly because they think he's not going to be an inflation hawk. So that's how I think he might be tested, that he's being too dovish, or it could be that inflation actually goes up a lot and he refuses to hike rates. You know, so there's a big chance that he is tested within the first 6 months of his term, because for some reason the financial markets, like to test you. It's almost like a rookie in sports when he's on the first sports when he's playing as a rookie, and they test you, whatever sport it is. So I think that's a very, probable, not most likely, if it's going to happen, that would be the most likely scenario where he's trying to lower rates, and the market doesn't like that, doesn't think that that's deserved. Hopefully, because the market, the Fed needs to restore their credibility. I mean, they've been calling for this 2% target inflation rate for 5 years. We haven't even been close to it. They're losing for me and for the financial markets, credibility for the Fed is one of the most important things for long-term investors in all financial markets. And globally, they've lost all credibility by keep pointing to this 2% inflation target. And here's the problem. So, people are more educated in running small and large businesses than they ever have. They know what the Fed target is. So if you're a business owner and he's got this 2% Fed target, and you want to raise your prices by 3%, and you go, no, you know what? I'm only going to raise them 2%, right? Because if that's what the Fed, that's what everybody's going to do. So you keep your prices at 2%, and then inflation comes in at 3% every year, and then the Fed suddenly says, well, we're going to change our inflation target to 3%. Well, what's going to happen if you're a small business owner? Go, wait a minute, I only raised 2% because that's what you said the inflation target was. Everybody else was raising their prices more than me because that's how we got to 3% inflation. And now you raise it to 3%. Well, you know what? I'm not gonna honor your expectation of 3% because you didn't honor your expectation of 2%. So I'm just going to raise my prices, 3-4% instead of 2%. If you follow that pattern, you lose, not only do you lose credibility, but you lose having an influential effect on inflation, because you've lost the credibility, then becomes loss of influence. So it is a big deal. So he doesn't seem like he wants to restore that. So I don't, we'll see how it works out, but those are my views on the Fed.
Do you think the Fed stuck the soft landing?
Well, we still don't know. I mean, it's kind of funny because most recessions occur not when the yield curve is inverted, but when the yield curve inverts and then actually becomes positively sloped afterwards. So we're not totally through that yet. We had in 1990, we had a recession after the Fed. We had a big tightening cycle in 88, early 89, and then the Fed actually lowered rates a couple of times, and we still had a recession in 1990. So, I mean, it is a possibility. You could still have a recession without the Fed tightening from here, if that, the lag effects, so that's still a possibility. But right now everything's on hold, which will probably be the case for at least the next couple meetings. So we'll have to see how that goes. But yeah, it's still a possibility. In other words, you don't have to have an inverted yield curve to have a recession. What you do need is to have an inverted yield curve that, a couple years before, and then becomes positively sloped. So we're still in that time period where it could happen.
Gotcha. Yeah, and when David keeps mentioning invert yield curve, that just means that the shorter term investments, treasury bills, somehow are higher interest rates than the longer term, whereas you should get longer term money for taking a longer risk where people are holding your money longer. And that is usually a reflection upon the government or whoever's issuing that note for them to pay it back. So definitely a salient point in there as well. The soft landing is definitely something we'll have to see. Was inflation transitory? I don't know. We'll see. I think Warsh is walking into plenty of challenges already. I mean, Powell had COVID pretty much right when he jumped in, right? And Trump actually had started some tariffs back then. There were some tariffs going on. Like that's when the tariffs initially started. They just stayed on through Biden's administration. So I think Warsh is definitely walking into some type of situation, to say the least.
And also, Martin, I don't know if we discussed this, but spending has exceeded income every month since the fall of 2024. So you can't do that forever. The savings rate's down to 4%. And even with all these tax refunds, which, by the way, came in lower than expected, the tax refunds, real disposable income from the time the tariffs were put on until like January was negative. Real wages are really slowing down. So you can't keep doing that. You can't keep spending more than your income. You can draw down your savings to a certain extent, but I don't think investors are aware that the consumer has been spending more than the increase in spending has been less than the increase in income for like a year and a half. And that's not good.
Yeah, it's definitely not good.
No.
And even as you mentioned, to go back a little bit further, when you were talking about the Fed's credibility and the 2% interest rate, and then, they set the COLA, cost of living adjustment, off of what's PC.
Yes.
They set that, and that number is still coming in higher. They say our target is 2%. Maybe the Fed should just say, like you said, that the target's 3%. That's where we're fighting with, and let business owners and Americans figure out, global community, because our rates kind of set the bar. Like Japan sets the lowest bar, I feel like, but our rates kind of set the international bar as well.
Yeah, but
so maybe they should realize that. And then what do you think would happen if Warsh came in, somehow convinced the board to just cut, regardless of it needing to cut?
That's where I said what will happen is the vigilantes in the bond market will sell off the long-term treasury bond. Yields could go to 5% on the 10-year treasury. And that would cause less economic growth. It would cause the stock market to go down. It would cause financial conditions to tighten. So it could have the reverse effect, right? It could actually have the reverse effect of causing financial conditions to actually tighten. So that's the big risk of him doing that. Remember, he can't control, although they can control through buying, through quantitative easing, buying, long-term treasuries, which he's going to do less of, obviously. But without that, the Fed has no control over long-term rates. So, it could backfire if he tries to do too much. But if he tries to lower rates and the market doesn't want that. So, they're in a real predicament, a real catch-22. We basically have stagflation right now.
Yeah, self-inflicted.
Year over year, GDP growth was only 2% last year. So a lot of people
Didn't they revise that down?
I'm sorry?
Didn't they revise that down too?
Yeah, that was down to 2% year over year on a fourth quarter to fourth quarter basis, which is a big drop from before. So people comment that, the tariffs didn't really affect the economy. Well, first of all, it slowed the economy down because everything, if you look at, real GDP growth slowed down a lot. And then you had inflation higher. Everybody, inflation came down, but actually tariffs probably caused about 50 base, about, I don't know, maybe, a half percentage point increase in the CPI when it would have otherwise would have been. So, you do have that we're still contending with, which is still kind of rolling off. But
to say tariffs didn't cause any, they weren't impacting the American people is very interesting, especially when you look at the fact that now we're giving back tariff refunds. So clearly some money was somewhere inside of tariffs, right?
Well, yeah, but they're going to go back on with all the different options he has. The interesting thing, Mark, is who's going to get that money. Are consumers going to get it, or the businesses are going to get it, or is it going to be? There's lawsuits all over the place now.
You took the words right out of my mouth.
Yeah, the corporations are getting it right now because they're the first ones. But how do we know? Does a consumer benefit because he the consumer had to pay higher prices, which is pretty well documented.
There's
Marcus, people didn't understand. So the inflation rate really didn't change much, right, after Trump took over with the tariffs. However, that doesn't mean tariffs didn't affect the inflation rate, right? So in other words, if the inflation rate stayed close to 3%, and so people say, well, the inflation rate didn't go up with tariffs. That's not the way you should look at it, because inflation would have been lower if not for tariffs. So even though it didn't go up, it would have been like 2.5% instead of 3%, right? So that's what people don't understand, that it still did cause higher. And most of the offset to tariffs was lower oil prices last year. That was a big factor in pulling the CPI down. Probably the biggest factor. Well, we're not going to have that this year, right, to offset. So it still had, the tariffs still had, people don't understand the no economics. Tariffs actually cause more economic slowdown than they do higher prices. So we're seeing that. We saw the Atlanta GDP tracker for the first quarter is 1.2%. So we just did 2.2% year over year, fourth quarter to fourth quarter. Now we're going to do 1.2%. So that's 5 quarters of subpar growth since the tariffs. So I don't know how people can say it didn't affect the economy and it didn't affect the inflation rate. Some of these tariffs just don't make sense. Vietnam. In Vietnam, shoes and things like that they make in Vietnam are literally 50% cheaper to produce in Vietnam than here. So if Trump puts a tariff of 20%, which is what it is now in Vietnam, how does that help anything? Because it's not going to move manufacturing of shoes and apparel, whatever, to the US, because he'd have to have 100% tariff in order to make it worthwhile to move to the US. So when you do a 20% tariff on Vietnam, all you're doing is put a tax on American consumers, because there's no benefit of trying to reshoring at 20%. Do you follow that? That it would have to be like over 100% tariff in order to get reshoring from Vietnam. So what's the point of having a 20% tariff? I mean, all it does is tax. It's a regressive tax because shoes and are a higher percentage of incomes of lower income people. It's just a regressive tax in the U.S. Makes no sense at all, and increases the inflation rate.
Yeah, tariffs are definitely something that history is showing. And the Fed, even going back to the Fed, they just keep they don't speak about the tariff impact, I think, enough. Like, they just kind of say to keep waiting to feel it hit or see it hit. But the Americans and people, we know when we go out and shop that things have gotten more expensive since last year. And you can pull out a fancy chart and show us parts here and there and why. But like you said, oil was a big part of the deflationary pressures last year. Oil's going to be higher. The beef prices, going back to the tariffs, we had to change some of our import rules with beef so we could get lower prices there. Where it's like we should already be sufficient here. It's just a mixed bag in this economic detox that they said we're going through at the beginning of last year.
Also, really important, and nobody knows, is non-defense R&D spending under Trump is going down 25%. That has been the government R&D spending has been about 20 to 30% of productivity growth. It accounts for 20-30% of productivity growth in the last 100 years. So that is a big deal that now that's a little more longer term kind of effect, but you more than pay for federal government research on defense. You more than pay. Every dollar produces like $3, of income. And we have cut that by 25%. And so that's a major long-term negative effect on the economy as well, that people are not really aware of. So, there's other factors. But one thing I left out, Marcus, is the high yield market. The high yield market, even with the private equity getting hit, has actually stayed pretty stable. But I use the Bank of America option adjusted yield spread. That came down to basically match record levels in January of 25. And what that is a sign of complacency, extreme complacency. It was only that low in 1997 and in the fall of 97 and in 2007. And within a couple of years of that, or 2 years, we had a major, major recession and bear market. So it's a contrarian signal when the high yield spreads are that low, low, almost 2%, low, 2.5% spread, it is actually a contrary to negative signal that people are being way too complacent about credit. And we've had now 15 months since that hit in January of 25. So it's another variable that's worked well in the past. And so you have to be very aware when complacency on credit gets that high. And we're already seeing some things in the private equity market this year.
So that's yet another sign of the bubble.
Yeah, another sign of a bull market coming to an end. Yes.
So pretty much I can just set my timer for 2027 to like 2034.
I don't know. The timing of this is going to be tough. I mean, it's going to be hard to know exact. It could be as late as the fall of 27. I don't think it's going to be past that. I'd be shocked. Okay. I'll be shocked.
David, so yeah, you're great, man. Sitting on here just giving all this great information. So we need to let Main Street know, because you saw these things coming, you predicted them, you've done this, you've called highs and lows for those who don't know. If you were investing right now, not particularly positions, how would you position yourself for what you see coming?
The next 10 years, if you just invest in an S&P 500 fund, index fund, you're probably going to make very little money, if any, and especially on a real basis, on adjusting for inflation. So you're going to need to be more conservative. You may miss out on the next 6 to 12 months of this internet bubble, but if you're a long-term investor, it's worth it at this point. So you want to, if you're going to invest, you need to invest more in income-oriented stocks, and especially for the next a couple of years, more of the income-generating stocks that are not cyclical. So that would be one area. It maintains a decent amount of cash, and you got to be tactical. Tactical, I mean, when you do see the downturns, you start to buy, and because you're believe me, I've been in this 40 years. You're always going to get opportunities. It just happens. It's human nature. People get over enthusiastic, over greedy. Yeah, so I would try to stick with, really good, high quality. When we go to high quality at this point in the cycle, we're late stage of the cycle, and stick with good, low valuation companies, stocks, and don't be tempted to try to jump into to the bubble stocks, the bubble this late in the stage, even though you may miss out in the next 6 to 12 months, because it's really difficult to time. Your question more is about if you're 10 to 15 year investment horizon. So
any horizon.
Yeah, that would be better. So it's very important to be more conservative at this point in the risk cycle. So yeah, that's what, bonds will be fine.
We're just over 40 minutes in, and I really appreciate everyone who's hung out with us. If you're just joining us, remember, we aren't chasing the daily ticker. We're operating within our different set of pillars. We've covered some of the geopolitical intelligence regarding energy bottlenecks. Now we're shifting to more of a macro structural audit. We just finished talking about Kevin Warsh and his effect on the AI boom, productivity, his philosophies, investment strategies, or how you can particularly play them, ways that you can invest inside this economy. I asked David some moves he can make. So moving forward, as we jump into the latter half of this conversation, stay with us, because this defines where the money could be going and what we can see when this cycle hits or when the next cycle hits. So like I said, we've audited the history, the rotation. Now we're talking about some of the preservation. So whether you're a managing principal over at a family office or you're just the managing principal in your family, right? The goal of these reports are all going to be the same. These podcasts to give you information, help you grow, and help you make your own informed financial decisions. Strategies required to thrive in a K-shaped economy like right now. Don't let the noise of the mere exposure effect dictate your outcome. Use this ledger. Audit your trust derivatives, whatever you may need to do. Make sure you have proper beneficiaries on your accounts. Allocate according to reality, not to the headlines. Let's get back into the last part of this with David Snyder and his AI bubble predictions.
I think bonds are going to have more difficulties because of the government deficit. So I wouldn't go too long in bonds right now. Although if you see a recession coming, I would up my allocation to bonds. I'd completely stay away from private equity right now. I wouldn't even go near it. What I would stay away from the high yield market right now. Just way too much complacency. You'll get an opportunity within the next couple of years, believe me, when spreads widen. So yeah, so a much more conservative type of portfolio at this stage. People are just completely, especially healthcare stocks. Healthcare stocks are really attractive again. They had this big run from July until December of last year, and then they gave a lot of it back the last few months. But you have companies like Medtronic, a blue chip medical device company that's been high return on capital, incredible franchise. And they're growing, close to 10% a year earnings. And it's trading like at 16 or 17 times earnings. I mean, this should get a premium because it's recession proof. They don't have a lot of drug exposure where they're trying to, medical devices, the prices actually are flattened down for most medical device companies in the crosshairs of the Trump administration. And they, you got the demographics with, the baby boomers retiring. So, it yields like over 3%, a dividend yield. So those kind of things nobody cares about when you're in a go-go market, but they will care. So that's where I would be emphasizing.
Got you. Okay. And so we can't sit here and stay in those positions for ever or forever long. What signs should people be looking for? Say they make the move, because that seems to be the problem when people try to time the market. Because you're talking about becoming clearly less, not getting out of the market, but taking less risk. So being more risk off.
Just
How do you know when to put the risk back on?
But investing in more conservative equities for one, and staying away from all the risk private equity, high yield. Stay away from those for now. It will come. You'll get a chance, but now's not the time.
Can you expand on private credit and private equity while you stay away from that?
There was so much money put into private equity and private credit over the last 10, 15 years. And it just, when you have that much money, you're competing for capital, which means you're going to offer better and better companies that are running the private equity and credit. They're offering better deals, meaning more risky in order to get the deals. So if you're private equity was doing, they were investing in companies and get 10, 11, 12% a year in private credit. You don't get 10, 11, 12% a year without taking risk, okay? Because if the companies were that good, they wouldn't need to go to private equity and get loans at 10, 11, 12%. So that's telling you something right there. And there's just too much money. Anytime too much money, chases too little capital, you end up making deals that you shouldn't make, which is what's probably happened, especially in the 2021 timeframe, where some of this stuff is coming due. They were making really very liberal terms, a lot of the private credit and even private equity. So, and private equity is tied to the stock market, and so they need exits. And if the market's this high priced and is vulnerable, they're not going to be able to exit as fast as they would like. And then the things they're investing in a high price right now. So yeah, I'm not a fan of those two areas right now at all.
You mentioned the move in healthcare. You said how healthcare had a run from like October until now. Something else that had a parabolic run that has come back down is gold. What are your thoughts with gold and metals? And I think we saw the basement trade, but maybe you didn't.
Well, you don't want to know my view on gold. I don't invest in gold. It doesn't produce anything. But
no intrinsic value. The
biggest thing for gold is it's not correlated with anything. So people think it's correlated with inflation, right? Inflation in 22, the biggest spike in inflation ever, maybe except for the late 70s, and gold hardly did anything. The core inflation rate peaked in October of 2022. And gold actually then started going up, bottomed. The exact opposite of what you would expect, right? And so then it had this amazing 3 or 4 year run, gold, when inflation was coming down, the steepest it's ever come down, except for the early 80s. So if inflation was really correlated with gold, this past 5 years, it really did not work at all. But I have a really funny story about gold. So
perfect.
I was at Morgan Stanley in 2002, and we had two really smart guys, and they gave presentations. And this is when gold was at the lowest. It was like $300 back then. It had been in a 20-year bear market, gold, since 1980. and 82, whatever. One guy gets up and says that we were trying to get out of recession in 2001 too. And so the Fed had really lowered rates dramatically. And he said, it's going to cause hyperinflation. He says, I'm buying gold because we're going to have hyperinflation. And so gold's going to do really well. The next guy gets up and he says, gold, I'm buying gold because there's going to be deflation. We're trying to get out of this deflationary period. And the Fed's lowering rates, but they're not going to be able to. You can't push on a string, was the saying back then. Gold does very well in deflationary periods as well as in inflationary periods. So I thought about it for a while, and these are two bright guys. And I thought, I think inflation is just going to be like it was in the 90s, 2.5%, 3% a year. So I'm not going to believe what they say. What they're recommending. So what happened? I was right. Inflation went up like 2.5% a year. The other two guys were totally wrong. The one that said there's going to be hyperinflation, the one that said there's going to be deflation. Yet they made a fortune. Gold went up like tripled or quadrupled during that period. Where else could you be? So two guys were totally wrong and made a fortune. I was totally right and didn't make a penny. So that tells you about gold. I have researched it. People say really low real yields. Well, we had the lowest real yields ever last decade. Gold did nothing, right? They say inflation, they say geopolitical events, maybe for the very short term on geopolitical events, but there's no correlation in intermediate to long term. What's the other oil prices? Oil prices correlate with gold. Guess what? Gold tripled in the last 2.5 years, while oil prices went straight down. This is before February this year. Gold had tripled, while oil prices went straight down for 2.5 years, completely negatively correlated when everybody says they're positively correlated. So, and I also think, I know this is crazy, I also think that gold is going to be replaced by man-made gold someday. There's now
diamonds?
There's a company called Marathon Fusion that's a private company that's raised like 10, 20 million. And one of their goals is to produce through nuclear fission to produce man-made gold. I don't know if you know this, but man-made diamonds, which are really hard to detect if they're not real, have caused the price of diamonds in real terms to go down 40% since 2012. And so with all this new AI and stuff, we're gonna be making man-made commodities, not having to dig underground at some point. Obviously, it's still a theoretical and still way off, but it will probably happen faster than you can think. So that's another risk. But gold, I have done a lot of research on it, and there is almost no correlation with anything except for price momentum. If you buy it when it's up a lot, if you see it on a 20% move and you buy and you put a tight stop on it, and because when gold tripled in the last couple of years, there were only 2 or 3 10% corrections. That's it. So you never got scared out of your position. So the best way to play gold is on a momentum basis. If it's going up strongly, you buy it with a tight stop. And so because there's no other correlation with anything. And by the way, fair value in the long term, fair value of gold is usually about 50% above the production cost. Production costs right now about $1,700, $1,750. So the fair value of gold is probably like $2,500, $2,600. So it'll eventually get to 50% premium to the cost of gold. It may not happen for 5 years, 10 years, but if you're a long-term investor, I don't think it's a good entry point.
Got you. Are there any commodities that you like? I mean, you didn't like oil, you don't like gold, or any commodities?
I thought copper was pretty good because, it's tied. There's a lot of copper and electrification and all that. So, and there's been some disruptions in copper production around the world, even before the Iranian war. So, yeah, I think we're short-term commodities look okay, but I'm never a big believer in commodities. Commodities over the long term, become less part of our economy. And I think between 1800 and 2000, there were only 3 commodities that outpaced inflation. They were timber, fish, and I can't think of the third. But people think oil did not outpace inflation from 1800 to 2000. Well, gold did. Gold did because when we off the cycle, the Bretton Woods. But so commodities over time, especially with AI now, and with all we have, is going to be less and less important, in my opinion.
And for people listening, they should realize that, David knows what he's talking about. He's made some great market calls. Let's take a second, and I want to respect your time. We've been on here just talking. This has been a great conversation. Take a second and just go back through some of the history, maybe if you can, to let people know like some of the things you've called, some of the things you've seen, and maybe how you saw them and how you called them. Even though you may not have said them yourself, you might have wrote it out there, you put it out there. How are you getting these market calls?
So, I have an investment strategy letter, Journey One Advisors, and I've been doing it since 1986. So my biggest call was in the financial crisis. In November of 2007, I made a big call that there was going to be a massive bear market recession. And I actually have that real-time research report on my website that was written in real time. And then in April of 2009, I put out a massive 35-page paper on how this was the start of a new multi-year bull market. So I didn't get the exact bottom, but, I did get close. Close in the sense that I got the direction right. So, I did have that. My biggest mistake in investing was in 2000. Even though I knew the market was way overvalued in 98, 99, I stayed with it. And in March of 2000, I called the exact top in tech stocks. They dropped dramatically in the fall of 2000.
Like 70-80%, right?
Yeah, well, not at that point. At that point, they dropped like in half. And I went back in and with hands that full, and I got back in way too early. I mean, I knew it was a bubble, and I just didn't realize when a bubble bursts that it takes more than 6 months to revert to the mean. And so I remember like Oracle was down like 50-60% from March to October, and I jumped in and it went down another 60% after that. So that was my biggest mistake was getting in to I called the top, but I got in way too early. And I also got the Fed had lowered rates in January of 2001, and every time in the past century when the Fed started lowering rates, the market went up. It was the first time the market didn't go up, Marcus, in 50 years when they aggressively started to lower rates. That's a whole nother point. There used to be Marty Zweig was one of my gurus, and his saying was, don't fight the Fed, especially when they're lowering rates. That completely changed in January of 2001. January 2001, we were down 20% in 2000. The bubble had burst in the internet, and the Fed lowered rates 2 or 3 times in January. The market went up just like it normally does when he starts lowering rates, and then it died. And then the Fed lowered rates 5, 6, 7 more times over the next 2 years, and the market kept going down. That never happened before in the history of our stock market the last 100 years. So this whole thing is no longer valid that don't fight the Fed. We had in 2007, they started lowering rates in in October of 2007. And for the next 18 months, they lowered rates to 0 from where it was like 5.5. One of the big, massive loosening cycles ever. And guess what? The market went down another 40-50%. So now you have you can't just say, follow the Fed and everything. Tightening still has a negative effect. But on the loosening side, you have to get to a threshold. You have to know when is it the 3rd interest rate drop? Is it the 7th drop? It's really going to spur the economy in the stock market. It was so much easier to invest from 1950 to 2000 because every single time the Fed stopped tightening and then started to lower rates, the market and the economy responded. Part of it is that what we call velocity of money peaked in 1999. So even if you increase the money supply, it's the velocity. The economic is the increased supply times the velocity. And that has changed since 1999. It's been much lower velocity of money. So lower rates don't necessarily get multiplied through the economy. The velocity is just how much it's multiplied to the, So these people, it's a much harder environment now to invest in because you don't have that ease, that security that if the Fed's lowering rates, everything's going to be fine. We just saw in 2000 and 2008, 2 times where it completely did the reverse. Lowering rates just led to lower and lower stock market, and the economy got worse and worse. Not that it caused the economy getting worse, but it didn't help. So that's a real big distinction versus the prior century. Not many people talk about it.
Yeah, it's definitely the Fed and the rates and the returns and the rate of return have definitely all changed. We saw
it's not as good a signal as it was in the past.
Right. We also saw like with the Fed cut nearly 100 points. When was that? 24, end of 24, and the interest rates went up. Like the 10-year went up, mortgage rates went up. That goes back to the focus. Yeah, man, this has been a really good conversation. You all right? You need a drink of water?
I'm fine. That's fine.
Perfect. Let me while I have you here, I'm borrowing Dave. David is he's a wealth of knowledge. People, how did you get so smart about all this stuff, David? Like, tell us a little bit more. I'm trying to get back into how did you get to this point?
So I got into the business in 86. So I've seen everything. I've seen 40 years. I've seen the world end and come back. I got in a year before the stock market crash of 87. So that was a real awakening. So I was always interested in, I was an economics major in college, and I was always interested in the stock market. I practiced law for a couple of years, and then I got into the business, and I've done a lot. I've just really enjoy doing research and writing investment strategy reports. So I've written them for 40 years. So I have I'm really, I'm more historical based. I like to look at historical patterns to see, because they repeat so much. So I have a real good sense of history going back to the 1800s about the financial markets. And so I use a lot of it, apply a lot of these historical patterns to today's markets. And things do change and you do adjust for that. But most of the time, it's not different. That old saying, it's different this time. So so I was very, very research intensive, do a lot of reading, multitude of research reports and economic reports. It takes a lot of work, and just have a real sense of history, and really, I would say that the biggest thing is just trying to not be influenced by other people. If I do my research, I try to pretend like I'm coming down from Mars and say, this looks like this, or this looks like that. And then I'll, see what it is in reality. And then I'm like, wow, that's so much different than what the status quo is today. I try not to be influenced by the status quo and not accept a lot of things that other people accept. So I tend to be skeptical of anything. In other words, I want to look and make sure that whatever people are saying is actually factually correct, and also intuitively is correct as far as their conclusion. So that's a big part, is just doubting everything, and working from there and trying to prove that that's my theory is correct, or whatever, my thesis.
Yeah, you're a data dog. Something hits the floor, you're sniffing it, getting ready to go.
Yeah. So, I've done a lot of, I do a lot of research, as I said, and a lot of long research investment strat. My reports are very detailed, so they can be cumbersome at times. So I try to, make sure I get the point across.
How many words are these research papers usually? Like general range, or I guess pages for people who don't look at the words?
They can be 10, 20,000 words. Yeah.
Really?
Yeah.
So you do go deep into your research.
Yeah. So I just did, in December, I did this massive research report because I wanted everybody to hear my views on almost everything in the financial markets. That's still on my website, and it's broken down into about 20 different categories. So if you want, you can just pick your own category if you want to review it. But I just want to make sure I got everything out to be on the record of what I thought at the time.
How is it holding up, your research, 4 or 5 months in?
You mean how there's everything I've said? A lot of it's
just from like the December letter.
A lot of it's coming true so far. So, it's more longer term. We'll see in the next couple of years. It's really more of a longer term strategy piece. I don't, we'll have to wait and see. So, yeah.
All right. Good. David, this has been a long, great conversation.
Yeah, it's long.
It's been a long, great conversation.
Appreciate it. I appreciate it.
I guess before we hop off, I found you because obviously people don't realize, if they listen to you speak, they've heard a lot of what's being said here, like your mannerisms are being put out in the media, but you're not popping out there. So your research papers are how people found you. How did you get connected with those people who do that? They just read your work and then just started.
So what happened is that I would send my research reports to Michael Santoli at CNBC,
Okay.
starting in like 2008. And he really liked the reports. And he started publishing my research he was working for Barron's then. And then he moved to CNBC like in 2015, I think. And he continued to write and also, cite a lot of my reports all the way through. So I became known on Barron's and CNBC for my investment strategy pieces. And then, of course, I had my first appearance on CNBC. I got it on December 30th of this past year. So he had always referred to me as the mystery broker. So it was kind of it was pretty cool. It was the unveiling of the mystery broker. Nobody knew my real name until that unveiling on CNBC. So that was pretty exciting and fun to do the unveiling. But yeah, as I said, he was he had written, I'd cited my reports all the way through. Became had a decent pretty big following.
So your good hard work came out. You just put it to the right people's hands, and they realized that was
Right.
good stuff. Yeah, I got David in here like, whew, he needs a drink of water. We're gonna hop up off here in a second, David. I guess let the Main Street audience know where they can find you, if they need anything, where they can get that research from, and then anything else you want to tell them before we hop off.
So if you need, my website, my firm is Journey One Advisors, and my website is Journey, the number one, not the number, Journey, the number one, advisors.com is my website, where you can find any information you want. There's some research reports. If you want to contact me, you can do it through the website, and we can go from there if you're interested.
Perfect. There you go.
You got Adam Parker, so
Yeah, Adam Parker. The podcast has been doing great, man. We've had a lot of really cool guests on here. I don't know if people realize, and we've done reports on like live reports from the war since it started happening. It's been really cool stuff for anyone who's popped on. But yeah, David, you have to come back on here.
Okay.
And also let me know when me and you can do a live session so we can hop on.
Okay.
But unless there's anything else you want to tell Main Street.
That's all. Let's wrap it up.
All right. Main Street Heart meets Wall Street Smarts. David Snyderall, the mystery broker. Thank you so much.
Thank you.
Guess what? The 2026 economic landscape does not end when this video concludes. It only deepens. As we've dissected today, from David Snyder's warning on the systematic risk of the AI bubble to the geopolitical frictions in the Strait of Hormuz, the era of passive index fund growth is reaching a structural limit. For the high net worth stewards, the family offices, and Main Street, who, the people who keep this country going, and the serious allocators, the mere exposure effect is no longer a psychological curiosity. It is a financial liability. You now possess some of the structural intelligence to navigate three of the pillars of this ongoing audit. Geopolitical intelligence. You have the maps of the friction points, Hormuz, Taiwan, and the energy bottlenecks that dictate global market stability. Macro structural audit, you understand that we're not tracking sentiment. We're tracking solvency, liquidity, and the shifting balance sheets of the central banks. Tactical wealth preservation. You have the baseline for rotating out of over-leveraged areas, assets, and into defensive areas. Maybe not out of stocks, but just into different areas. Check your allocations. That defines the survival for multi-generational wealth or for anyone who's just trying to make it to next month. Here are your next steps. Re-audit your own personal ledger. Review your current asset concentration. Is your exposure to these hyperscalers too much, or is it based on market hype rather than on operational yield? The More economy is in effect. We got a video on the More economy for anyone who wants to learn more about it. It's time to pivot to assets with tangible and properly sovereignty-backed utility. Optimize your stewardship. Your estate planning, trust derivatives, and tax efficiency strategies must be stress tested against the escalation scenarios we discussed. Your wealth structure was built for 2010 to 2020. Expansion is fundamentally misaligned for where we're at in 2026. And stay integrated. The macro realignment we tracked today is merely the first half in a long-term cycle. We're sitting in it. Don't let your capital sit idle as the structural tides turn. Feel free, if you want to check out more from me, check me out over on LinkedIn, Marcus Durbin Sr. over on LinkedIn, or you can check out my financial planning firm, theabcsquared.com. Guys over here on YouTube, Marcus Dermott Sr. And there you can find some of the latest specific articles. The Wall Street Journal South is on the LinkedIn, and archives of the War Report over there, the Wartime Capital Report, or on my LinkedIn or my YouTube channel, to provide some of the adjustments that you just aren't going to get from legacy media. What David spoke about today should be heard by millions of people. Will it? But it should. People need to understand what's happening in the world and just signals to look for. Subscribe to the newsletter, the Wall Street South Journal, and be prepared for the silent war that I just made. It's like a 3-hour compilation going back in the Wartime Report. I'm Marcus Dermott Sr. This is the Main Street Meets Wall Street podcast and airing on the YouTube channel as well. You have the blueprint, the framework, and some data. Allocate accordingly. Get to work. Main Street Heart meets Wall Street Smarts. Thanks for listening. Share this with someone you love, care about, or who just needs to hear it. Subscribe.
You know, what people need to filter out is what actually matters to me in my life. I like to say there's the economy, and then there's people's personal economy. And ultimately, people's personal economy is all that matters. You know, we hear about inflation and job loss numbers and the war in Iraq and gas prices and all these things. But ultimately, can I still retire? Can I still go out with friends on Friday night? Can I pay for my kids' soccer lessons? All the things that matter are in people's personal economy. And so what I tell people is, as an advisor, as an entrepreneur, you want to not just think about what the news is, but you want to be a news interpreter in terms of what does this news mean to your exact clients.
Era of the Fed Oracle is officially over. If you spent the last 5 years waiting for the Federal Reserve to tell you when to buy, when to sell, and what to expect next, you've been operating on a playbook that's currently being shredded in Washington. This week's FOMC meeting wasn't just another hold on interest rates. It was a regime change. Kevin Warsh has taken the podium and he's made one thing clear. The days of forward guidance, that crutch that markets use to build their entire risk-on mentality, are gone. Welcome back. Main Street meets Wall Street. I'm Marcus Dermott Sr. We're not here to guess. We're here to look at it. Today, we're going to do a deep dive into the 2026 economic landscape. We're going to play that clip that defines the new Kevin Warsh era, his first address, and then we're going to break down to see what it means for your money. We're living through this Hormuz paradox. We've seen it open, close. Now we're seeing bombs fly again, blockades. We've seen the price of crude spike. We've seen it come back down. We watched fertilizers and food supply chains get squeezed in real time. This is not transitory noise. This is structural. And it's hitting the American consumer right at the kitchen table. So we're going to jump from speculation to strategy. We're going to stress test those things just to think about what we're having at our home, in our home. This record U.S. sovereign debt, price to perfection tech market in our stock economy, and the current massive shift is maybe showing some underlying fragility. We're going to start right off with Kevin Warsh's full speech. Sit back, listen to what he says and what he doesn't say. Pay attention to the dot plots and know this is a different era coming in. I'm not saying it's good. I'm not saying it's bad. This is the information we need, Main Street, to help Main Street meets Wall Street. We're going to jump into the Warsh video.
Good day. It's an honor, a true honor, to be back at the Federal Reserve and to take up this duty at a time of such consequence. I've been especially heartened by the warm welcome of old friends and new colleagues both. And I've listened closely to my fellow FOMC members, heard a lot of new ideas, new thinking, and genuine interest in moving the Fed forward. This week's FOMC meeting exemplified the very best of the Fed's traditions: rigorous debate, open-mindedness, commitment to mission, responsibility, and accountability for performance. In this business, they all add up to one thing: getting monetary policy right, or as near to it as we can do. That is our North Star. My colleagues and I are here to serve our legislative remit, which you've heard us say before: price stability and maximum employment. And these objectives guided our business in the meeting just concluded. The appropriate federal funds rate to be at 3.8% at the end of this year, and 3.6 at the end of next. Let me turn now to a few words on a key initiative that we're announcing today. I'm appointing a task force in each of 5 areas that are central to the broad conduct of monetary policy. First, Fed communications. Second, the Fed's balance sheet. Third, our use and reliance on existing data sources. Fourth, productivity and jobs in an era of transformation. And last, inflation frameworks. These subjects are timely, consequential, and in my view, worthy of a fresh look. My colleagues and I discussed energy and purpose over the last couple of days. For each of these independent task forces, I'm enlisting some of the very best minds, both inside and outside the economics profession. They will be supported by subject matter specialists from our superb Fed staff. And they'll have a straightforward charge. Start with first principles. Ask hard questions. Examine current practice. Consider alternatives. And ultimately, propose next steps for policymaker consideration. Since last summer, my colleagues discussed possible improvements in the form and function of Fed communications. This new task force will build on that effort, and I expect propose some well-considered changes, including to the SEP I mentioned a few moments ago. The second task force, the one on balance sheet policy, will review the benefits and risks of the current ample reserves regime and the composition of the Fed's balance sheet. They will assess alternative frameworks for the conduct and operation of monetary policy. The third task force, the one on data, will evaluate new information sources and consider methodological changes to improve data gathering, with the aim of giving policymakers more accurate, relevant, contemporaneous, and perhaps most important, actionable information on the state of our economy. Fourth, task force on productivity and jobs. It'll survey the pace, the reach, the economic impact of new general purpose technologies, including AI, and explore the implications for the Fed in pursuit of our employment and inflation mandates. The last task force, the one on inflation frameworks, that'll examine the drivers of inflation, first principles, and weigh the full range of ideas for delivering price stability in a changing economy. You'll hear quite a bit about these task forces and this overall initiative in the coming weeks. Enough for now to make a simple statement. Each task force will serve an objective shared by everyone in the system, shared by everyone around that table that I sat with the last couple of days. A Federal Reserve that is clear-eyed about its mission, fit for purpose, and focused on the future. And with that, I appreciate your attention. I'm happy to take your questions.
Howard Schneider.
Once more with feeling. That was good. I think we got it.
Hi.
Oh, hey, dude. Wait, where's Esty? I'm here.
Hi.
Hi. Are you coming over? I'm gonna need 20.
Okay.
Okay, I love you.
Love you.
Bye.
Oh, goodness. Where's my phone? Where's my hand?
Sorry.
Oh, cute skirt. Thanks. You ready?
Ready?
Ready. Good?
Yeah.
Hi, Chairman Howard Schneider with Rotary. Good to see you again, and welcome back. This is a lot to be putting in motion so fast. What is the timeline you have in mind for each of these?
So I think it'll depend on the task force. It also depends on the urgency in which we need clear answers. My expectation, I'm still in the business of recruiting and finalizing them. My expectation is the task forces will begin work in the next couple of weeks, and we'll start to get some more information from them, some more framing of how they see things starting in the fall, and hopefully most, if not all of them, concluding by year end.
And just specifically on the inflation framework, you talk about first principles. Does this include a review of the 2% target itself? You mentioned that things to the right of the decimal point don't matter. Should this be starting from a premise that 2% as a point estimate is too strict?
Let me break it into two pieces. First, on the inflation framework review, their remit is what are the drivers of inflation? What's the Fed's responsibility for inflation? In part, how do we measure inflation? But that'll overlap with my data group. On the 2% inflation objective, that is the Federal Reserve's long-held objective of 2%. You've heard me say before, I tend to focus on the left of the decimal point. Well, the 2 is the left of the decimal point. For now, 0. I see no reason until we have reestablished our commitment and ability to deliver on the 2% inflation objective to revisit that outside the scope of what we're taking on.
Colby.
Thank you so much. Colby Swift from the New York Times. In the past said that inflation is a choice, and in the policy statement, it includes this pledge to deliver price stability, as you've reiterated today. But looking at the SEP, the bulk of your colleagues expect core PCE to run around 3.3% by year end, and for the 2% inflation target not to be reached until 2028. So I'm curious how patient you think the Fed can afford to be at this juncture in terms of waiting for one-time inflation waves to wash through and for underlying inflation to step down after so many years of inflation running above target, and under what circumstances you would support the Fed taking some action and raising rates.
Sure. So quite a bit there. Let me try to break that into pieces. First, we have the capability and commitment to deliver on our price stability objective of 2%. That's exactly what we're going to do.
I grew up working on this farm. Friday was football. Sunday was church. We looked out for each other. Go after insurance companies denying you treatment and ripping you off. It's time to get it done.
For 25 years, the people of Firestone have been building products and services with one thing in mind, to make sure
that in the Fed's review of its strategy over the last any number of years, in January, the Fed, including the strategy that we're still bound by, the Fed statement says that inflation is primarily determined by monetary policy. You bet it is. I've said for years, inflation is a choice. You bet it is. And today I'm announcing that this committee unambiguously and unanimously have decided we are going to deliver on that. The rest of your questions sounded like a encouragement for me to give forward guidance. We've dropped forward guidance. Some along the committee, I think, dropped it, I suspect, from our discussion the last couple of days, because they said at this moment in time, it doesn't feel as though providing forward guidance is right. Others have, I'd say, different views and think as a general proposition, forward guidance isn't the business we should be in. But that'll be taken up by the task force on communications and my policymaker colleagues. We're going to listen hard to what the experts say and make our own decision. But I can't give any forward guidance about what we're going to do next. The good news is we'll be meeting in 6 weeks.
So just following up, I guess, on the current policy settings, then I am curious how restrictive you think things are at the current moment, given the flow of data that we've seen and, forecasts that are coming down the pipeline.
I've heard characterizations both inside and the Fed about, give you my own, it's uneven. If I look at the housing markets as one example, Fed policy isn't the single determinant of the state of the housing market, but broadly I would say Fed policy appears to be somewhat restrictive. I would have a hard time managing to say those words if I were to see what's happening in financial markets. So I'd say it's uneven. That's perhaps a function of different transmission mechanisms of monetary policy, whether monetary policy is coming from our interest rate tool or our balance sheet tool. But the good news, we have a task force on that too, and the balance sheet task force will be looking more at that subject.
You said you don't like forward guidance. You dropped it from the statement this time, but with the dot plot, 9 members suggested that they want a rate increase by the end of the year, and the markets have taken that as forward guidance. So what does this mean in terms of how you guide the markets and in terms of...
I grew up working on this farm. Friday was football. Sunday was church. We looked out for each other. So I'll go after insurance companies denying you treatment, ripping you off. It's time to get it done.
Sometimes their timing can be a bit rough. That's why Urgent Vet offers after-hours pet care open every single day. Get answers and get back to life. Urgent Vet, your pet can't wait to feel better.
what the dot plot's future is.
I'm going to have to give you the same answer I gave to Ms. Smith. We've got a task force for that. I'll give you a little bit more. I reviewed the dot plots, and when I saw the submissions, I noted that all the submissions were coming in with pencils, you know, those kind with the big erasers. That's to say that I think my colleagues around the table, when they submitted their dots, understand the world is changing quite quickly. And they didn't feel bound by them 6 weeks from now or 6 days from now in the event that their circumstances change. I'll note a couple other things. What I heard around the table was, as they submitted their modal forecasts, to be clear, weren't, this was more likely than not. This was more likely than their other scenarios. So I didn't hear tons of conviction. What I heard was the kind of humility that I think we should have. I did not submit a dot. For me, it's not helpful in the conduct of policy. I suspect by year end, as I mentioned in my opening statements, there'll be a review about communications broadly, press conferences, dots, meetings and the like, transcripts, minutes. This will be part of that. I don't want to prejudge the outcomes there, but I'm pretty open-minded about what they could be. And I was just incredibly impressed over the last couple of days. My colleagues over the last 2 days, and frankly, over the first 3 weeks I've been here, they've been very open about changes. Change isn't easy, change is filled with risk, but our number one goal is to get monetary policy right. The way to get monetary policy right is to deliver on the remit that Congress gave us, to deliver on price stability. And there was no disagreement on any of those points.
At the risk of possibly getting the same answer about task forces, communications, what is your feeling about these news conferences? Are you going to continue one after every meeting? Do you find them useful? What is the future for the way Kevin Warsh will communicate?
Well, this one's probably got another 15 or 20 minutes in it, so I don't want to prejudge the outcome. Press conferences can be a very useful way to communicate with households, businesses, and more broadly, through using the likes of you. I had a great old mentor named George Schultz, and his mantra was press conferences are useful, but when you have one, you want to make sure you have something important to say. Today, I think we had something important to say about our commitment to deliver on price stability, our commitment to rethink practices with an eye of moving the Fed forward, and to give you and the American people a sense that these aren't idle thoughts, these are concrete thoughts, that we're going to seek out the best minds, both the best thinking inside of the Federal Reserve and the best people I know in business and economics and the academy and technology and the rest, to share their views. That's what we're going to be doing here, the pursuit of truth. I think we're going to come up with some new and interesting things. We made some changes today. I expect more changes to come. And some of those might well be worthy of a press conference.
Chris, your favorite.
I grew up working on this farm. Friday was football. Sunday was church. We looked out for each other. So I'll go after insurance companies denying you treatment, ripping you off. It's time to get it done.
For 125 years, the people of Firestone have been building products and services with one thing in mind: to make sure you get to where you need to be.
Hi, Chris Rugaber at Associated Press. Thanks for taking our questions. Could you give us a sense of how you see inflation more in the long term? I know you may not want to comment on the ups and downs, but is this mainly driven by energy prices in the Iran war at this point, or do you have any concerns about underlying inflation pressures in the economy? Thank you.
So I can't do much better than the committee just did. So let me restate it. Inflation remains elevated relative to the committee's 2% goal, in part reflecting supply shocks that have driven price increases in certain sectors, including energy. The paragraph goes on to say, but to be clear, the Fed will deliver price stability. My own judgment is the committee spent quite a bit of time, not just in 2 days, but over iterations of a couple of weeks. That's what we're prepared to say about inflation, but the commitment to deliver is strong, unanimous, and unambiguous. And that's, I think, an important message. We've missed for 5 years, and we're going to fix that.
Well, great. And then just on the data task force and everything else, I mean, generally speaking, I think people feel the Fed looks at everything already. Certainly that was the sense from before. Is there data that you feel is not given enough weight? I mean, you mentioned the trim to mean in the past, but again, that's well known to certainly most Fed members. So what is that task force looking at, and what might be I mean, I know you don't want to prejudge the outcome, but are there examples of data that you expect might be given more weight? Thank you.
So you're answering my question. So let me say, I don't want to prejudge the outcome. I also don't want to say too much about what they're going to do, because I still have a phone call or two to make before I've nailed down the people that are doing that. I'm interested in what the outside experts' view is on the subject. I'll say this generally. Most of the data that central bankers and other government officials in the United States consume come with old-fashioned survey methods, a national accounts of what the U.S. economy looks like that looks very little like the U.S. economy in 2026. Survey methods that don't have response rates that we need, asking questions that might have been quite applicable a generation ago that are less applicable now. So even inside of official statistics, I would be open-minded if the task force and our own best thinking had recommendations how those official statistics can be brought up to a standard of our time using new analytic methods. I'd also say this: almost every private company CEO that's running his or her business are doing so with real-time information that isn't subject to much revision, that is telling them what just happened at that very moment. As you know, there are normal, long and variable lags in the conduct of monetary policy. What we're really interested in is what's happening right now. What we're less interested in is echoes of history. And you're hearing from my answer that some of the data that we receive, that we're waiting on, the first Friday after the month, the payroll index or something else, that might be an echo of history that's quite useful on its third revision. We need to take those error bounds down because we have to make hard decisions in real time. I'm really open-minded that there is a lot of new data sources that we can learn from the private sector, from reforms in the official sector, and new analytic techniques that are far more refined than asking a simple question about whether something was core or non-core.
A new era of American shipbuilding is here. When you hate your job, you get bored. When you're bored, you shop online. When you shop online, you buy taxidermy squirrels. When you buy taxidermy squirrels, hacks happen. When hacks happen,
What the
your data gets leaked. When your data gets leaked, Ron steals your identity. When Ron steals your identity, he takes everything. Don't let Ron take your taxidermy. Protect your identity with Cloak.
Thanks. Welcome, Mr. Chairman. Edward Lawrence with Fox Business. So if you don't give a lot of ongoing forward guidance, won't the markets have more volatility, and shouldn't Americans have more access into what you're thinking going forward?
So I think financial markets perform best when they react to incoming data. I think the financial markets work less efficiently when they ask a question, how will the Federal Reserve react to that incoming information? The more that markets are paying attention to what's happening in the real economy, deciding what's good data and what's less good data, the more financial markets can price what they believe is the most likely and what are the tail risks. Financial market prices are probably the most important source of information to guide central bankers. But when all the financial markets are doing is reflecting back what we've said, then we're taking the most important source of information and we're being blind to it. I'd like us to create a system where those blinders come off, where markets are following data that they efficiently think is reliable, and they'll be watching data, we'll be watching data. They'll come with better information through market prices to us. We can make more informed decisions. But ultimately, the goal that I said at the outset, deliver on the price stability objective that Congress told us to do, and that we've got to get in the business of doing.
Yeah, if I could take you in the meeting a little bit. It's your first meeting. The board members seem fairly hawkish when you listen to, in general, when you listen to what they're saying. Was there any discussion of a rate cut going forward today?
There was one proposal on the table. There was no discussion of any other proposals. The discussion on that proposal, I would say, was quite limited. The group was unanimous and unambiguous on it. It has been the practice of this central bank and others to have a range of alternatives. Today we had one. I thought it furthered discussion, deepened it, and made it clear what we needed to do and how we needed to deliver. I wouldn't prejudge what happens in the future, but there was only one big subject for us. We took it on. We had a good family fight on it for a couple of days, and we ended up, I think, in a better place.
Claire.
I grew up working on this farm. We looked out for each other. So I'll go after insurance companies ripping you off.
For the moments that can't wait, but don't need the emergency vet, Urgent Vet is here.
I'm so glad we came here instead of the emergency vet.
It's urgent, but it's not life-threatening. That's what we're here for.
Urgent Vet.
Thanks a lot, Claire Jones, Financial Times. Coming to this blind, reading this very nice short statement that I think we've all appreciated in the room, one might wonder why you didn't raise rates today, considering what you're saying here about the risks to US inflation and your mandate. I guess, why not, and what would you need to see in order to get to that place? And secondly, on your task forces, are there any best practices at other central banks that you'd consider looking at? Thank you.
Yeah, I'm glad they're in the practice of giving you two questions, because my answer to your first question was to be very curt. I've got nothing more to say than the statement itself. And to the point of the question I got before, market reactions to what we say unfiltered, I think is more helpful than having delivered a statement, me then improvising further upon it. Best practices of task forces. This is a subject I've thought some about. I've been on a task force or two in my life. Best practice, find the best minds. Ensure that the task forces have a range of people, both by backgrounds and predispositions, so they too can have a bit of a family fight. Make sure when you establish a task force that the group that's going to be the recipient of the information feels as though they've got some equities in it too. That's why we're looking for, haven't done the final roll call, some of the most significant talent we have in the building and across the reserve banks on each of these, and in some sense seconding them to this group for a period of some number of months. so that the leaders of the task force know what the most analytical central bank in the world thinks about that. They can reflect on it. And a final best practice, we're not outsourcing decisions to anybody. Administrations past and present, reserve banks have chosen a group of 19 people around the table. These will be our decisions. We can agree to some of the recommendations, disagree with others, have a good family fight about it. But what comes from them will, I hope and believe, make the discussion we have internally better, stronger, more of a dialectic, so that we can finally deliver on that price stability objective.
Just a quick follow-up on your markets point. If you look at 2-year yields, they're really suggesting that markets think more tightening is needed. Would that be your read on what the 2-year yield is saying as well?
We were in such a good place. This is why we don't do third questions, I presume. I'm not going to offer any commentary on market reaction over the last 30 or 60 minutes. What we've given markets is a new chapter for the central bank, some fresh thinking. What we've given markets and households and businesses, I think, is a commitment to ask ourselves hard questions such that we can deliver on the promises that we've made before. This is a lot of change for financial markets to digest. I wouldn't be particularly intrigued by how they react in the first several minutes or even first several days. What I think is most important is that financial markets, and at least as important, households and businesses know that this central bank will deliver on price stability.
Brian.
I grew up working on this farm. Friday was football. Sunday was church. We looked out for each other. So I'll go after insurance companies denying you treatment, ripping you off. It's time to get it done.
Yes, we know it's political season with all these
Brian
ads.
Chung with NBC News. Thank you for taking our questions. So when you say that we've dropped forward guidance for the layperson, that might sound like the Fed's going to say less or offer less insight into where their borrowing costs might go. So for the person that maybe you might run into at the grocery store, where the price tags are rising at a faster pace than their wages at the moment, how would you explain it to them? I don't know if task force might be the answer there, but how would you kind of communicate this era, this chapter of the Fed?
If I told somebody in the milk aisle that I had a task force for that, I think that would be doing a very poor job. So I appreciate it. If I saw somebody in the grocery store, what I would say to them is that we cannot have a very significant effect on particular prices. The price of oil in the markets today, or even the price of a dozen eggs, that does not have first order consequences to what we're doing. But we do have a really important job there. And it's to make sure that those changes in oil or beef or eggs or milk don't broaden in the economy, don't have second and third order effects. That's our job. That's our commitment. That's our capability. And we're going to deliver on it.
And then is the Fed's relationship with the Treasury also under review? There was the normal breakfast meetings with the Treasury Secretary. Is that something you intend to continue doing? And have you had conversations with the president since you're swearing in?
So on the president, I don't have anything for you. With respect to the Treasury Secretary, he has been posting pictures of our breakfast. So I don't think I can deny that. The long tradition at the central bank is that the Fed chairman and the Treasury Secretary meet weekly. I think we've pulled off 3 of those so far. I believe he's overseas this week, so this will be the exception to the rule. I think they're very useful discussions. The central bank's objectives and our roles and responsibilities are quite delineated from the fiscal authorities. And in my view, monetary policy is independent in the conduct of what we do. But that doesn't mean we're not interested in what's happening with the fiscal authorities. The way I think about it is this central bank needs to have a wide lens, but a narrow remit. We need to be quite interested in what's happening in the world. I won't be breaking any news here to suggest I'm quite interested in what's happening in the Middle East. That does have some effect on our day job. It doesn't mean it's our responsibility, but I think we're going to keep a wide lens, and my meetings with Secretary Besson to this point have helped widen that aperture. So we're aware of things that could affect our day job, even if it isn't.
Steve.
Every day I find people to talk to. I didn't have that at home. That's the value of holiday.
Fans pay more attention than me when I hear my own song come on. Imagine advertising to that audience.
Steve Leisman, CNBC. Mr. Chair, thank you, Mr. Chairman. Thank you for taking my question. You had said in the before you became chairman that you thought productivity was a reason why the Federal Reserve could lower interest rates. Do you still believe that to be the case?
So the committee had a discussion of productivity today. AI came up. The way I thought about it before and socialized with the group is that artificial intelligence, the latest generation of general purpose technology, is perhaps as important a change in the economy and business and households that we've had in my adult lifetime. It is filled with both a huge opportunity and with risks. I take both of those very seriously. You may have heard me say before that AI is shorthand perhaps for American ingenuity. That doesn't mean that it's going to be easy. That certainly doesn't mean it's not going to be disruptive. But over the long term, my conviction, and I heard quite a bit of support for this around the committee today, is the United States is a winner as we go down this. The United States is ultimately going to be better off in that. Now, to bring that back to the conduct of policy, timing, scale, speed, implications for output and employment, it's one of the things we have a task force to do.
If you don't mind, a follow-up from the other side, which is that when you look at the strong job growth that's out there, the elevated inflation, GDP seems to be going pretty good, and the stock market seems to be soaring. Do you look around this economy and see the funds rate being restrictive?
So that's your second question. I'm going to give the same answer that I gave before. I'd say as I think about the conduct of policy, what matters is what's the effect of policy. Not what do we say, but what happens. And the best way I can describe it is it's uneven. I do see some restrictiveness in things like housing. It's hard to use those same words anywhere else. I'll just make one other point. You talked about one of our dual mandates in the employment side. I don't believe that we have a cruel choice. I don't share the view that was expressed a few generations ago that Federal Reserve chairmen show up at a podium like this and say, you got to choose. And you're going to have to decide whether you're willing to tolerate.
I grew up working on this farm. We looked out for each other. So I'll go after insurance companies ripping you off.
For 125 years, the people of Firestone have been building products and services with one thing in mind, to make sure you
higher inflation to put more people at work. I don't believe in that. What I believe is if we do our job, we can make strong growth, low prices, and strong employment mutually compatible. And so what you heard from the committee today is we've got some work to do on the price stability front.
Nick.
Thank you, Nick Timmeros with Wall Street Journal. Chairman Warsh, you've said repeatedly credibility is earned by delivering. If credibility requires delivering, the move would be to tighten or at least to threaten to. Now, you didn't do that today. Why not?
That judgment you expressed was not expressed by any of the 19 people around the table. We'll be meeting in 6 weeks. We'll take up the issue again.
And if I could ask about AI, the build out is generating enormous demand right now, CapEx, data centers, power. The productivity payoff may be further out. So in your judgment today, is AI adding more to demand or to supply?
It's a good question. At the central bank in an economics profession, what we spend most of our time doing is counting demand. It's easier. We can see it, we can count it, we can check it, we can revise it. What we do, though, is we infer supply. You'll notice in the second paragraph of what one of your colleagues described as a very short statement, we have a sentence on the demand side and a sentence about the same length on the supply side. They're both important. Just because we can count one better than the other doesn't mean we're going to favor one more than the other. With respect to AI and the growth of data centers and infrastructure around it, we're counting the demand side, and it is no doubt showing up in GDP figures. We can be less certain when we infer the timing and extent of the growth in the supply side. It may well be an intuition the supply side is going to expand, but it'll take longer. And just describe it this way. There's a race between supply and demand. Milton Friedman says that the only thing we know about economics is that there's a supply line and a demand line they ultimately cross. When they cross and what are the implications for policy? The good news for you is we have a task force for that.
Andrew.
Thanks, Mr. Chairman.
I grew up working on this farm. Friday was football. Sunday was church. We looked out for each other. So I'll go after insurance companies denying you treatment, ripping you off. It's time to get it done.
A new era of American shipbuilding is here.
It sounded like on the task force on data that you were looking at overhauling or completely overhauling the system of national accounts, the way the government mines the economy. Is that your ambition?
In a word, no. In a few words, much of this data gathering happens in other government agencies to which we owe a tremendous amount of respect, tremendous amount of deference. But if in the course of this, we come up with recommendations, which Fed staff have already begun to develop about things that they could be doing to help inform us as policymakers, we're not going to hesitate. Again, I don't want to try to delineate the four corners of the research of the task force on data, but I do think there will be a review of official statistics, and at least as important, a view of bringing the best practices from the private sector and new analytical tools made possible by AI so we can forge these into a fabric that gives us better real-time information. So as I mentioned before, when we're making decisions that we'd say are real contemporaneous data, not data that we call contemporaneous, that's really an echo of history.
Okay, thanks. The other question I wanted to ask is related to the building renovations. Are you considering any changes to the renovations, the projects, just in light of the fact that they became kind of a political football in the last year?
I heard something about that. I don't think I'm breaking any news, but my view, when you show up at a new institution, you should go meet with the inspector general, just as a matter of good practice. It's a practice that I hope to continue. I've had one meeting with the inspector general, and he told me what I believe the world knows, which he'll be coming out with a report on the building and the building projects at some point later this summer. And I'll be interested in reading the report. From my perspective, with a forward-looking glance, is there anything that we can be doing or should be doing from this moment until the completion of the project to do what we can to be good stewards of taxpayer money and make sure that we're delivering on the promises that we made? Some more work to do. You might not be surprised in the first few weeks. I've been somewhat preoccupied on other matters, but I promised to get to the full breadth of the Fed's tasks in the weeks ahead.
Victoria.
I grew up working on this farm. Friday was football. Sunday was church. We looked out for each other. So I'll go after insurance companies denying you treatment, ripping you off. It's time to get it done.
Hi, Victoria Guida with Politico. So I know that you did not submit a forecast, but you are the person who is authorized to speak on behalf of the FOMC. So I'm wondering if you could tell us in the SEP, the increase in the expectations for inflation, is that all because of the Iran war? What was the discussion around what would the expectations for inflation being higher and also potentially growth being slower?
So my read of what I heard in the room reflected, I must admit, in the SEPs, is half of my colleagues thought the policy rate, given all those developments, should be at this level or lower between now and year end, and the other half thought higher. That 19th voter was me, and I didn't submit one. There's a range of views on the questions of first and second round effects, no resolution or conviction, but we'll be meeting again in 6 weeks. I think we're going to know more then. And I think that my colleagues are very attentive to incoming developments between now and then.
And can I just quick follow up on the SEP? You said that you're still encouraging your fellow committee members to submit forecasts even if you're not doing it. So what do you think is the benefit of them doing it even if you don't?
That's the commitment that the FOMC made, and it's a commitment that I hope we live up to. Commitment we made was to deliver price stability. I expect us to live up to it. By the time we get to the end of this year, as I mentioned, I wouldn't be surprised if there was a new communications framework, there were some changes to the SEP. That's a committee discussion, a robust discussion. I think we'll have it. I believe we're going to come to a better mix of communications to deliver on what we promised, but I won't want to prejudge what those are. But between now and then, I would continue to expect colleagues to submit their SEPs. Some of them, I think, believe that the practice is currently structured is okay, but I heard a lot of interest in real reform, generally about all these topics. You didn't ask it, but I'll answer. It was a pretty gracious couple of days, and it's been a pretty warm few weeks.
I grew up working on this farm. We looked out for each other. So I'll go after insurance companies ripping you off.
Yeah, turns out it's non-melanoma skin cancer. And my doctor says most surgery is my only option.
The institution wants to figure out how we can do better. The institution's going back to first principles. And I'm encouraged that what we've done in the statement, what we're thinking about doing with respect to the SEP, that instinct towards a new chapter is a real one. And by the end of the year, I hope we can put some points on the board, both in form and in substance of delivering.
Going to end up for the last question.
Thank you, Mr. Chairman. Andy Curran, Bloomberg News. Could you guide us through, please, some of the principles that guide your own reaction function, and tell us a little bit about the kind of conditions that you think when the Fed should respond?
It's going to be a very unsatisfactory answer to the final question. The Federal Reserve has a lot of responsibilities, not just in monetary policy, but in supervision and regulation, consumer affairs and payments. My own view is our credibility comes from delivering on what we're saying we're going to do across everything we do. I've devoted more time in my first 3 weeks to monetary policy than all those things. But the more we deliver on our promises as good supervisors and good regulators, the more benefit we get, the more credibility enhancement we have in monetary policy. When we deliver on our price stability objectives, which we will, the American people, as though the hardships that they've been living through in part because of inflation in the last 5 years are in the rear view mirror, and that credibility will have dividends across what we do, and the institution will come to press conferences like this, always with an impetus to reform, always with an impetus to do better, but we're going to put some points on the board.
And Mr. Chairman, that's strong labour data in recent months. How would you sum up the labour market right now? Do you see it as stable and as potentially a source of inflation? Thank you.
Yeah, so the committee, if I were to try to capture how the committee thought about it, the committee thought that the labor markets were stable. There were some people around the committee who thought that it was trending better than that. Trends matter more than data points. What's happening over 3 or 6 months matters more than any one data point, any one data release. And I'd say the jobs data has been moving in a good direction. If I heard one other thing around that subject over the course of the last couple of days, what I heard was that strong productivity-led growth is not something that we fear, but something we embrace. Thank you all very much.
And there you have it, straight from Kevin Warsh's mouth. It's the first week of Warsh's speech. SpaceX's at IPO's first full week of trading. Kevin Warsh didn't just change the post-meeting statement. He launched a quiet revolution inside the central bank to fundamentally rebuild the Federal Reserve from first principles. Warsh announced 5 independent task forces. These aren't standard committees. They're a mixed group of internal Fed staffers and external experts tasked with tearing down and rebuilding how the Fed operates. Are they going to have strict deadlines to deliver a complete strategic framework by the end of 2026? That's the goal. But this isn't a slow transition. It's a corporate-style restructuring of the world's most powerful economic institution. Let's take a second just to think about some of the areas that Chairman Warsh introduced. Fed communications is one of the task force. So the first and most immediate goal is Fed communication. For years, the market hung on every syllable of Fed's forward guidance. Warsh wants that dead. This task force is reviewing whether to permanently scrap the famously quarterly dot plot, which Warsh did not participate in, and eliminate routine post-meeting press conferences entirely. The philosophy here is profound. Warsh believes that by telling the markets exactly what the Fed will do, the Fed accidentally blinds itself. If the Fed stops guiding the market prices will finally reflect true economic reality again, serving as an unmanipulated data feed back to the central bank. So he's pushing the onus from the bank to send a signal, and the bank is now receiving the signal from the market, I guess is a better way of saying that, right? He also pushes on how the Fed uses backwards looking data, lagging data. So that's one of the task force. Next, he's focusing on the Fed balance sheet. The Fed's multi-trillion-dollar balance sheet. Over the last 2 decades, the central bank became the world's largest buyer of bonds. The second task force is conducting an aggressive top-to-bottom audit of asset management. Because this study is locked into a year-long timeline running through late 2026, it sends a massive signal to Wall Street. Don't expect any sudden near-term changes to the Fed's bond portfolio, although Warsh has started making moves to reduce it. Any structural shifts are a long way away, giving the market a predictable, quiet runway while the deep work happens behind closed doors. Third task force, or another task force, tracks a flaw that has plagued the Fed for years: lagging data. The central bank has historically relied on backwards-looking macro indicators to make real-time policy choices. Warsh's data task force is reassuring the Fed's entire information pipeline. They're auditing whether traditional metrics are still accurately capturing the speed of modern economies, or if the Fed needs to build entirely new high-frequency data pipelines to avoid driving the economy looking strictly through the rearview mirror. AI productivity and inflation. So the last 2 task forces prepare the Fed for a radically different future. One focuses on productivity and jobs in the transformative era, and specifically built to study how artificial intelligence and automation are how artificial intelligence and automation are altering the labor market. Warsh recognizes that AI could massively spike productivity while shifting employment dramatically, throwing out old Fed models out the window. Meanwhile, Task Force 5 is reevaluating the inflation framework. It's examining whether the Fed's legacy tools are actually effective at maintaining absolute price stability, and in the new tech-driven era, ensuring the Fed isn't fighting tomorrow's inflation with yesterday's playbook. Another thing to note is that new Chairman Warsh only focused on one side. He's focused on price stability a lot, not so much on labor participation. He mentioned a lot or several times that his focus is on the left side of the decimal. When he says that, means he's focused on that number 2, 3, 4, whatever the headline. I shouldn't say headline because that's a different type of inflation. But whatever the number is, whether it's headline or core inflation, whether it's 2, 3, or 4, not so much on the numbers after that decimal point, which people often should count as well. I mean, that's a big percentage if you take that whole percentage out. But he's also just showing his shift in the way the Fed is looking and the Fed is moving. So one thing about it, two things for sure. Kevin Warsh came in and put his stamp on this Fed. He put his name there. He put his initiatives there. Two things about it, though, is this is still a committee. So there are a lot of different groups and ideologies inside this Fed. The Fed is also elected. They're not elected, they're appointed, but they're appointed by officials who are elected by the people. It was interesting, all of the political campaigns that played in that video from Fox Business that were for a Democrat, Roy Cooper. They did target it right, though, because I was in North Carolina, so they targeted the right area. But it's interesting, there weren't any other videos. It was all from one side, and it was on a different network. So I don't know, but it's that time of year again where the political ads are coming out. So the inflation target is a big thing that we should think about as well. Inflation hinges a lot where we are, where prices go, cost of living when it comes to that later, and the cost of living adjustment later in the year. It's based on PC, I believe, if I remember correctly, personal consumer expenditures index, that type of inflation. But the 2% target that he mentioned, and that may not be 2.0, it might be 2 point whatever, what he pointed to on the other side of the ledger. And you could see, actually, if the price of oil comes down with the war from where it was versus months ago, you could see an inflation target or an inflation number come out with one of these reports a few months out with a 2 at the front of it or a low 3. We've seen some high 2s, but it's just the Fed has stated this goal for 5 years of 2% inflation. They really haven't met it. But Warsh said they were unanimous in their decisions on the board that they can reach that goal and that they wouldn't change the goal. That was one of the things that perhaps we didn't know if he would come in and change the goal, change the Fed target for where they were trying to reach. Maybe raise it up to 3% with this increased productivity, this increased GDP expectations. This is from America. The world GDP, the International Monetary Fund lowered global GDP expectations down a little bit here recently, but there's a detox going on, so we'll see if this new productivity, we need wage growth to catch up to inflation. That's a big thing that's hurting consumers right now, is wage growth is not catching up or holding pace with the consumer. So what you see inside of that is a struggle to purchase. You see your purchasing power actually decreasing every day you see it going down. But we've seen prices at the pump come down here recently. We've seen prices at the pump come down. We've seen some food prices come down. We've seen inflation. Inflation's sticky, though. We saw a 6 handle last inflation print. That's a big number. That can be scary when you look at it, but that wasn't totally unexpected given that oil and gas prices, when the war started, that data is just starting to feed through, were in the high 60s and they doubled pretty much. So you got to think about that when it plays into inflation. Inflation almost doubled. There are a lot of things that go into oil. You have fertilizer, that's a big thing, which plays into food, and it just plays all through the supply chain, the increased cost of transporting goods. And we saw that 6 handle on the producer price index. So we see that it's being passed on to the producers, the consumer. The CPI was lower, consumer price index. So that means it hasn't been passed on consumers yet as high. It'll be interesting to see what this recent reading comes up to say. Because with inside of that, we'll see if more of this pricing pressure has been passed on to the consumer, or if the producer is still absorbing most of it, or if we just saying some of this inflation is leaving at this point. I don't know. Inflation's sticky, and that's one of the things they're focusing on over there with Chairman Warsh is the inflation. We saw a struggle it's not a struggle. We saw that employment was still strong, above expectations, employment and job growth with the last numbers that we saw come out. So inflation seems to be a sticking point for Chairman Warsh. Like I said, he didn't even really mention the other side of the dual mandate. A big thing that he also mentioned, not always, but a big thing that he also mentioned was the fact that the Fed is probably going to reduce forward guidance. I mean, he definitely wants less Fed speak. But I don't know if you realize, if he reduces forward guidance, and this is just thinking out loud, if he reduces forward guidance in the amount of time that the Fed speak, that the words that they do say will have far more impact on moving the markets. He can't restrict the governors from speaking. He can try to influence them to speak less, but they're all independent governors of their own banks, and their districts, so they can speak. It's just he's trying to reduce the level of communications, as I mentioned earlier, because he wants the markets to move on market structures and pricing, earnings, costs versus what the Fed is saying, where the Fed's chasing. The markets have been chasing 2% inflation targets and setting their expectation of 2% inflation targets. And the Fed clearly has been not able to reach that goal. Although it would be hard to say that Jerome Powell did not pull off a soft landing. It's left to be seen, but we'll see. He flew up into some bumpy turbulence when inflation was at 40-year highs, but we'll see how history plays out with that. Also notice that Jerome Powell's still on that board and still a voting member, if I remember correctly. So they're going moving away from the dot plot. So those are just economic forecasts from each Fed governor. They put them on a chart, a little plot, dot on a plot chart. So they're Warsh wants to do away with that. All the other governors voted. I think there were 9 and 9. He did not vote. 9 whether to lower inflation or raise inflation in the future, where they saw inflation heading. He did not vote. He would have been the deciding vote. I don't think it would have changed anything. They all decided to keep inflation or keep rates paused. They weren't raising or hiking inflation. He said that in 6 weeks they'll have a lot more information, a lot more data. I guess he's getting these task force going. Some of the things that to note with the task force, he mentioned he was looking for strong minds, experts. He's looking for diverse opinions, people who can have, he kept mentioning family arguments, strong family disagreements. So he's looking for some consternation inside these areas but good consternation, good, healthy conflict and verbose discussions hopefully will come from this. And hopefully all this benefits the American people. This is Warsh's first meeting, so we have to give him the benefit of the doubt. I mean, President Trump spoke but President Trump has a lot going on with the war right now. We had the peace agreement that was signed, the memorandum, but bombs have started flying again since then, or missiles or something. They've started shooting again at each other over there. We've started engaging things. I think Strait of Hormuz has been blocked again. So we saw some traffic coming out of there. It'll be interesting to see where that leads with the economy and data going forward. And we'll see what Monday and the rest of the week looks like. But it could be a bumpy one going ahead, which is a thing that you should note also historically. And I digress a bit, but that the markets, and I've said this before, the markets will probably be choppy and volatile going up into the midterms. And this is historically, and then once you get to the midterms, we have a little clarity into who the elected officials are into the end of the year, even into the beginning of next year. We should see the markets explode up and back to the right. Hopefully too much damage has not been done until that time. I mean, we have to remember markets are all-time highs. But another thing to note is that when Chairman Warsh spoke on Wednesday, I think the market had the largest decrease ever after the first chairman's meeting ever. But like he said, he's not really watching what the market's doing in the first few 30 minutes, hours, or even days after he makes his speech. He understands. Another thing to know is that Fed chairmen are usually tested. So they're usually tested by the markets or some abnormal event. Chairman Powell, when he came in, that was right around when COVID hit, so that was one of his tests. I think if you go back to the 80s, we had the Wall Street crash, but that was all set up from running the economy hot, a lot of productivity, growth, and gains. That was also a K-shaped economy like we're seeing right now. So a lot of parallels to when the 80s took off to when the 2000 or the 90s to the 2000 boom took off, the dot-com boom. So there's a lot going on. Are we on a 17-year bull run that started at the end of the 2008 market crash? That's to be seen. There are people who think that this market is about to pop and the bubble's going to blow anytime. And there are people who think this thing can continue to grow until the end of the year or to the end of the decade. So you just have to be positioned, know where you're at. Don't jump out of the market right now or anything, because you have missed a ton of gains if you jumped out of the market. You have to stay invested in the market. You just have to know if you want to be more risk on, and if you want to have more exposure to stocks, or if you want to be a little bit safer, but you need some exposure to stocks, because historically stocks are one of the few things that have beaten inflation, like price participation. So when I say like your cash is literally losing money or losing productivity, think about the example here where we're talking about inflation and inflation target, or people who are on fixed expenses from like COLA adjustment, cost of living adjustments that you get. Where it was set last year, I believe in the 3s, and then we saw inflation like the next print was much higher than that. So those people are losing already when inflation is higher than their cost of living adjustment. Or if your raise, let's say you got a raise this year, your raise was 3%. And companies base raises off of these numbers as well, off of the inflation expectations. So they say that your raise was 3%, but then we see inflation running 4 or 5%. Did you even gain anything? Or even if inflation is at the same 3% that your pay rate increase was, are you even gaining anything? Perhaps you're even losing once the taxes come in. But more money, more problems, as they say, right? But it's not the same way that we're thinking about. Inflation is huge in productivity, economic growth. You have to know where we're sitting at inflation. That's why we just sat here and watched 45 minutes of Kevin Warsh's video. I've watched every Fed speech since Powell took office. I enjoy watching them, listen to what they're saying, cipher out some of the noise so that I can decipher what is actually being said here on Main Street from Wall Street or from the Treasury. This is up in D.C. Or I guess that's from the Federal Reserve, not the Treasury, but the Treasury as well. Let's jump into quickly talk about SpaceX for a second here. So SpaceX had their IPO. SpaceX's IPO was one of the largest, I think it was the largest in history, actually. But SpaceX's IPO, whether we're not going to jump into the valuations and whether you should buy or whether you shouldn't, actually have like a couple videos on that if you want to go back and check out on the channel and a podcast. I mean, where you see the interviews from the SpaceX people, you hear them lay out their thesis. I mean, several hours of it are available on the channel if you want to listen, if you want to hear my thoughts on that. And I also was quoted inside Business Insider speaking on SpaceX's IPO and its potential inside employees' retirement plans. With that being said, SpaceX's IPO, as we expected, was volatile, but it ended up for the week from its first price. I mean, its initial IPO price was $135, but it initially jumped right up to like 160s, 170s. And I believe last week it was up in the 200s, the low 200s, 220s, 230s maybe. But it came back down into the high hundreds, so $170, maybe somewhere in that range. But that's what you're going to see with SpaceX and companies like these right now. So they're going to be volatile, extremely volatile. We have Anthropic and OpenAI coming out later this year, or OpenAI or later this year and beginning of next year. Several other IPOs are coming out. When you listen and you hear people think about IPOs, like I said before, David Snyder mentioned with the IPOs that 5 years later, they're usually down from your initial price where you buy them from. But that's because the way they're set up, IPOs. And this one's a little bit different. This isn't, once again, not an endorsement to buy SpaceX or to not buy SpaceX. That's your personal call. Some of my clients want SpaceX, some of my clients do not want SpaceX. If you are going to buy SpaceX, or my personal philosophy with these clients, I just let them know like this stock could go in half from where we're at right now, from where the initial price offering came out, and it could do it fast. Or it could go, one question, it could go to 50 or 250. Which number is it going to hit first, right? $50 or $250. Which stock price will it hit first? We'll see. It's kind of like those things with Bitcoin. Same thing, like will Bitcoin hit 50,000 first or 250,000 first? You don't know. It's that volatile, and SpaceX is kind of that volatile as well. But SpaceX does have a lot of different components that they're bringing in, and I think eventually you'll have Tesla brought inside of SpaceX, one huge mega company, because these market caps and valuations help Elon Musk reach his compensation package, which he set up, and they also help Elon Musk become the first trillionaire in history. The SpaceX IPO made a lot of people millionaires. And that's another example of like how IPOs work. So private credit people, if you're buying inside of a private credit entity or company like SpaceX, so their employees, for example, began working there and they were probably getting lower like physical compensation dollars, salary-wise, but they probably had a lot of stock options or IPO options for that SpaceX private before it went public. And once Elon Musk and his team went on and did their roadshow with the bankers, so I think Goldman Sachs and Morgan Stanley led that effort. Once they went on their road shows and they were doing the tours with the banks and the bankers, explaining their strategy, those individuals had an opportunity to sell some of their stock pre-IPO, or they could hold them to when they went public. But once they go public, they're gated. So, you can't sell them until a certain amount of time. Usually these IPOs can't go into indexes for at least a year. They have to be profitable. I'm speaking of the S&P 500. They have to be profitable. They have to have earnings. NASDAQ fast-tracked the allowance of SpaceX in there, but NASDAQ also launched the SpaceX IPO. So that's one of the things I said is going to be different with the SpaceX IPO, or that is different. The SpaceX stock will go inside of the NASDAQ 100 index sooner than most stocks go into indexes. So they'll actually be inside of people indexes. So that'll push the price up a little bit. You would imagine the cult following of Elon Musk, I think they had announced they were going to allocate up to 30% to retail investors, but they ended up allocating maybe 20%, 23, 24% to retail investors that had very small float, like 3 or 4%. So very small amount of stock that was available for people to actually purchase. And like I said, the stock price didn't go extremely crazy that first day. Like it went up, but it didn't. And to say like from 135 to 180 isn't extremely crazy, but we've seen stocks on those IPOs like double and triple, like just ridiculous numbers. And those things crash and destroy extremely hard. Not very long after that, we've seen it just here recently in history. And there's been a lot of markets for the IPO game. People really want to see IPOs again. We expect banks to benefit from IPOs. We expect individuals to gain from IPOs. But you also have to realize that people are hesitant with IPOs because the IPO has been looked at as a trap for retail investors. People assume that institutional investors, and rightly so, because I mean, this was a time and where only the institutions were really making money on IPOs. They were catching the money as soon as it started. They had these options that I was speaking about, like with some of these employees, they were buying up these stocks and then they would sell them. So the retail investor had more exposure to the SpaceX IPO. I was in one of the Benzinga show in the chat with him. Shout out to Benzinga Pro, which will help actually right now. If we have less Fed guidance, you can check out Benzinga Pro for some of their research and market data. I'll have a link for them. I'll leave it in the description for this video. And people were talking about the amount of SpaceX shares they were getting from their pre-orders, like retail investors. So that was something different, because usually it's hard to fill those orders. I mean, people were getting half positions, but like a billionaire investor, Ron Barron, who's been investing with Elon Musk for a long time, I think he put in for $1 billion and he reached his full allocation. He got the full $1 billion allocation. So, and that was at the IPO day. So certain people, they got their full allocations, but it was interesting to see that I thought more was available at the beginning than it would have been as far as like what people were requesting. Some people were requesting 100 shares and got 100 shares in there. Also inside the IPO, SpaceX set it up where you have to, not SpaceX, I'm sorry, certain custodians set it up. So like Fidelity or other custodians had it where you can't sell the stock within a certain amount of time. If you try to sell it within 2 weeks or a month or something because they don't want you to flip it, then you will get like a restriction, a 30-day restriction, 60-day restriction, and the time's arbitrary. I'm paraphrasing here, but so 30 days, 60 day, and then like I think after the second or third time, you may be restricted from ever participating in IPOs again, because that was one of the things we worry about, or that retail investors would take these IPOs and just try to flip. Whereas I guess, quote unquote, air quotes for anyone listening, institutional investors tend to hold on to these positions longer. So when they're holding on to these positions longer, that gives the stock more time to find its footing and its balance, and it also gives more time. If you ask retail investors or people who say IPOs are a fool's game, that gives more time for people to come in and be the last man without a cheer when the music stops playing. I don't know. We'll see. Once again, inside that, so you also have the allocation to the retail investors, which is different. Then you have Elon Musk and the cult personality and cult following that he has. So he's one of the original Tesla's, one of the original retail investors market. We saw a lot of people. So he has a built-in base of people who will buy stock, but not enough people to support a stock forever, right? Not enough people to support that stock at that level. But as the stock goes in the indexes, that will force institutions who own these indexes, these are going into pensions, these are going into hedge funds, people who they'll be including SpaceX, and then they're fund managers. So when I say fund manager, someone who creates their own portfolio of stocks and they sell them out to people. You invest in this and they'll show you my fund has performed versus the S&P or XYZ or whatever stock index. XYZ is not stock index. S&P, Dow Jones, Kashi, you probably won't compare it to Kashi, that's international stock now. But any index you want to compare it to, and you pick individual positions and they build out portfolio. But if they're doing that to mirror the NASDAQ, if that's the portfolio that you've put into mirror, then you have to include some SpaceX stock in there. So people will be buying SpaceX stock if they have to fill it up. Another thing that happened earlier than usual were the options came out on SpaceX. So we saw a lot of volatility with the options. Those calls and puts were priced extremely high for options calls for people who've never bought options. Be careful if you do buy options. Options are tricky, man. Options are hard with timing, I'll tell you that. Be careful with options, all right? If you're going to buy options, you need to go do some research, like some deep research on options. You need to have a entry point and an exit point with options, because options will leave you with zero if you're not careful. Be careful with options. But SpaceX options came out last week, so traders were trading them as well. So the speed, the fan base, the actual individual involved with SpaceX, all these things make SpaceX's IPO different. We also saw leading up to the SpaceX IPO that shift in crypto, the flush out from Bitcoin, but it's also a Bitcoin winner. So people don't know if it's just the cycle with Bitcoin or if it's also the timing. We saw some of the high flying tech stocks lose a lot of market capitalization. So a lot of money went out of them back into the stock market. We saw the stock market actually go down, have some rough sessions there with the Dow Jones here in the last few weeks, and the NASDAQ and S&P. It's been a couple dead cat bounces inside there where it looks like the market wants to pull higher, but we're still hovering around all-time highs. Watch for oil. I'm still inside the IPO, but I'm sorry, so I'll step out a little bit outside because we're, setting up just let people know what to watch for. Like, we saw the mechanics where oil prices were going down and stock prices were going up. That's good. That's how it's supposed to be like, right? If the stock movement was based on the war before, like, so when we saw in February, we saw stock prices drop. Initially, we saw oil prices go down. Then we saw a period where we saw oil prices going up and the stock market going up. That wasn't really, I don't know. We did have strong earnings. Earnings are what should be driving the stock market. One of the things that should be more influential on the stock market are stocks, or their actual earnings and where they're actually producing results, how they're taking this money. We've seen this apocalypse since then. We've seen a lot of companies say they're now sourcing out debt. So we can't say that's all the war or all chemical wars or all IPOs that cause money to move out in the markets. But there were definitely people preparing to get their dry powder, quote unquote, cash ready to buy some of these IPOs. And they're still waiting on more IPOs to buy in the future. People also realize that this market is bumpy right now. So there will be opportunities to come in and buy the market. One thing that I want people to realize, and whether it's investor or trading, sometimes the best move is no move at all. Like, sometimes the best buy is not to buy or to sell. It's to hold tight with the position that you already have and just figure out where it's at. Figure out why it made that move. Figure out what happened inside that stock. So I want to take a second here. If you're listening, if you're watching, you can get some value from this. Share this with someone you love, someone who needs to hear this. We recently just sat down with a lot of great conversations. Brad Olson over at Benzing, I've been sitting down in the chat. Well, I got some great ones coming out with Derek McKinley. Derek Kinley, he sold his financial plan firm for an 8-figure exit. We did the Broke series over there with the LinkedIn editor, John Tomasi. That's really great. With first we talked about sports, so we talked about the Knicks and Spurs. Shout out to the Knicks. Shout out to the Hurricanes down here in the Wall Street South. It's just great content. There's a lot of great content. If you don't know the tempo of this channel, is this your first time watching? I love to help Main Street meet Wall Street, but I can't do that alone. I need your help. I need you all to share this stuff, subscribe, like, engage with the content. If you leave a comment, I'll comment back. I'll reach back out to you. But this is a free pipeline for people who they don't know where to start. They hear this jargon and they're confused by what these people are even talking about. We need information as such a powerful tool, such a powerful weapon. We need more of it spread out throughout all the people who aren't paying attention to these type of things, whether it's due to a lack of knowledge, a lack of time, or a lack of desire. Like, these things impact your wallet. At the end of the day, your standard of living, your cost of living, all these things are intertwined. So that's what I'm doing over here on Main Street Meets Wall Street. I'm trying to help people have the ability to digest, evaluate, and make informed financial decisions. So hit the like button, subscribe. If you're listening on podcasts, give it a 5-star review. Just join the channel if you enjoy this content. Tuesdays are going to be, we're always dropping the podcast with the guest on there. That's Tuesdays, usually premiering in between the 9 and 10 p.m. hours somewhere on Tuesdays. And then Saturdays, we usually drop something as well. So something like this, a series where we're just speaking on what just happened in the world and in the markets. And also we'll probably start doing a pre-week of setup. So help people set up for the week that's coming ahead. But back to IPOs. As I was saying, the SpaceX IPO is different. I think it set up a structure where now we will see other IPOs that are coming out adopt this structure from the SpaceX, where you have a certain amount, you have the price set where retail or more investors can access it. You have a certain allocation put out to retail, because Anthropic, OpenAI, these are also companies that are going to be highly pushed by retail investors as well. Another thing we saw in the markets this week, we saw the move back to some of the memory comes from, we saw a broadening of the stock market, but it was just a very volatile week inside of the market. As we've seen here recently, we're going to continue to see choppiness. We had the memorandum, the peace memorandum that was signed, but then yesterday they were supposed to meet up. So Friday they were supposed to meet up and officially sign it, and that trip was called off or postponed. We'll see where that leads to. That is a very fluid and dynamic situation. But Main Street, we have to stay informed. We have to get these tools. We have to gain and understand some of the things that the world is presenting right now and how it impacts our money. Like I was speaking earlier, we were talking about how folks are important, how folks are placed. We were talking about Fed chairs. I was talking about Kevin Warsh. That's a result of our vote. So go out and vote, because that's one of the main powerful tools that you have. We didn't vote for Warsh, but we voted for, or the world, however you want to look at it. We're not getting political here. The administration that's in office gets to make that decision based on the votes. And then the people inside of Congress, so you have the Senate and the House of Representatives, they actually have to confirm these people into these positions. So once again, impacts of our vote. So just remember that. We're sitting here with the two-track economy. You know, we got markets versus households. As we sit here, we see how can this S&P 500 trade at record levels, right? How is it trading at record levels when consumers are struggling at home? And it shows the divergence where we're at right now. In this case, you have the economy. Like the personal savings rate is really low, I think like 2.5%, suggesting consumers tapped out. Or is it a sign of extreme confidence that we can spend money? I think affordability is really hitting people in pressures. Small businesses, you know, they're signaling that, what are the small businesses telling us? There's been a low hire, low fire, but there's been steady job growth, you know, inside of our economy. And the wealth effect, you know, is the wealth effect continuing to carry this? Are stocks the reason that people are able to live with this higher cost of living? Because once again, like I said, stocks and higher inflation, who's going to win out in the long run? Historically, stocks have outperformed inflation in the long run. And then, well, the rates, what are we going to do with rates? Are rates going up, rates going higher? One thing to watch with rates, so you can listen to what the Fed chair is saying, as you should. I don't say listen to what he's saying as you should for particularly to agree with him or disagree with him. Saying listen to the words he's saying, but also watch what the actual bonds are doing, right? So watch what the bond rates are doing on the other side. Are they going up? And when I say bond rates, I mean U.S. Treasury rates, so like the 2-year, the 10-year, the 20-year. See what they're doing. Are they going up? Are they going down? If they're going up, chances are that means that they're not. If the bond rates are going up when the Fed chair said that they were looking at rates going down, which Warsh didn't say. Warsh didn't say he was lowering rates, which was also interesting. That means that the bond market expects rates to be higher, right? If they're going down, that means eventually the bond market expects rates to be lower. Bond market wants to play it pretty close. The spread, look at the spread from how much you're paying for these U.S. bonds versus if you go out and buy a corporate bond. That corporate bond should give you a higher coupon because you're taking more risk lending your money, because a bond is up. That's what you're doing. You're lending your money to someone and they're paying you an interest rate coupon back for, usually biannually. And with this coupon, and at the end of that term, you get your money back, plus whatever payments you made. The coupon is just a loan, whereas if you own a stock, you actually own part of the company equity. You own it. It's a part of the company that you own. Sometimes they pay a dividend, not a coupon, but a dividend, so a percentage on their earnings. Sometimes they don't. Sometimes you're in there for the growth. But just something to remember when you're thinking that. And then another big thing is that Chairman Warsh mentioned that it's 2%. And that it's on the left side of the decimals where he's really focused on. So left side of decimal versus, you know, where we're at right now. It's going to be a big week coming up. It seems like every week's going to be a big week. Just where we're going, just with the market, with the world, the war in Iran right now, that conflict and the Hormuz paradox. I mean, how is it going to affect your fuel costs? I noticed that fuel costs are coming down. I haven't checked them down. I need to check the fuel costs today. Because you can see it daily down here where I live. Like we can see it go up, we can see it go down. But will this spike in fuel costs from the last month create sticky inflation, you know, or that won't disappear even if these tankers move? They've slowed down. as of right now. The traffic is slowed down. Are markets really like underestimating the second order effect of this conflict on global food and fertilizer logistics? The growing season. And then, why is this geopolitical shock? Is it structurally different from the 2022 energy crisis when Ukraine and Russia began their war? Like, how do investors differentiate between a war-driven supply shock and a true recessionary trend in energy demand? Then you have the war, and this conflict picks back up over the weekend, which just shows that you have to stay in the market. You can't try to jump in and out of the market. You can't try to time the market. It's not saying you don't lock in some of your gains. You should lock in some of your gains. You need to trim some of your winners when you have the opportunity. Not every day, maybe quarterly, maybe biannually, maybe annually, whatever your horizon is. And it depends on when you retire, or if you're retired as to how often you want to go in there and even rebalance anyway. But these are opportunities to reevaluate where your position is, why you're invested the way you are invested, what your actual investment themes are, what's your philosophy. Why am I invested in, and this is not a stock recommendation or this is just an arbitrary stock. Why am I invested in, let's say, ExxonMobil? Okay, yeah. The war started, I'll go out and buy a bunch of Exxon. Full disclosure, I've had clients in Exxon way before the war started. But say the war started and I didn't buy any more when the war started. But let's say the war started and you say, okay, I'm going to buy energy now because gas prices are going to go up. So you went out and bought some Exxon to add to your portfolio. And now you think that the war is going to end, or you see oil prices coming down, you see stock price move. Is this a time for you to sell Exxon? I don't know. Did you buy Exxon solely because you wanted it for the war? If so, then maybe it is time for you to trim Exxon. But you also have to think about the time you hold these stocks. A lot of people don't take that into account. And I'm going on a rant a little bit. I'm sorry. Like, they'll trade and they'll make a huge gain in stock. They'll make 100%, but they'll forget that 40% of that's going to be taxed if you sell it quick. So you really only made 60%, which, don't get me wrong, that's a nice percentage, but you have to take that into your calculations. So whether you hold it over a year and a day, as they say, that turns into a long-term capital gain versus a short-term capital gain. And that drastically drops your tax rate that you pay on that sale that you have there. So I always like to I like to do research and study companies, but I always like to go into an investment or a trade with at least a 1-year horizon on anything that I'm invested in. And notice that I said investing because I'm not trading, we're investing. If you're going to trade, make sure you got some outside account that you can do it with a minute amount of money. Some people do have that trading itch, but be prepared for taxes. People don't think about taxes. I remember that was a big thing with the Bitcoin run that we had and the meme trade, the GameStop. People were underestimating the cost of taxes, and it was just people were upset. So I guess some big questions here are, what will be the results of this task force? How will the Fed moving away from forward guidance impact retail investors? Are they going to continue to guess now based on these press conferences, or are they going to really just start analyzing hard data with tools like Benzinga Pro? Or, how are retail investors or people who don't have access to these meetings that they have or backdoor channels going to invest? And this Warsha stance that the Fed has less control over prices than previously before represent a pivot to a more handoff monetary regime. It seemed like Warsha wants the markets to churn and work for themselves and the Fed to play its role. It's interesting that he did not push for lowering rates. I think he sees where we're at. He sees we're at a point where you don't have a strong case right now for lowering rates at any cost. And the next move may have to be an actual rate hike. We'll see. Depends on how persistent this inflation is and how growth is going. If we continue growing this economy as high as predicted, is this current AI bubble still being fueled by what many have called, air quotes for those listening, circular financing, or are we seeing general capital expenditure returns? We've seen companies announce just as recently as last week that now they're going out into the debt markets. Companies some of the largest companies in the world, so companies with large amounts of free cash flow, they're going into debt to fund some of these AI build outs. Are we going to build data centers in space? I don't know. That's another space that's play. If they do, I heard, I think it was Peter Thiel maybe came out with the idea of putting data centers in water. Once again, I definitely ain't drinking water from the ocean, but think about that, man. But that's just something else I do, right? I guess all water comes from the ocean eventually, but think about the things you want to put in the ocean. That's a whole nother thing. And, Benzinga Pro, like I said, it can help you if you take a second and look and give you some of this new data. see what some of these signals may be, especially without these new channels. And there are companies like Micron and Dell. Are they now picks and shovel winners, or are they just the latest high frequency momentum memory play in the case of like Micron, or Dell's another American champion? We saw Intel and Apple just announce something, or maybe the administration announced it. I don't even know if Intel and Apple announced it. We saw Intel price shoot up again. So what happens to free risk after the US dollar when the government borrowing cost accelerates, or like non-linear, right? So if the amount that we're spending really exceeds our amount of debt, or if these interest rates don't come down, because that has a lot to do with how we finance the debt too. Is this current market rally that we've seen sustainable if the Treasury's most continuously issued record amount of debt, continues to cover this deficit? What are some of the risks of this fiscal dominance, where the Fed feels pressure to hold rates lower than inflation to monetize the debt? So that's what I'll say. Like, if we keep these rates lower, it's going to help them with paying off the debt. But there's just a lot to go inside of our debt right now. And if you want, I have a couple hours of video on debt as well. If you want to go check it out on the channel with Mr. James Callahan, who was a debt analyst for many years. We go deep into the debt, how at that time it was like 36 trillion, how it was actually like $160 trillion serviceable debts. Those numbers are higher now. That was a couple months ago. But like I said, this is an outlet for anyone who wants to learn pretty much anything financial. We have something covered. We go from 50,000 feet to the basic building blocks on some of the videos as to, setting up emergency funds, and which, you need to set up an emergency fund. That's one of the first things you need to do. But obviously you have to have a budget. You need to figure out your debt, figure out a method of paying off the debt. But emergency funds first, right? You got to pay yourself. You got to get that savings rate. Just several things into like stocks versus ETFs versus mutual funds. Never make a stock recommendations on this channel, because everyone's portfolio is different, right? If you're listening to a channel or somewhere and they're just making a recommendation, go buy this. I mean, and that stock might go way up in the time that you're talking about in a short time, but they're probably not for the 80-year-old person listening to this, or the person who's about to retire. Not the stocks that most people are talking about on the internet or whatever. Those are stocks that are going to be up and down, like SpaceX, volatile stocks that you can't particularly have in your portfolio, or you can't have an oversized position in your portfolio if you're about to retire. If you're a longer-term investor, like I said, how does these volatile mid-cycle environmental changes, like how are you allocating that high beta, so high risk stock inside your portfolio? And then modern portfolio theory, I spoke about that a little bit with Benzinga's Chief Content Officer, Brad Olson. And is it being replaced? Like, is the 60-40 being replaced? Modern portfolio theory focuses on a lot of things, correlations. It had a lot to do with so it was part of the reason why people invested internationally versus domestically, where you had that mix. But it's a lot of it about diversification, correlation, and how if you have the proper amount of diversification, correlation, and you reach out to a efficient frontier, that you'll have the best performance that you have, your optimal performance. And then, how can you perform a weekend stress test? These 3-day weekends are always, or recently have been interesting, right? So you see a lot of people making moves going into these weekends, and you'll definitely see some moves coming out of them. And why is it important to track these institutional flows? And what the Fed is saying, I'm telling you, we need to pay attention, right? We need to pay attention. We got personal consumption numbers coming out. There's always data coming out, right? And once again, you can check out Benzinga Pro when the Fed drops this data, or when there's something that comes out that people don't quite understand. There will be a link down in the description for it where you can just take a look and see some unusual options activities. Be careful with options, institutional flows, and real-time news, probably before it hits the headlines. Those guys are on top of it. I will give them their credit, give them their flowers, as they say, to Brad and the team over at Benzinga. They're just really doing big things over there, and they're making great moves. We've been talking for a while, so we had Chairman Warsh come on, give his speech, and let him speak for a while, 45 minutes of that. And I've just been kind of riffing, speaking on the IPOs and the Fed, inflation, jobs, just sitting here talking to you, Main Street. For those of you listening, hit the like button, share this, subscribe. Also, anyone who wants to do budgeting, if you're struggling with your budget or personal budgeting, check out Modern Money. I have an affiliate link for them. I can leave in the tools. They don't do any selling. There's no ads on Money Mark or Money uses AI to help you as well. You can share it with people. You can share it with your spouse, whoever else you're budgeting with. You can share it with your financial advisor or financial planner, someone like myself. So yeah, there's just a lot going on right now in this world, and these are tools that can help you. And that's not to say that and with those tools, yeah, I guess I should say those are going to be affiliate links, so the Bezega Pro and the Monarch Money. So if you do happen to use those, I can or may receive a commission if you use those links that I said, or a fee if you use the links that I said. I want to get that full disclosure, and those are tools I've definitely checked out and used myself. So get that out there so people know. We need to be informed. We need to make informed decisions. We need to know what we're looking at. We need to know what we're listening to. I've really heard a lot of people lately they're listening to all these gurus, all these people who are just saying all type of, it's ridiculous some of the things that you're hearing out here in the world today, as far as like what people are saying. I hear, and what you have to notice is that these people making these outrageous claims, there's no accountability really for them, other than if like the SEC or FCC or someone like that came in and got them. But like, as far as from like everyday people, there's no accountability. They're not licensed or insured or bonded to really make these like. So that's why you don't generally hear financial advisors or financial pros hop on video and hop on YouTube and say things like, go about this and you'll get a million gazillion. We're not going to say the word guarantee, really, rarely, because nothing's guaranteed. Few things are guaranteed, I should say. Death and taxes are guaranteed, but few things are guaranteed inside life. So please, you have to understand, and the difference is another few differences. I'm just making a plea for people who, and this is whether you're dealing with like mental health professionals, financial professionals, any type of professional you're dealing with. I've seen people charging, I don't even want to say the numbers, but just like ridiculous amount of money for courses, and then they're offering basic stuff. They're offering stuff that you definitely can get on this channel right here for free. But anyway, they're offering all kinds of, and not just my channel. Like I said, there are other channels, other people that you can listen to and watch where you can get this information. I don't want to say the same information because, it's a little bit different over here. Main Street meets Wall Street. We do a little bit different over here, but you can definitely go out and get great information. And also, folks, always remember, like, have different sources for information. It doesn't have to just be one person. It's fine. If the person you're talking to gets offended because you ask them a question or you ask them about some information, I mean, that's probably on them. That's probably more of a telling sign on them than it is on anyone or anything else. But yeah, so as licensed professionals, we have insurance, bonds, insurance. So if something was to go wrong, we mess something up, we're doing continuing education. So we're continuing to grow and learn. We have to take tests, the certifications to meet federal, state. We have to meet certain information requirements. So we have to have certain knowledge about things, right? Because like I said, anyone could have said, and this isn't taking shots at people, anyone could have said, go buy NVIDIA in 2023 and you would make a lot of money if you had just held it a year or whatever, when it was trading, it was going through all-time highs, when it was becoming when it was becoming the most valuable company in the world. But it went down those times too. What to do in those situations? What's really your risk tolerance? Are you really investing at a proper risk tolerance for your age, for what your long-term goals are? What's the tax consequences? What's the whole picture? And how much of this should you have, right? Everyone probably should have some NVIDIA, but guess what? Once again, that's a stock that's inside index, so you will have it. Once again, not stock recommendations, but how much of this particular stock should you have? Am I getting these stocks already inside of my employment plan? If I work in one of these big companies, I work on Microsoft, Apple, Lowe's. These are companies that are all around here in the Wall Street South. That's why I just said, that's why I'm mentioning these companies, because I know a lot of people work down here and they offer stock and incentives to their employees. So you have to think about these things as well. When it comes to, like I said, once again, when investing, are you investing? Is it going to be over a year and a day? And that's still short-term investing. We speak about investing, it's still short-term. Or is it a long-term hold? Am I buying this and I'm going to hold it, never sell it? Maybe I think that's what Ron Barron said about his SpaceX. He said he's never selling. We'll see. Never is a big word. Never is as big of a word as guaranteed with financial professionals and in the world that I live in. But once again, so I've seen a lot of different things in this world. And that's not to say that people who are doing these things or saying these things aren't actually being effective and efficient. I don't know if you ever heard of the book Think Rich and Grow or Grow and Think Rich. That may be the name of. They're actually two different books. One, Napoleon Hill wrote it, and he's questionable about whether the information he wrote about is true. He said he once spoke to Carnegie, maybe. I think it was Carnegie. One of the Gilded Age millionaires, and people who were so rich back in the day that didn't even, it was ridiculous. Like Elon Musk rich right now. But went back and he said this man wanted to write a book about his thoughts, how he got rich. I actually have read the Think Rich and Grow. No, I did that audio. I listened to that audio. Think Rich and Grow. But it's very interesting. But it came out later. It's been questioned as to whether he actually even had those interviews. Actually, as whether they were even actually happened. The person he was interviewing, Carnegie, has written plenty of biographies himself. So people are like, Carnegie probably didn't need a biography. There's just a lot of different things that question whether or not Napoleon Hill's book actually was based on, whether it was a nonfiction or whether it was kind of a fiction. But at the end of the day, his book has inspired so many people to go out and do things and grow and grow rich. Like, I think Tony Robbins has quoted him that some of these big people that you hear right now, some of these big inspirational speakers, it all ties back to Napoleon Hill. So whether he was grifting or not, his work got results, right? And I don't know if sometimes in there you're going to get bad results, sometimes you're going to get good results. So that's to say, like, someone like that. Or then if you even think about, like, let's say Richard Simmons. Richard Simmons came in, he was dancing. His message was health and fitness. I don't think Richard Simmons was a certified personal trainer or anything, but he went out, he got people to take action. Dave Ramsey. You look at Dave Ramsey, people, that's a really hot topic. People either like Dave Ramsey, they're against Dave Ramsey. Dave Ramsey has some interesting theories and some interesting topics, some interesting statements. Like he was saying, the stock market's 10% return historically. That's a little high. But Dave Ramsey gets people to take massive actions. He's helped millions of people start going down that financial path. For better or for worse. I don't even say for better or for worse, because the moves he helps people to make to begin, if you're just starting out, Dave Ramsey is going to help you starting out, getting down the path. I can say that, like, with the things he's going to tell you. He'll help you focus on budgeting and this. Like, some of that strings he goes, you're like, in my opinion, it works for some people, like paying off all your mortgage and all that debt. Like, I don't know, get that some time, but definitely gets people focused. That envelope method, if you're just starting, for anyone who hasn't, where you take all your cash, you put your actual cash into envelopes, and that's what you get to spend for each bill. So if your power bill is $100, you put $100 in that envelope for power. You put $100 in leisure. You put $100 for savings, whatever. And once you run out of that money for that allocation, then you either don't do what you have. So if you spend that $100 for entertainment before your next month or next pay period or whenever it is that you budgeted for, then you don't do any more entertainment, or you have to take it from somewhere else out of those envelopes and put it into that envelope so you can do it. But you have a finite amount in those envelopes, and you have to figure out how to make it work. And those type of mental exercises help people out. Like his Financial Peace University, I read one of his books. People seem to find value and people make moves from what Dave Ramsey tells them. So that's just another example. So then we go into, and it's a community like, I don't know if people can afford these programs that are out here now. And there's plenty of people on the internet bashing them and attacking them and saying whether they're good, whether they're bad. That's not what I'm saying, where these programs are good or bad. I'm saying they're helping people take action right now. A lot of people who have never taken action. And hopefully, once these people begin to take action, they begin to go deeper into their research. A good thing that you can do is never just look at one viewpoint for research. Always fact check it. Trust but verify. Feel free to look at another person's information from what they're telling you, right? If they're telling you this and they're telling you, I heard a popular statement the other day on a show. I tuned in to watch someone else that I'd never seen it. It was one of these money podcasts or episodes. I'd never seen it. I heard people talk about it. So, and this channel has millions of subscribers. Tuned in to watch it, and I heard one of the hosts make a statement about Micron. He said Micron's capital, or Micron's Micron's market cap went from 500 billion to 1 trillion. And he said in 48 hours, fastest ever. It did have the fastest ever from 500 billion to 100 trillion. I mean, from 500 billion to 1 trillion. But it was not 48 hours. And someone else on the show questioned. They said, oh, you sure it was 48 hours? It was 48 days, which is still extremely fast. Like, That's fast, but it's nowhere as fast as 48 hours. And that is a material mistake that someone probably should correct it. No one did. But those are the type of things like no one's paying attention to, I guess. They just see the movement and see the price. Because if you were in that stock, Micron, I think with Micron was the stock. Like if you were in Micron at the end of March or in March when it got down to in the high threes, and now Micron's sitting at $1,100. Yeah, you were like, oh, I got, but once again, when you're getting out, when you're trimming, what's the taxes, or even this long term, short term, these are the kind of things that you need to look back and figure out when you're investing and when you're working with people. So some of these courses that people are offering, just, I don't know, they're interesting. But I do love the fact that people are having conversations, people are learning different things, learning different topics. Just go back and research what you're hearing, especially if something sounds like extravagant. If something sounds extremely extravagant, you need to go back and check back on that. Let's go back and look and see like what we're really doing, like what's really happening here, what are we really talking about. So I'm trying to think of another example with people who get results, but I don't know. You have to just look and see who you're listening to and check. Make sure these people know what they're talking about. Are they experts on the subject? What makes them an expert on the subject? Did they just happen to buy some Bitcoin at 5,000 and it went to 100,000? Did they sell it? They still have it? No. What are you doing right now? Because another thing is a lot of these folks don't show you their investments. They don't show when they go up or when they go down. They may make a trade. They may hedge the trade where part of the trade, they may make the same trade, a call or option trade. So a call bullish meaning they think the stock's going to go up, and a put, which is bearish, meaning they think the stock's going to go down. They may make the same trade for the same amount on both sides, straddled. So if it goes up, it looks like they would make a lot of money that way. But if it goes down, but if it goes up and they got the same bet that it goes down, they lose money on the other side, and they just show you one side of the trade. So it's just like something that's a whole lot. So like total returns, watch for these type of things, and then just be careful in general on Main Street. Like I said, this is an outlet. Hopefully people can sit back, take in different information, learn about what's happening and what's going on in the world. We have coming up this week on the podcast, we have Derek Kinney's episode coming out. It's great for anyone who wants to learn how to speak about what you do, how to market yourself. He tells a great story about how he got involved in local schools and how it really grew his business. Like I said, Derek has sold his business. He sold his business for 8 figures. So I think he knows what he's talking about. He wrote a book. He's out doing his book tour right now. We spoke with Brad Olson from Bazinga, Chief Content Officer. So Brad's great. It was a great conversation. Check that one out. So all this is on the YouTube channel and the podcast. We have some live sessions coming up with Mr. Stephen Davenport and Samuel Brink. We're bringing Samuel back. Me and Samuel want to sit down and chop it up from Business Insider. So there's just a lot coming up, not to mention some of the great podcast things that are coming up. We got the crypto stuff coming up soon. The other side of the bullish case. We had a lot of crypto bears. Me and Clem Miller went down that crypto hole where he made the bear case why Bitcoin is a fraud in his opinion. So I want to bring different opinions. I want to bring people on here who you get the facts from their side, this side. You can go check them out. You can go check out and do your own research. I'm not going to tell you to go buy this stock or not buy this stock. I can tell you if we ever talk about a stock or a sector, why this stock or this sector has the pros and the cons, So just another a lot of stuff going on here. If you can't find the plug, just like with the Wall Street South Journal, that's up almost to 1,400 subscribers. We just launched that in February. And in the initial edition of that, I said, couldn't find a table, so I built my own table. That was the first part of the table. And guess what? The table's getting big. Everyone, there's room at this table here. We're letting you at the table. If not, we're going to show you how to build your own table. Couldn't get plugged in the proper way, so we're building an outlet. This channel is the outlet. Main Street meets Wall Street. Like if you want to learn information without all the jargon, we have the fancy jargon. Like I said, that's usually going to be probably a Tuesday episode. We're going to give you some of that, but on Saturdays we pull it back a little bit more. Check out the hair. You also like the hair pulled back, just a little bit laid back. Just laid back. We're still giving valuable information, practical tools, and steps that you can take and make every day. Got a lot of great information, a lot of great content coming out for everyone. Like I said, Main Street Meets Wall Street podcast is on fire for those who haven't seen it. Just a lot of big things coming out. I hope people take the time to really check it out and see how we're helping Main Street meet Wall Street. Also, just to recap, in this video, we've talked about Kevin Warsh and his new moves, how it's going to affect and impact. We let you hear it from his own mouth. Warsh speaks. And then we also spoke about, IPOs, mainly the SpaceX IPO. We dug deeper into that one. And then just what we're looking for this week. There's a lot of consternation moving forward. We don't know where interest rates will be, where the war will be. Well, interest rates are holding steady. So we know where they're at until the next 6 weeks when the meeting happens again. I guess 5.5 weeks now. But we've covered a lot of ground because there's a lot of things happening in the market. You found some value in this. Hit subscribe, hit like, share this with someone. This is the epitome of Main Street Heart meets Wall Street Smarts. That's what we're trying to do here. We really cover those Fed, the 5 task forces for the Fed. So communication, that balance sheet audit, economic data sources, so those models, AI and productivity framework, and then trying to reach that inflation target is the two really feasible. They all were committed to reaching that 2% inflation target as they have been. So it's good to see uniformity inside of that group, at least on one subject. But you do need a little pushback both ways to actually get your best result. You don't want everyone all agreeing with the chair, everyone all disagreeing with the chair. We need some lively conversations from both sides of the table, and we need people to articulate and research and evaluate and deliver to the American people the best result for price stability and full employment. I know Chairman Warsh didn't really mention full employment, but that's what's in the amendment that created the Fed. That's part of their dual mandate. So, yeah, when it was created. So, Main Street Heart, Wall Street Smarts, hit subscribe, hit like, share this content with someone else, someone who needs to hear it, someone who wants to hear it, someone you love, someone you care about, or someone who's just asked these questions out loud. What does this stuff mean? What are these people talking about? Why do I care about interest rates? These are the questions that not only this outlet and this channel will help you find, but you'll also get it with unfiltered, no political biases here. Like I said, that video showed a lot of political ads, but that's just because it's that time of year. None of those ads are for me. It's that time of year. So remember to vote. I'm not going to tell you who to vote for. Just vote. Do research before you vote, too. Don't just go blindly vote. That's silly. But Main Street Heart meets Wall Street Smarts. Thanks for tuning in. Spend some time with me. Share this with someone. Hit subscribe. When your quality is treated as a commodity, or even worse, you don't care about your quality, your wealth will vanish. We say Black Wall Street, but if your dollars aren't circulating in your own zip code, you're not building a local economy, you're doing a global one. We're acting like gig workers when we should be acting like landlords of our own economy. Ownership isn't just a title. It's the refusal to export your labor to a national platform that views you as a commodity. When you walk into your local economy, do you see a place of work, or do you own the place you work? Black Wall Street, local economic ownership, and a broke cycle. We've been told a fairy tale story about our economy. We're told that if we hustle hard enough, if you work enough gigs, and if you stay busy enough, you'll eventually build the kind of generational wealth that makes the community self-sufficient. But look at your ledger. I hear way too often people talk about rebuilding Black Wall Street. It's a great idea. But Black Wall Street, Tulsa, Oklahoma, Wilmington, Durham, people treat these like museum exhibits. We treat it like a cultural monument to be honored. But the people who actually built those empires did not care about monuments. They cared about velocity. They cared about ownership. And they understood a math equation that we completely forgotten. When your labor is exported to a global platform, your community dies. When your quality is treated as a commodity, or even worse, you don't care about your quality, your wealth will vanish. Today, we aren't here to talk about what happened in 1921 or 1898, Tulsa and Wilmington, North Carolina. We're here to conduct a structural audit of how we can do these kind of things today in our own community. We say Black Wall Street, but it doesn't have to be Black. It can just be any community. We see this happening all across the globe. And if you're currently trading your time for a discounted hourly rate, you're not a business owner. You're a high-stress, maybe highly paid employee of your own gig. If your dollars aren't circulating in your own zip code, you're not building a local economy. You're doing a global one. Today, I'm going to show you. We're going to sit down and just talk about some of the quality gaps, how you can work with your local market how to stop asking for discounts. Small business owners are not prepared to give discounts. Stop asking for discounts. And how to start acting like the landlord of your own industry, folks. How to take ownership in your community. The ledger's open. We're going to jump into building this empire. What do we see? What is happening in our world? What did they do that was so different in Tulsa, in Wilmington, and other places that set them apart? Well, for those who don't know, I'm Marcus Dermott Sr. Bring this back down a little bit. I'm Marcus Dermott Sr. I am a financial advisor, business owner. I own a financial planning firm, so I am Main Street, right? Down here, small business owner, helping people. But one thing that I've come across in conversations that have happened lately are we should rebuild Black Wall Street. We should do this. We should do that. And I agree. But like I said, it doesn't have to be Black Wall Street, but we need to refocus our focus on the local economy. Because believe it or not, this big stuff that's happening across the globe, it doesn't work if the local economy isn't working, right? So if stuff's not working at home, it's not going to work abroad. Like they'll make money, but we'll suffer here on Main Street. So I'm just going to take a little bit of time here today, to talk about, we will look at a little bit of Tulsa, Blackwood history, Black Wall Street and Greenwood history later. We're going to look at that later on towards the end. So stay to the end. But today we're talking about different ways, so how people can work. I have this picture on the screen. Everyone sees. A lot of people may not know. It's actually my shirt too. One of my favorite shirts, right? So that picture right there is of Prince. And for those who don't know who Prince is, I'm sorry. Arguably one of the greatest artists who ever lived. That's not the purpose of the story. That picture right there is from the mid-90s, early 90s to mid-90s. So Prince was a creative genius. He would write his music. He would, and when I say write his music, he would write the music. He could play every instrument on the song. He could sing pretty much all the parts. But obviously, to put all the stuff together, you have to bring a band in. But he would write the music. He would do everything. He had huge hits through the 80s. Purple Rain, which was like the #1 movie and the #1 album in the country at the same time. So he had a lot of momentum, a lot of great things going for him, right? But then he realized that he didn't actually own any of this stuff. He didn't even own his name, it turned out. He didn't even own the name Prince. Ownership's a big part of what we do, right? You need to own something, right? Own something, own a house, own a car, own something that's an asset. Prince had plenty of assets, but he didn't own them, right? So he changed his name. He made it a symbol, and he went by the artist formerly known as Prince, because he was still under contract with Warner Brothers at this time. That's who had control of his music. Long story short, Prince got his masters back. His masters, so the original people who control the what can happen with the music and how royalties are paid. Like, he got full control of that back. He may have had to buy him. But you've seen that happen here lately with other artists. You've seen Jay-Z talking about buying masters. I think J. Cole went back and bought his masters. The Beatles' masters were for sale. Michael Jackson may have bought them, and then someone else may have bought Michael Jackson's masters. There's a lot going on with masters. People realize that ownership is very important. And the music industry was a lot different back then as well. So you didn't have to pay for clicks. People were actually selling CDs. Or I guess back when Prince was doing it, they were probably selling tapes at the beginning of CDs. If you don't know what a tape or CD is, Google it. But so Prince was creating a lot of income for Warner Brothers, but he was not receiving nearly enough in return, right? That's another thing. So if you create something, you should, in theory, reap the most benefit from it financially, right? Financial wise, if you create something, if you make it for one and sell it for two, that's not a terrible profit margin, right? But everything can't be priced as simple as that. Like, make it for one, sell it for two. There are certain things, that you can look at per se, like maybe food. I know, like restaurants. So I used to work in restaurants. And this isn't the formula we use, but these are different formulas that you use in industries. Sometimes they do them in restaurants. So they'll take whatever your cost is and multiply that by 3. If you're a business owner and why do they multiply it by 3? The one part covers your food costs. Other part should cover your labor costs. And then the other part, the third should be profit, ideally. Right? We have to have the profit. People don't realize that the profit's not there. I hear people talking about restaurants wanting to open restaurants. Restaurants are one of the lowest margin businesses in the world, unless you're making everything from scratch and it's real niche. And then you'll have a problem with volume, top line volume, maybe. You'll be capped out, because once you start franchising, we see qualities fade. As we can see with some of these places that used to be great places to eat. I'm not going to call them out back in the day, but they're definitely not what they are. And it's reflected in their stock price. But this is back to ownership, right? You need to own something, right? We have to take a second and own it. Prince wanted to own his masters, hence the word slave, right? He's got the word slave on his face because he felt that he was not being fairly compensated. I can't even say he felt like it. He was not being fairly compensated for the quality of work that he was producing. So we sit here and you have you have artists like Prince or anywhere, anyone, and this could be in your local community, right? So think about this local business owner who, or you yourself, say you work for a business, but you completely work for the business. See, a lot of people have this misconception, in my mind, my opinion, my view. If you only have one source of income, like say you work a W-2 job versus being a business owner, you're a business owner, you may have 10 clients, 1,000 clients, 100 clients, customers, whatever you want to call them, who come in and use your business or create income for you. Let's say it's only 10. Say you have 10 clients that come in and create 100% of your income. Okay. Now let's say you work a job, a W-2 job, 1099 job, whatever kind. You only have one source of income. Let's say you only have one source of income. Okay. You lose that job. Your entire source of income is gone. Now, if you run a business and you have 10 clients or customers and you lose 1, 2, 3, 4, 10, 20, 30, 40% of your business, but it's not 100% of your income loss. And those numbers don't even play all the same either, because it's, the top 3 or 4 of your clients provide like 80% of the income and revenue. And that's just the math that works out. So know that when you're thinking about it, right? That people have to appreciate their margins, their personal margins. You have to treat yourself as a business, right? And I know we're talking about building out the community, but we have to start in ourselves, right? We have to realize that we have to know our worth, know what we're worth, know what we should be paid, get a fair wage for your job, man. Like, don't sit out here and let people underpay. Speaking of fair wages for your job, right? So I had a post that I saw on LinkedIn the other day where someone was talking about, actually it was one today, someone was talking about free financial advice. And like what people offer for free financial advice. Shout out to who, I think maybe it was Matt Jarvis, he posted it. But he said, asking for free financial advice is like calling your doctor 3 o'clock in the morning and say, I'm having a heart attack. Your doctor's going to say, call 911, right? Like, I can't particularly help you with that. I don't know the whole situation. I don't have it all grasped, right? And as financial advisors, like we really shouldn't just be out here giving out like free financial advice per se, like individual recommendations. So like if you walk up and say to a financial advisor, tell me about blah, 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 and you've never even met this person, it's a process that we have to do to give you proper financial advice. You have to know your clients. We have to sit down and get to know one another. I can say I like XYZ fund. I can say I like this stock. I can like that stock. And we do on this podcast and on this show, because I want to help people understand different things, but they're never blanket recommendations for anyone, right? Only blanket recommendation I'll give people, and this is purely financial, it's cheaper to keep them when you get married, because financially divorces they cost a lot of money. But if your mental state and other reasons, there are obviously reasons why if you need to leave, whatever, you may need to leave. I'm not trying to sound flippant with that, but that's not what we're here for the purpose of this conversation, right? So cheaper to keep them. That's the free financial advice. So which leads me into it. Like, I'm not sure why people want to ask people they know, or like in the case of the free financial advice, someone you don't even know, like for advice, right? For free advice. And it's fine because there are plenty of people who will give it to you, right? They'll offer you free financial advice. They'll have all the keys and all the mysteries and come get this product and you'll make $1 million, gazillion, bajillion dollars on top of that with no taxes and no penalties and the stock market is rigged and all this kind of stuff people say. Meanwhile, a majority of the wealth in this country and globally is created in the stock market. The wealth effect comes from the stock market, right? So get invested somehow, somewhere, even if it's just buying an index fund. So invest that. That's investing in yourself, right? Have some type of savings to yourself. Who do you pay first? I guess, depending on your religious beliefs, maybe you tithe first. But let's say it's without the tithes, get past the tithes. You got to pay yourself first. Pay yourself. Savings. Set up some kind of savings, right? If you don't have any savings level, go for 10. Shoot for 10 to start. You want to get that up to like 20%, ideally, if you can get there. And that 10% savings could be included from your 401k. Say you're getting 4% and your company's matching 1 or 2%. That's 6%. If you're getting 4 and they're matching 2, that's 6% saved. Figure out how to get those other 4% saved in your emergency fund. So high yield savings account's a good place for that. And then put it somewhere like if you have an investment account. So you take that 10% off the top and you save that as well, right? So you got your savings covered. Then you go into the expenses, bills, those type of things, and reward yourself. Sometimes you need to reward yourself first, but that's just structurally how you can approach budgeting. You have to take care of the bills, take care of the debt, however it goes in how it's ways. But long story short is you got to pay yourself first. You got to reinvest in yourself first, which is another thing we see with these small businesses is that it's capital intensive to start a small business, any small business, unless you've come from an industry where you already, unless you're like Elon Musk going from PayPal to Tesla, in which case, another thing people don't realize, he went and raised funds for that. These rich gazillion billionaires out here raising funds to fund their projects. So, and how does he raise his money? Selling stocks, or he's going out and doing funding rounds before it goes public. We see that right now with like SpaceX and Anthropic, those pre-market IPOs. They're going to go public eventually, but right now they're not public. So people are putting money into them, and that's another way to generate a lot of wealth. If those employees at those companies are they may have been gifted those stocks at like zero, and then this company goes public at $3, $5, whatever price it may go public for, $300-$500 a share. You own several hundred shares of this or several thousand shares of this, because these companies will sometimes give you these stocks as compensation, especially when they're startups and small businesses. That's quite the windfall when that company goes public. It's quite the windfall. If you didn't pay anything, but then all of a sudden your stock is worth $300 and you have 100 of them, that's 300,000. So in that situation, you would have to pay taxes, but you would have to figure out what to do with that money. But that's the kind of stuff where you make money. You have to invest, right? So invest in your local community. Here's the thing that people didn't realize. So, and they talk about, and once again, I'm going to say Black Wall Street, but this applies to like any community. But back in Black Wall Street, and people think like Black Wall Street was purely, all of the economics came from Black people. Guess what? White people came to Black Wall Street and bought stuff. Why did they come to Black Wall Street and buy stuff? Not necessarily because it was cheaper. It's because it was some of the highest quality things out at the time, right? Quality is what's going to get you. Quality and value are what will keep your community thriving, and then keeping those dollars inside. So a dollar that was spent in Black Wall Street generally circulated inside the community 30 to 40 times before it left. A dollar right now, even in my community, air quotes, just because I want to you have to realize that this is more than just a black or white thing. It's demographically different. It's in that K shape that we're talking about. It's K-shaped economy. Once you get down to that lower side of the K, these dollars don't stay in our communities very long, once or twice, and they're out. 6 may be the highest I've seen, right? And that was not for the Black community. And once again, this is for any community, brown community, whatever community you want to be in. You have to build up from the inside to make everything strong. You got to build up your own house before you can go out. When the plane goes to crash, they tell you to put on your own mask first before you try to help anyone else. So let's get putting on our own masks, right? We're saving, we're earning income, we're realizing our worth. We're not taking discounts from people to pay us, right? We're not having these discounts. If y'all wondering where this is coming from, it's coming from a literal experience I had today, just like recently with involvement and trying to support, because me personally, I support small businesses and local businesses as often as I can. Like I love to support them any way I can, even if it means paying more. People say, why would it cost more to shop at a small business or a local business? Let me tell you why. It's the economy of scales. Small businesses can't afford. Okay, so the more you buy generally, or the larger quantity you buy of anything, generally the price comes down, right? The more you buy, the less it costs you. So if this is the manufacturer and they're a small business and they're making, let's say they're making t-shirts. Shout out, because a small business made this t-shirt for me in my community, actually in my family. Keep those dollars in the family. Anyway, let's say that small business takes this shirt, they're making the shirt, right? And this small business orders 100 shirts, but the price break may be if you order 500 shirts or 1,000 shirts. This company may not have the wherewithal, the actual money to afford to make that type of order, right? So their cost of goods is already going to be higher. Now, they may actually save on employee or payroll costs because the small business may be doing most of these things themselves. So you may have that cost reduced. But if a business owner is doing all this stuff themselves, like I said, they're just a high-paying employee, so their hourly rate should be high. So let's say the small business owner orders 100 shirts, whereas a large corporation orders 1,000 shirts. What do you think that price discount's going to be? Then they go in, they make whatever they make the shirt, they make the product, however they make it, and it is a little bit more expensive for the person who only has 100 shirts, who only can afford product for like these smaller runs. Usually in larger runs, people are like, what do you even know about this? Like, why are you talking about this? Yeah, well, part of my master's was supply chain. So I got supply chain stuff down. Blockchain, supply chain. But anyway, so part of this is how, like I was saying, economy scales in this situation. So if they're paying more at the small business level, and they're going to have to charge you a little bit more than the big block stores, right? That's why Walmart can charge less than anyone. And I go to Walmart a lot because Walmart's right down the street from my house. So don't get me wrong. But that's also supporting the local business, because people who work at this Walmart are my neighbors, right? Would I rather be able to get the stuff I get from Walmart at some little corner grocery store that offers it? Absolutely. I don't have one that does it right around here. I'm in Indian Trail. If there's one, let me know. I'm in Indian Trail, North Carolina. If there's one down here, right down outside of Wall Street South, let me know. I haven't found that. I will pay a little bit extra to go and support a small business. I found the best burger, I think, in Indian Trail yesterday. Shout outs to, I'm not going to say their name yet, but it wasn't Wendy's or McDonald's or any of those places. Not that they would be the best burgers, but there was a time when those places did have arguably some of the best burgers. But guess what? Quality went away. They focused more on scale and economy, and their customers suffered. We've been told that economic success is purely about merit. But history shows us that when a community achieves true economic self-sufficiency, it creates a target. Once again, we're auditing the Wilmington coup. We're going to look back at that from 1898. This wasn't just a political event. It was the largest scale destruction of a Black-owned economic infrastructure in American history. Get that again. It was the largest scale destruction of Black-owned economic infrastructure in American history. It was the moment a thriving Greenwood-style economy was systematically dismantled because it had become too successful to be ignored by the status quo. But I'm not just sharing this history look back. I'm sharing it because the same economic leakage we see today and the same structural vulnerabilities that led to the destruction of these communities, they're peaking out. If you want to know how we rebuild the economic power, and more importantly, how we protect it in 2026, you need to understand this history. And stay with me to the end of this video because I'm going to reveal four modern day Greenwood ecosystems that are currently proving this economic model works right now. We're going to try to do this audit. We want to thrive while others fail. Once again, we're looking at Wilmington and this coup, and it's not necessarily particularly, once again, it's not black or white when we're doing this. These were different times. Our community day, I'm speaking more to Main Street in general, right? How can we grow together, right? How can we continue to flourish? We're going to watch this video in a second, but some things to think about. Wilmington was a booming port city where black entrepreneurs own the insurance companies, newspapers, groceries, supply chains, and banks. They weren't working. They were capital owners. When you own the supply chain, you own the community's future. The 1898 coup happened because the Main Street, the 1898 coup happened because the Main Street ecosystem had just been closed looped for the power that the establishment system couldn't control. They couldn't control who was controlling, and they couldn't handle that. The coup leaders didn't just attack people. They targeted the daily records, so the print press, all through the business district. To destroy the community, you don't need to kill everyone. You just need to destroy their ability to communicate, record, and circulate values. When you use national platforms for all your business needs or personal needs, we're essentially dismantling our own infrastructure, piece by piece, by handing our data and revenue streams to the corporations that don't share our local interests. There's a lot going on with data centers right now, right? People building data centers, people are complaining, people don't want a data center in their backyard. But just like Black Wall Street, Wilmington business owners were patronized, their services were taken and used because of the quality they provided. Wilmington, I think, was like 54% Black. So it's not like it was 80, 90% Black, but it was a majority city of African Americans, right? Even in an era of extreme systematic hostility, these business owners forced the market to respect them through sheer competition, quality. Like if you bring the best product, eventually people will come. Your only defense against economic displacement today is being so good at what you do that the market can't afford to ignore it. You hear that again? You have to be so good at what you do that the market can't afford to ignore it. And this is all things happening in Wilmington, right? How do we prevent this from happening in our modern gig economy? We got to move from being freelance competitors to independent nodes. We're looking in these industries in Wilmington and Durham today. Look at how many national conglomerates dominated the first page. If you're a local entrepreneur, This is your 1898. You're being displaced by national players just because you haven't built your digital moat yet. Are they going to burn down your city? I don't think so. But we need tools. We need to be equipped. We need knowledge. Once again, this is an outlet for people. They didn't want to plug us in, so this is the outlet. You have to share this. You have to let people know. Now, as I said before, this isn't a race thing or anything. This is just history. Let's just look at the history of it and the economics. People want to know, like, a lot of people don't even know this ever happened.
Wilmington coup is so important for American history.
Back and take a few minutes to watch this, just to see how this plays into the look at the line.
And the crisis is upon us. You must do your duty. This city, county, and state shall be rid of Negro domination once and forever. You are the sons of noble ancestry. You are Anglo-Saxons. You are armed and prepared.
It was never discussed. Nobody told us anything about what had happened in our own town. I remember there sort of being whispers talking about a race riot.
We, the undersigned citizens of the city of Wilmington and county of New Hanover, do hereby declare that we will no longer be ruled and will never again be ruled by men of African origin.
It wasn't talked about, it was deliberately covered up. We still have to contend with 120 years of silence and fear.
Why has North Carolina buried and avoided this story? We always bury the things that we're ashamed of.
It was the only armed overthrow of an elected government. Black citizens were murdered with impunity. No one was ever held accountable or held responsible.
We have taken a city as thoroughly, as completely as if captured in battle. It has been redeemed for civilization, redeemed for law and order, redeemed for decency and respectability.
This was a coup based on the devaluation of African American citizenship. What Wilmington tells us in that larger scope of American history is how fragile American democracy is.
Mother, my dear mother, what rapture did you feel?
Fragile till today.
Your daughter smiling in your arms just after the repeal.
1865.
First born out of slavery, your hopes to me effaced. Newborn cry, sweet lullabies, so long ago in 1866. Lash is still stinging, yet your songbird bringing the life that salvation redeems. Echoes still ringing, but your sunshine singing of freedom no longer in dreams.
In the years after the Civil War, we have the end of chattel slavery as we know it. 4 million people formerly held in bondage are now citizens. They have the marks of the lash on their backs. And they settle in this city that's on the rise.
The best way to understand Wilmington is to understand that coming out of the Civil War, you have Reconstruction.
That's Robert Kelly.
Reconstruction was the process by which the nation tried to come to terms with the end of slavery and the end of the Civil War, to bring the seceded states back into the Union, and to try to make good on the promises of the original founding by integrating newly freed African Americans more fully into the nation. The end of slavery means that they can have access to their families, that they can work and be paid for it, that they can have schools, that they can have churches, their own businesses, land. A lot of historians have likened it to a second American Revolution.
Before 1898, Wilmington exemplified the spirit of Reconstruction.
Wilmington was the state's largest city.
As one of the few open ports for international travel and traffic in North Carolina, this was a very prosperous city. The railroad system drove backcountry items straight into the port in Wilmington and then out into the rest of the world. So tar pitch and turpentine, the things that came from the forests in North Carolina, really drove some of this economy. The Sprint Cotton Compress here in Wilmington, they were one of the largest exporters of cotton in the world by this time.
Wilmington was one of those important centers for newly freed people to find opportunity.
There was really no other major city in the South like Wilmington. First of all, it had a majority Black population of 56%.
They have the opportunity to compete with whites for